Just a final call for everybody who is in as an attendee or an exhibitor. Please come to the presentation hall for the final keynote, the initial keynote. Thank you.
We are dead inside but look alive. Always saying that we do the right. Always saying that we do the right. I can't stop crying when I see that blizzard.
G'day, how are you? Hey.
Good morning, everyone, and welcome. That's right, there's plenty of seats, guys. You can come and have a seat. It's completely fine. People aren't scary. Just want to say welcome to day two. Obviously, I did the intro to day one. Super energetic. It was nice to actually have people back in a live room to hear the buzz of networking and also just the general conversations that take place. And Emergence is a special event for us. Initially, we designed this event to basically place a spotlight on the ecosystem, but now this whole theme of this event is the era of exponential innovation. And I think this really sums up every participating company, and it also sums up for you as an investor what you're looking for. So just for the formalities, I'll just go through. Obviously, Emergence is a 3-day experience. Obviously, yesterday we've already had day one. I know the conversation, said we literally just watched everyone talk the entire day. It was like you had pent-up discussions over the last 2 years. There's 9 networking sessions. We've done everything we can to give as much flexibility on the networking sessions as we can. And then also we've got incredible content from panel sessions, from keynote speakers and so forth throughout the days. And to me, everything we've done, when you think about the sectors we've faced and the whole thematics, I hope to sort of give context to that when I actually go through my presentation. So that's obviously the range of speakers we've got coming up today. There is a session just after me it's actually a partner session with Dan Berrycan, who's been incredibly instrumental for WI over the last sort of 18 months in helping us from a technical perspective, because the reality is, all of you know that every investee company you go into, at some stage they face either organization challenges or technical challenges to get to their goals. And that's where he's been incredibly helpful for us. So I hope you really enjoy his session. But as said, and then not only is it an incredible lineup today, and tomorrow is absolutely off the charts when we delve right into the fun stuff, when we go into Web 3.0, etc. And there's some incredible, like the Immutable X CEO is actually being here tomorrow. Lee Travis from Binance, said the largest crypto trading platform on the planet. And obviously Immutable X, you would have seen the AFR yesterday, raise an incredible amount of money at a very high valuation for such an early company. So that space is going ballistic. So basically you can connect obviously with the companies at their booths, right? Every company, each day we have different companies participating, but we obviously encourage a connection with all of them. And the philosophy that we have is that basically the power of one conversation in an event like Emergence. So I got feedback yesterday that I didn't talk about some of the success stories. What people don't realize is how many amazing success stories come out of a conference like this, right? And it comes out of the conversations, it comes out of the networking, and it comes out of often the value that you guys as attendees and as participants have with each other. And you said, we've seen companies where, where it's been ASX listed companies who we've watched go 10x within 12 months post this event. I've watched, a company that's now an ASX listed. They presented at Emergence. They had an investor put in a significant amount of money, right? That investor then introduced them to the company that they were previously CEO of, right? They ended up acquiring that company, and then that company then went and 10x'd, all in the space of a year. You guys have seen Booktopia. Booktopia is famously noted throughout, in media, where throughout 2016 to 2019, they really struggled with raising capital, even though they were the premier online platform in Australia for buying books. And yet, it was actually at the Emergence conference where they met their link to their strategic investor, and now it's obviously gone on to successfully list, and they've done an incredible job with continuously growing that business. And these stories, Long Pipes yesterday, who was here yesterday, once again, that company has now raised over $30 million from networks they've made at WI events. More than that, we've seen companies participate. When I mentioned about Immugene, in 2020 they presented, they had a market cap of $150 million. By the end of 2020, they were somewhere around or maybe even 2021, early 20, they were around the $2.5 billion mark. It is crazy the stuff that we see, and we, as a company, we probably don't talk about it enough, but just know that this is the stuff that drives this space. And every single company, and it's amazing if you actually bring everyone's networks together. Each of you have 10 to 15 people in your networks that are either investors or are active in this space. And so when you go today and when you're having conversations to your questions, obviously we're all here for selfish reasons first, and then there's the opportunity around it. But just think about who else could potentially be in your network which could be relevant to the companies which you're seeing today, even if they don't fit your portfolio. So that is the spirit of Emergence that I love to go through for the event. And I just want to say a big thank you to all our sponsors. Gave a shout out to a lot yesterday. And also, for me, I just want to say a big thank you to obviously Invest HK's co-sponsored and been great supporters of WI for a long time and been helping a lot of companies go to Hong Kong. Nudge Group did a fantastic presentation yesterday. Stephen, if any of your portfolio companies need BD hires, amazing guys to deal with. Fastlane, Apollo Capital, Remote Staff, Pepperstone, who are just outside there. It's an incredible, product offering for high net worths, for trading and so forth. To actually, and for me, seeing their platform and seeing some of the people behind the company, really highly recommend. Have a chat to the Pepperstone guys. Red Wolf, you'll get to hear from Alicia today. Alicia has single-handedly helped us transform our business in so many different ways from the people perspective, and really, as much as we all invest in technology, at the end of the day, our businesses all rely on people. And the work she has done with us and the work I've watched her do with many companies has turned that people part from moving it from that sort of art into science process. So I hope you enjoy that session today. Zerocap, incredible platform. Obviously they're here today, but also involved in the sessions tomorrow. But it's a great platform to help people be introduced to the crypto space, especially in that private wealth area. My accounts, and then also obviously Binance. Go check out the NFT gallery, go scan the QR codes and have a look at some of those. And this space has come on incredibly hot and incredibly fast, and I'll go through that in my sort of presentation. Boring stuff, obviously we've got 3 breaks throughout today. When you hear the bell rung, can I just ask that everyone come in? I know that there's going to be a buzz of networking at the time. Our role in this event is we want to give everyone their opportunity for their 8 minutes to present their business and give perspective to what they're doing and what they're building. So when we ring that bell, please come into the room. Okay, accessing the company's inside Crisp. So you should all have a Crisp account by now. If you haven't, just go to app.crisp.io. It's a simple sign-on, takes just seconds. In the filters, there's actually an event filter specifically for Emergence 2022. You'll be sent you sent in the email, but you'll send a text message about this shortly. It gives direct, in that Emergence 2022, all the companies featured throughout the actual conference are in there. Every company has videos, they've got summaries, information, etc. Just gives you an opportunity to, in your own sort of private time, give as much visibility as possible. outside of the networking that's going on today. Inside Brella, obviously that's our event app that we're using. Once again, all the companies are inside there as well. We highly recommend setting up your preferences, and then what it does is it then matches you with some of the most relevant companies for you. So effectively enjoy, obviously, day 2 of Emergence 2022. I know a lot of you will be talking for the entire day. That's pretty much how this conference rolls. Enjoy the experience, and most importantly, I said, just think about that power of one conversation, because whether it transforms the business that you're chatting with or your own investment side, that is often what we see as the outcome. And often as founders, we have to speak to 100 people to meet that one right person, but that one right person can make a difference that has 5 to 10 years of impact for a company. And that's what's exciting about this space. Or if it's a short-term high growth, it could be 3 to 5. So my topic, this has been interesting for me. So for the last sort of 12 to 18 months, and said, as you know, for me, I'm on the platform side. So really, it's only when we started launching WI Capital when I really understood every investor I dealt with had their own thesis, right? And that was interesting for me because I wanted to understand, well, what is my thesis, right? And I understand what is the area that I'm passionate about, that I love, that I see great opportunities in, that I think is interesting to me. And so when I understood that every investor has their thesis, the first thing, so my background is marketing, and so the first thing I wanted to understand is, well, what are the key sort of generational and what are the key technological trends that are taking place in the ecosystem right now? And so effectively in doing this sort of keynote for today, I hope to just give a really high level on this as a topic, because I know, and I said, this is, when I say super high level, I know that all of you do your own deep dives in your own sort of specific niche areas, but I think it's always interesting for investors to look at other potential opportunities or to learn about other areas which you can potentially add value to. So this is one of my favorite TED. Has everyone watched this TED Talk from Bill Gross? One person, wow. I thought everyone would have seen this. Okay, so this has been one of the most influential TED Talks for me, and it's by Bill Gross. It was done in 2015, and basically what he did was he did a study of the 200 companies that he invested into, and he wanted to understand, like, what are the reasons why startups actually succeed. And so he broke it down into 5 key elements. He broke it down as, is it the idea, right? Then he looked at, okay, well, is it the team and execution? Is it the business model? Is that what actually makes the difference? Is it the funding? Is it the access to funding that companies get that basically helps them really transform? And then the last one is timing. So when he actually broke it down to the areas. Basically 14% was funding, and that was interesting because effectively noting how much money companies were raising, it wasn't the most sort of influential factor. Then looked at business models. What they realized, and this is when you hear about a lot of deep tech investors, a lot of deep tech investors are investing into businesses that don't really have a business model, sort of at that point. But what they realize is that as companies go through their different phases, they start to figure out the right business model for their business. And I know I've experienced that myself. The idea, is it the idea? And obviously at that time, the people were still in ideas. Now people are looking for more sort of traction. Team and execution. For me, I would have thought this would have been the highest one. And in our psychologically, in our heads, we always think that team and execution are the key components for a business success. And absolutely, it plays a massive role. But the number one factor they found was timing. And I thought that was really interesting. If you look at the Australian stock market, if you look at the ASX, I'm sure a lot of you in your own portfolios have experienced either the upside benefit of timing or sometimes the downside and the difference it makes. And I found that interesting. So the example he gave was YouTube. They had their own version, I can't remember the name of it, but they had their own version of YouTube 1 to 2 years before YouTube. The problem was the technology wasn't quite right at that time. So when YouTube simplified their access to video, and they had more capital than YouTube at that point, and obviously everyone knows the success, it's crazy to now think that YouTube generates more revenue than Netflix. Right, that's how valuable YouTube is to Google. And I remember at the time people were saying, oh, they've paid too much for it, etc. So timing becomes an important role. So then I started thinking, okay, well, that's interesting. If that's where I'm starting, whereas the timing aspect, I like to think for myself from how can I focus on things for the next 5 to 10 years to simplify, because I like to have relentless focus on an area, no different to building a business. The relentless focus helps. So effectively, when I looked at the generational trends, the millennial one sort of really stood out to me. Sort of me being on the cusp of sort of Gen X and millennial, you know that millennials are coming into their peak earning power, right? And also, obviously, we all experience a sort of Gen Z influence. And then likewise, Gen X as well, sort of in that sort of peak earning power, in that sort of peak wealth area. And then there's the role the baby boomers has, which from a WI perspective, we built our business, you know, sort of with the sort of baby, you know, high net worth sort of baby boom market. What I found really interesting was to learn about the millennial wealth transfer. And I find this is one of the most interesting things. And so I suppose my core thing I'll say is make sure you start bringing your millennials to our conferences. Deloitte did a study of basically saying $25 million, $24 trillion will be transferred from baby boomers to millennials over the next 15 years. The AFR put out an article at the end of last year saying that there's going to be $260-something billion per year for the next 15 years transferred from baby boomers to millennials. So that becomes also interesting from a whole bunch of different conversations where we think about. And then you start to think, okay, well, what are the key trends that are important for millennials when they're thinking about either investment or they're looking at this area? Because I know a lot of family offices are also sort of working with their next generation on the next generation of investments for their family offices, and then likewise for high net worths as well. So the key areas, you know, sort of come up was obviously the access, not ownership, has been a key one that we've all seen, right? As far as that's sort of built, you know, off the back of, you know, whether it be Airbnb, Uber, etc., where you said decreasing amounts of sort of millennials and Gen Z looking, you know, interested in owning cars. They'd prefer to actually rent it. And then likewise in so many different areas. So I said, like 25 years from now, the car sharing will be the norm and car ownership an anomaly. And you think that's interesting when you look at the likes of Tesla who are working on full self-driving, because, you know, in 10 years' time, do we just book it on an app, jump in a car with no driver, and then go to our destination, right? So what's the actual need to actually own a car? And then wellness is obviously one. I'm sure me, like you, I wear a tracker. All of us have got some sort of device or some way in which we try look after our health. But wellness is obviously a big area. And, you know, I'll go to what areas I think super interesting. But you can see that, you know, this is just an analogy they've given of, you know, the perception around smoking, the difference between 1998 and 2013. Funny enough, you know, I just forgot the device. What's the device people smoke on? The vaping. That seems to be completely okay, but smoking, different story. How's that for marketing for you? Environmental, sustainable, good. You know, if you look global EV forecast, 2020 was 2.5 million. 2030, they're predicting 31.1 million. What's really cool when you think about the EV market, whether it be, you see the popularity of electric scooters, you know, when you go to, you know, when you sort of, actually even in Sydney CBD, you see the popularity of them. But when you go to sort of China or Asian countries, you see how popular they are. Likewise, electric bikes, you know, as another example, the popularity. But obviously electric vehicles from a car perspective, you know, it's really coming up to an interesting phase, and obviously there's a whole bunch of government incentive and mandates around that as an area. Plant-based protein obviously has been an area we've all seen, whether it be Impossible Foods, whether it be, you know, all the different range of sort of plant-based foods, and now obviously the marketing analogies that go along with it. But you can see why there's just the sheer growth that's expected in this as an area over the next sort of 10 years. Buy now, pay later, the one that Australia experienced really well through the eyes of Afterpay. But really now that's sort of going across so many different areas other than just, than basically just sort of, you know, when you see that people can buy a coffee on Afterpay, to me that is ridiculous. But it's like, people are doing that, or they buy a drink, you know, on Afterpay. But that's coming across into business in all sorts of different shapes and forms where it's becoming that sort of access, not ownership, or the on-demand capacity. And the craziest part, obviously not now, but I was blindsided when I couldn't believe that they crossed the value of Telstra, and then obviously were acquired by Square. But you can see that fight, you know, from an investment side for owning the transaction or having visibility over that transaction data. This one's been interesting for me, and I use this in my presentations because really as a founder, this is what we need to be thinking about. It's that move from, you know, basically the efficiency to on-demand. you think, put it simply, all markets move towards efficiency. If we as founders or we as investors can discover opportunities or create opportunities that basically help people get access to something simpler, faster, on demand, that's cheaper, etc., I said, then we're putting ourselves in a fighting position. I said, all these ones, I said, no one would have expected 10 years ago how much they would be massively disrupted. Actually, I'd say maybe 15. So this one, so one of my favorite people, and I'm sure a lot of you as well, has been sort of Kathy Wood's work that she's done on the area of innovation. I think what I like about the way she did it was she took what I was seeing in what I see from day to day and just put it into a different description. See, for me, for investments, and you probably would have noticed in the interview with Jason, I always thought things about sectors, because often when I'm speaking to investors, I try and understand what are their sectors of interest. And then you realize that when you're thinking about the next sort of 10 years and how innovation unfolds, sectors is only one aspect, but really each sector has its own platform technology that it's going to be working with, to build that. And I'll go through those different ones. But the interesting things about those platform technologies is they typically abide by this area of Wright's law, where he discovered that effectively the more that they manufacture of a product, the more the actual cost comes down. So what areas are we actually seeing this? Solar panels, as an example, right? Solar has now become the cheapest form of electricity available to people, right? Because of the sheer amount of production and the demand as it goes up. Battery cells, the cost of producing battery cells, as another example, has come down to the point that in the next 2 years it'll be cheaper. It said the goal for battery cells, especially in the US, it'll be cheaper for people to own an electric vehicle car, more so than a traditional ICE vehicle. And that becomes interesting because then what happens to the demand? So Wright's law is an interesting thing to look at. And then likewise in my own business, it's like you think, how can you overlay Wright's law into it? And I'll go through it. So, because this also relates in my mind to software businesses as well in a different way that people actually expect. Metcalfe's law has been the transformation of every single one of us in this room has benefited off Metcalfe's law. Right, and it's the simple Metcalfe's law is the power of networks. So whether you've invested into crypto or you've invested into tech companies or you've invested into social media networks, effectively what the Metcalfe's law is that all the different networks and platforms that have been built basically helps with that distribution aspect. So if you've just got 2 people that can connect, that's got a certain value. But if you've got 1 billion people that connect with each other, the power of that network becomes infinitely valuable for what can actually be backed off it. So if you factor in those 2 factors of Wright's law and then Metcalfe's law, you start to think this is really interesting, right? Because what it means is that companies will grow faster than what they did previously. Something like an immutable X, because of the power of network, the power of community, values of companies accelerate a lot faster than what they did previously, to the point that for some of us, we just don't understand how companies are achieving billion-dollar valuations so fast, right? Which we weren't seeing 10 years ago, right? If you look at Facebook as an example, how long it took them to hit $1 billion valuation, right? But now companies are doing it a lot faster, and it's because of this network effect via Metcalfe's law. And then this is the last part that I find super interesting, which is the adoption curves. Each one of these platform technologies that you look at, or these areas, have their own adoption curve. And I suppose it's understanding where they sit in adoption curve. So if you want to ask yourself, like, where do electric vehicles sit in this adoption curve aspect? Because what happens is when it goes through that early majority up to late majority, there's a massive transformation in a very short period of time. And of course, a lot of wealth is created in that period as well. So some of those areas that right in that sweet spot, obviously, renewable energy and renewable energy tech. I am super proud of the companies that Wholesale Investor works with in the renewable. If you just go into CRISP and go into opportunities and then search renewable, go and have a look at every company that comes up. We have got so many cool companies. Some are here today, some were here yesterday, but make sure you check them out. I love that we've got so many cool companies and obviously so many investors interested in that as an area. But this renewable energy trend is not going away anywhere. The sequencing of genomes is a perfect example of Wright's law, where 20 years ago it was $1 billion to sequence a single genome. Now it's down to $1,000, and that cost is coming down more and more. The next one is obviously genomics as a complete area, is that personalized healthcare solutions. You can see that this is becoming more and more obvious in health tech as an area, and then also in biotech as well. So said all the different ways, if we think about 10 to 20 years from now, if we think about genomes as being the human code for the body, then what sort of work can be done in that area? It's scary, but also exciting at the same time, and it's being predicted to be $1 trillion plus industry going forward, which is still in its very, very early stages. AI and deep learning. All of our businesses and the majority of our investee companies will start to utilize AI in some way, shape, or form. The cost of actually training AI modules has come down so much, and obviously the platforms that provide AI help so much with companies, whether it be from Google, whether it be from Microsoft, whether it be from Amazon, etc. I said for most of us, and what does this mean is that it means that our businesses can scale faster. Things that take, like for example, in the implementation of AI for Wholesale Investor, basically I was trying to decode how I actually do introductions. If you see me throughout today, you'll notice at any time, I'm basically bringing two people together at some stage, during a conference. And so then you start to think, how can you do that at scale? And that's, for us, that's the implementation of our AI and ML inside the Chris platform, which will sort of integrate completely with WI. But all of our businesses will have that because that's where we actually scale the opportunity with our companies. And it becomes exciting because the cost of it's coming down. So once again, you factor in all those things, whether it be, and that's to me what I see as the Wright's Law, is that I can be a lot more effective as a company in introductions with people because previously I would have to rely, on events or on promotions and so forth, but now it can be platform driven, and that becomes super exciting about what comes next. Obviously, the other part, I think just the infrastructure that goes into renewable energy I find interesting, and I'll explain why in the next one. 3D printing, we've seen, I'm sure we've all seen different videos about how this is starting to dominate in so many different areas, and to the point that, and I'll use Tesla again, where they're trying to get they've got the gigapress to make one piece for the molds of their cars going forward. And obviously, anyone that's manufacturing anything, the less pieces they have, the easier the mass production becomes. Crypto. I said, so I should call it Web 3.0 now. That seems like the investor-friendly way of saying it. But crypto and Web 3.0, all of us have experienced this. Just think about how fast this has come on as an opportunity. Just think about the talent that is moving into this space. Think about the opportunities in that area. And just out of curiosity, so I know I do, who in the room owns some type of crypto, whether it be Bitcoin, Ethereum, or anything like that, right? All of us do at some point, right? So I'd be curious to know the NFT. Who actually owns an NFT out of curiosity? Okay, interesting. So that's, to me, that was like what crypto was in 2017, 2018. And it's like NFTs, we sit here and think, how on earth are these people, making so much money, or what on earth is going on in this space? And it's like, yes, it's volatile, but so is this whole startup space, right? So crypto I find also interesting because, it says positioned as Web 3.0, and if you think about the role that Web 1.0 and then Web 2.0 had for the building of information networks and then the platforms, then it's basically the monetization of that becomes really interesting. So for me, I find the whole area interesting. This to me, seeing the Ethereum trend as far as how many people have Ethereum, this is obviously not including people that have it on exchanges. This is people just have Ethereum wallets. The growth of that is so interesting when you see the adoption rate, and think about if you compare that to the internet adoption rate. I said it really, by 2025, 2026, this could be 1 billion people. And that becomes, you think, okay, well, the more people actually moving into that space, the more value that gets created, the more opportunities that get created, because ultimately more applications will be built on top of it. And then secondly, there's a community value creation to it. So even for myself, I have to think about how can I create value out of our community outside of the introductions that we make? How can we use this new layer to create more value amongst the wholesale investor ecosystem? And ultimately, we all know that when this takes place, a rising tide lifts all boats, right? So whilst people focus on the platform side, effectively, if you think about the rise of social media, it's created, that rising boat has basically created all new sectors, it's created all new layers of opportunities. And for those of us that still remember classified ads in the newspaper, and we think about how that got disrupted by the internet, not only does it get replaced and disrupted, but then it gets 10x on top of that, right? So whatever's been built, that's why for me, I think it's super exciting to think about the wealth that will be created over the next 5 to 10 years could significantly exceed the wealth created over the last 20 years. And obviously that combination of platforms, marketplace, subscription models, the on-demand aspect, and the way sort of you can aggregate through platforms and then also provide offerings through that becomes really interesting. So that's my part. And then I think I wanted to give you context then, well, how are we thinking about then as a company, right? Because there's no point sort of talking about it and then not actually making sure that we're also part of this innovation change as well ourselves. Because for me, I've identified these are the problems for our space. I see it every single day, how fragmented it is. I see that most people are still using Excel spreadsheet. It's very much legacy driven in the way people do it. It's isolated. And there's very little data still in this area. And it's crazy when you think how much money gets pumped into innovation, but not really into the actual act which helps fund it, which is the capital raising area and the venture investment. So for me, the way I think about it is that I feel that software can, while I said, I love the buzz of networking, I love the energy that goes along with this, but really from a, how it can scale your access to opportunities and how it can scale for companies as far as their access to potential investors. To me, software and AI and ML have to lead the way because effectively it can create a personalized deal flow. So people can have that best of both worlds where they can connect offline, but also get access to what they want online in a streamlined and efficient way. And so for us, we've thought about how we can not only be software driven, obviously we massively believe in the value of ecosystems, and also it needs to be end to end, but more importantly, I said there needs to be AI behind it because effectively what technology's role in our lives is to improve our experience and also to make it easier to access what we want when we want it, right? So AI becomes important. And then also the final part, which you guys wouldn't know about yet, but we will be integrating the WI and CRISP site. And then in that, right now you're using the Brella app for this conference. Hopefully by the next conference, we'll have built our own ability to do meetings and conferences inside the app, right? Because for me, I want everyone to have the experience actually inside the platform and get to meet who they want to meet, sometimes before, sometimes during, sometimes after. And then the tools that go along with it. So last year we launched secondary sales. In the future, I'd love to give access to SME debt for companies, facilitate deal syndication, which we've been doing, and then lastly, book builds as well as part of that. So there's some of the features that the ecosystem does already. We just want to simplify it through the platform. And then people have been asking about WI Capital, which some of you would have seen the stand out there. So effectively, the reason for WI Capital is obviously we are a platform, but over time I've seen in the US and especially in the US and also with the likes of sort of our crowd, is that we're in a unique position. Like we've had 10 of our clients go on to become unicorns. We've had 65 of our clients go on to exit. So I don't know many VCs or investment groups that have been able to achieve that inside of this sort of APAC region. So it's an incredible milestone. So when we thought, how can we facilitate that? How can we simplify components and also still allow you to do what you do as an investor, but also provide access to some other opportunities. So secondary sales is one way. We also, late last year, we launched our own fund. We are providing the capacity to license other advisors because we acquired our own AFSL. Because the reason is obviously we've got our own ecosystem, we've got our own software, and then obviously we want to empower that through the platform. Investor-led syndicates, which you guys will hear a lot more about over the next sort of 12 months with different opportunities, and then over the next and then the other one is sort of co-investments down the track. So these is the way we've sort of thought about how we want to position ourselves going forward. Effectively, we are ecosystem driven forward. We want to make sure that you get what you want. Obviously, the software enabled, we've launched an office in the UK. We actually have 7 team members now, 6 team members, sorry. And we're actually hosting a conference, we're hosting Emergence at the end of this month in the UK. And the investment-led syndicate, obviously it's very simple. It's just really giving people access to, sometimes with opportunities, they have very specific criteria which make it difficult. And so what the hope is the investor-led is if there's a lead investor in a transaction, and they've got a final amount they sort of want to complete, and it's sort of in our area of our interest, then we want to facilitate that through the actual database. So typically they're going to be led by an experienced investor, and then it just provides smaller minimums from 50, see the dollar signs in the wrong area. And then obviously just the risk diversification part for people. So the first two that we sort of highlight is we did this with Elixir last year and also Earnity as well. And it was, for me, I said, I'm passionate about that renewable energy tech area, and Elixir was one of those companies we've been working with now for 3 years. And then also secondary sales, we've worked with the likes of Impossible Foods through BMYG, Melbourne Victory, Surf Lakes, and Mint. And I said, that secondary sales part is something we're offering to a lot of the public unlisted companies that are unable to do secondary sales themselves, so we can facilitate that for them on their behalf. And a bit of a testimonial. So the fund, the last part I'll just talk about is the fund. The reason I did the fund with Hatcher Plus is Hatcher Plus, basically they're focused on how do you scale investing, and they've got a data-driven approach to how they actually do that. For me, it was really alignment because we're focused on how do you scale capital raising. And so what we've done now is we've isolated our first investment targets for the fund, and effectively what we're looking to do is pick some of the top accelerator groups in Australia and not only support them with money, but obviously support them via the platform and then support them via the WI ecosystem as well. Because obviously we've seen a lot of growth, and we know that sometimes when the companies get that help at the earlier stages, it can make a transformational difference for them. That's our team, obviously strong experience across the board, whether it be in private equity or also in capital markets. And just while I've got 1 more minute left, the current upcoming opportunities with WI. So 2 things I'll flag is that over the next couple of weeks, you'll see we'll be announcing our own capital raise for us. You guys would have seen over the last 2 years, we went from a team of 18 and basically we've hit milestones as far as launching in the UK, getting significant revenue growth already in the UK, acquiring our own AFSL, launching WI Capital, launching secondary sales, doing our first investment-led syndicates, and obviously growing the core business as well. And at the same time as that, growing the amount of interactions between obviously our companies and our investors. So everything we want to do, we're focused on investing to scale the business going forward so that we can create more opportunities for obviously our clients, and then also more opportunities for you guys as investors. And then obviously there's an ability to participate in the H&WI fund. That's my details. I'm obviously around all day doing my best to network with everyone and interact with people. So I hope you enjoyed that presentation. Now I'm going to do a quick introduction to our feature presentation now. So as I mentioned to you before, Den has been really important, transformational for me. When I first sat down with Den, and then he took me through his background, and I really understood that his experience in the technology space and everything he's come across from a technical issue to a strategic issue has really helped us transform as a company. So in inviting him today, I really wanted him to share some of his insights that he's found working with both early stage companies and also later stage companies. And to give you some perspective, when I won't mention their names, but when typically venture investment groups have technical challenges with their investee companies, they call in his team to basically assist them. So on that note, please welcome Mr. Dan Berrican.
Hello. Amazing speech and absolutely fascinating effort, Steve, what you're doing for this community. I just want to give applause to Steve. Thank you, Steve. All right. Welcome on site. All right, just stop for a sec here. This is the first time we are together in the last 2 years. I'm Dan Berrican, Managing Partner of Fastlane Solutions. And I'm here to talk about this community or tell you what this is all about, and to welcome you to the second day of Emergence 2022. While you're getting used to the music of my voice and accent and watching in the background and some slides that I prepared, I want to talk about this community. First of all, it takes huge skills and leadership to survive and succeed in the environment like this. Just imagine that. Right? Leadership was easy when nothing was happening. Nothing before it actually started happening 2 years ago. Right? It's only under pressure that you can see and realize the real thought leadership. It's only under pressure that investors will appreciate the real investment value of a strong, resilient business. And this is what this community is all about. Wholesale investor community. Metcalfe's law, I call it Torso's law. All right. We, as leaders in this community, we don't hesitate. We take this job of creating the value on our shoulders, and we take that challenge and we persevere. So everyone, congratulations on your achievements and welcome to the second day of Emergence 2022. Give yourself a clap. Now, how many times in the last 2 years, or should I say last 2 weeks, you've been actually asked, or your decisions were challenged to be either too conservative or too reckless? Me personally, too many times. Partners, investors, vendors, whoever, everyone, employees, right? And how many out of them actually come with a real, actual help? Don't know, just putting it out there. So it's impossible to satisfy everyone, including your cell phone interest in the process. Impossible. So how do you navigate and how do you build a successful business in the environment of continuous, permanent crisis and uncertainty? Well, once a very wise man said that we are facing not a crisis or a problem of knowledge, and from me I would like to say, and money, or lack of money. But actually, if you think about it, knowledge is abundant. It's almost free nowadays. You can sign up for Wholesale Investor and get huge volume library of knowledge about how to do capital raising in the best way. Similar way you can access any other knowledge. By the way, money are cheap nowadays as well. All right? The problem we are facing is the problem of wisdom and wise actions. You can have all the knowledge you want or can get access to, but it takes a lot of smarts to navigate the challenge and create a growth, create a value, right? It is a very hard, continuous balancing exercise in the business, especially so in the STEM businesses where I'm personally involved a lot nowadays. Now, we are at the start, I prefer to think in a positive way, we are at the start of a new historical era. And I'm sure that in not so far future, we're gonna see hundreds of publications and research and articles devoted to what happened and how we could have actioned it better. I sincerely hope that many of us here today will be able to say that they deal with that challenge like with the opportunity, with haste, but with wisdom, creating growth and value for the benefits of the community, not forgetting yourself. Because leadership is not about having money or more of it. Leadership is not about knowing stuff. Leadership is about knowing your people and your community and leveraging resources, assets at your disposal for the good of that community and its future. And where do you get that wisdom from? I'm just asking you. That's right, from here, from this community. And if for some reasons you have a difficulty with that, please come and see us at Fastlane Solutions, an Australian advisory and consulting firm whose mission is to enable smarter private equity ecosystem in Australia by engaging beyond money with founders and with the investors. Thank you very much for listening. Thank you for your resilience. Thank you for your wisdom and integrity. Congratulations, ladies and gentlemen, and welcome to the second day of Emergence 2022.
Good morning, everyone. I'm Leila. I'm part of Wholesale Investors team, and I'm going to be introducing the companies here today. Just quickly, show of hands, who was here yesterday? You three? Cool. So most of you already know, but for those who doesn't, I'm going to explain how it works. Companies will present 8 minutes here live on stage. And then, as Steve mentioned before, if you already have an account on CRISP, just go ahead and express interest so you can keep in touch with the founder and also review their documentation. If you don't have an account yet, please let us know, and then we're going to help you setting up. Literally takes 5 minutes. For question and answer with the clients, please go ahead and talk to them in the booths outside. I'm sure they're going to love to have a chat with you. And last but not least, I highly recommend you to use the headphones for a better experience. Cool, so let's get started. First, we're going to have Brett Quinn, CEO and founder of StrategyX.
Hi everybody, I'm Brett Quinn, CEO and founder of StrategyX. The paragraph on the screen now is our why and our value proposition. We want to help business owners, leaders and managers go from where they are now to where they want to be by providing an affordable business operating system that enables world-class execution and business operating excellence. We're solving the biggest challenge that business owners, leaders and managers face, and that's how to build high-performing teams that can consistently execute and achieve a company's goals. Think about all of the businesses you know. Do they execute well? Global statistics show that 75% of all businesses will completely fail, and many more won't achieve their vision, mission, goals or targets. How many businesses have you invested in that have not delivered? There is only one thing that sits between dreams and reality, or between a seed and Series A round, and that's execution. You know how managers say, "Didn't I ask you to do that?" Or get to the end of the day and say, "I was so busy," but struggle to tell you what they actually achieved? Effort is just effort without results, and we can no longer sit by and watch managers and leaders not execute. There are a number of technical reasons why leaders and managers don't execute well, which I could talk about all day, but they can be distilled into these 3 key points. A lack of structure. Many leaders and managers don't know what structure is required to achieve world-class execution and operating excellence. And the second point relates a little to the first. 99% of the world's startups and SMEs cannot afford to hire management consulting firms or expert chief operating officers. And then add the human element, where leaders and managers have varying levels of knowledge, experience, and training. And what do you end up with? Leaders and managers who can't execute and can't make it happen. Imagine a world where businesses just deliver on their promises, execute on their plans, and meet their targets. Imagine the positive impact that would have on business owners, their families, the communities in which they live, and the economies in which they operate. Just like Windows and Mac OS are the operating systems that make your computer run well, StrategyX is the business operating system that makes your business run well. Via our platform, we give businesses the structure that removes the guesswork out of achieving execution excellence. We've automated many of the execution principles, which enables leaders to spend more time on important activities and less time micromanaging staff. Our platform provides leaders with the visibility to know at any point in time what's working and what's not for rapid continuous growth. Once you combine structure, automation, and visibility, you will determine human behaviours, which will drive business performance. Then make the operating system affordable and accessible. And finally, you end up with sustainable businesses for generations to come. So why launch StrategyX now? The problem has not been solved. Regardless of where you are in the world, the statistics of business failure has not changed for 100 years. The pandemic has forced companies to operate differently, exaggerating the execution problem. And it's the right time. We are simply meeting an existing need in a dramatically better way. The question is, how do you achieve world-class execution in today's world? On the y-axis of our quadrant, we have cost, low and high. On the x-axis, we have personal involvement or touch, again, low and high. Management consulting typically entails high personal involvement and high cost, which puts them out of reach for 99% of the world's startups and SMEs. And there is no guarantee of sustainability in 2 years' time. Whilst many software platforms entail low personal involvement and low cost, these platforms are highly customizable, which unfortunately means most leaders end up customizing their own failure. StrategyX is a prescriptive platform which takes away the guesswork for how to achieve execution excellence. And we are significantly more affordable, accessible, and sustainable than the outcome produced by management consulting firms. So what is our competitive advantage? Well, our platform is affordable and accessible to all of the world's businesses. Our structure is prescriptive, which takes the guesswork out of achieving world-class execution. Our unique automations ensure managers focus on what's important, and when you combine these 3 points with rigorous visibility that allows companies to continuously improve and rapidly grow, businesses make more profit and have a greater impact on the world. And sustainability is just the result. We have gone well past building a minimum viable product and are well on our way to product market fit. Our web and mobile applications are already built, and we have over 500 registered users. We are generating revenue, and we have 21 companies in 14 different industries, which have provided us with a 97% customer satisfaction rate. And here's one of the many charts that demonstrates the results our customers are achieving. In addition to this, any client who has signed up to the StrategyX platform is still in business today. Our target market is startups and SMEs. Globally, there are 100 million startups annually and 700 million SMEs. Our geographical target market is Australia, the USA, and the UK. If we're able to sign up 17,000 of these businesses globally, we will achieve our goal of $100 million in annual recurring revenue. The way we generate revenue is each user pays $25 per month. A company can purchase other value-add modules within the platform for $100 per month each. And if a company wants customized and personalized support, they pay for a consulting membership of $600 per manager per month. Why should you invest? Our application is fully developed and tested. The execution problem globally has not been solved. It's the right time, and we have an amazing team of domain experts that have a combined 100 years specializing in world-class execution and business operating excellence. Each member of our team owns an equity stake in our business. We are raising US $1 million in exchange for 15% equity via a convertible note. These funds will enable StrategyX to establish its first full-time sales and marketing team and provide a 2-year funding runway. I listed my last business on the Australian Stock Exchange, and I am confident we will conduct our next IPO within 5 years. I would like to leave you with this parting thought. As an investor, you have an interest in seeing your current portfolio businesses execute well. If you invest in StrategyX today and then refer us to your portfolio businesses, those businesses will execute better, their value will increase, and you'll see an immediate return on your investment in StrategyX.
Okay. Thank you, Brett. Next up, we have Nick Raffaelli, CEO of AltX.
Good morning, everybody. Hope you can hear me clearly. I'm Nick Raffaelli, co-founder and co-CEO of AltX. Perhaps I set the stage for the talk with the following proposition. If you're an investor who's interested in a steady, consistent monthly income yield of 5 to 8% per annum paid monthly, backed by bricks and mortar security with personal guarantees from your counterparty with a product you can easily understand, then you're going to find the AltX presentation and what we do at AltX very interesting. If by contrast, what you're looking for in this presentation is the next biotech or the next fintech, which is going to return you 10x in a very short period of time, that is what AltX is not. So we are, if I can perhaps say, we are the tortoise as opposed to the hare, and if you're constructing a portfolio with high growth opportunities, we will be the balance on the other side, providing slower, steady, consistent income on a monthly basis. At the very heart of it, AltX answers the following question. Why is it that quarter on quarter, the major banks return billions and billions of dollars of profits to their shareholders, whereas we, as people holding cash, when we turn up to the bank to put money on deposit to try and earn a return, all we are offered is a measly 0.1 or 0.15%. Why is there that massive discrepancy between what the bank is able to achieve and what's offered to people who turn up as customers at the bank? And what AltX does addresses that question and really puts the power of the bank in the hands of ordinary investors like ourselves. In layman's terms, we actually use the expression, be the bank, stand in the shoes of the bank, enjoy the opportunities that the bank does. So in this simple example, you can see it on screen. You as the investor actually act as the bank. You provide capital through to the borrower. In this example, it's a $1 million transaction. It's a $1 million property with a $700,000 loan. So borrower wants to borrow $700,000. Investor puts the money through. The borrower pays monthly interest, which normally the bank would receive, but the investor gets it. And the investor has three important benefits. They get security over property in the same way that a bank does, the benefit of the mortgage. They get the monthly income, which the borrower pays through, and they also get the benefit of personal guarantees provided by the borrower. AltX is not a new business. We've been going for a decade. We're a deeply established business with a team of 40 plus people based in Sydney and in Melbourne. We've funded over 1,000 transactions, lent over $2.5 billion, and proud to be able to say we've achieved this with a track record of zero capital loss for our investors. So we've returned 100% of capital and interest for investors who've participated in AltX products. The wholesale investor environment has been very successful for us too. Obviously, the audience is wholesale investors who have cash and are looking for opportunities, and we've raised many millions of dollars working with wholesale investor. Mainly, the investors have been delighted with being able to access these sorts of opportunities which historically have been inaccessible to ordinary people. So the concept has almost been, how do you get access to these opportunities? Historically, it was done in a sort of clubby, private sort of way, and if you weren't invited to participate, you never saw the opportunity. What we do through the AltX platform is we democratize the access. By that I mean we make the deals available to everybody on the AltX platform so that every evening at 5:30 when we put out a deal, hundreds and hundreds of investors simultaneously can see and invest in the deal, get access to the same information at exactly the same time. So whether you're based in Darwin or Broome, Perth or Wagga, Sydney or Melbourne, you're seeing exactly the same info and getting access to the same deal, which historically you would never have seen. In terms of the problem, obviously it's one of yield in this environment. You know, investors are struggling for yield, particularly more retirees who are looking for income, struggling for how to get yield on their portfolio without taking undue risk. So everybody wants yield, but nobody wants to lose capital. The solution that we provide is, as I said, we enable investors to effectively be the bank, step into the shoes of the bank and provide the capital in the same way that the bank would. So they get the benefit of a registered first mortgage, monthly income, and guarantees from the borrowers who take the capital. AltX, of course, is the platform that sits in the middle. We manage the transaction. An important part of this, very important to note, is that we pre-fund the deals at AltX. So we're not just matching you randomly to borrowers. AltX leads with our own money. So we will fund the borrower, step one. Step two, we will syndicate the deal to investors. So when we bring you a deal, we vetted it, our credit team's gone through it, and we've put our own money into the deal before we decide to show it to you, the investors. So we're not just a pure matching platform. We call ourselves a managed marketplace. Managed in the sense that we manage the quality of the transactions that come onto the platform for the benefit of the investors. In terms of the team, I won't go through all the names. Probably the key takeaway here is we started a decade ago as a team of 3. Today we're a team of 45 plus people, as I said, based in Sydney and in Melbourne. And our team covers the full range of expertise, everything through from the transaction origination, the funding, the underwriting, the investor management, the monthly statements, the income, the loan management, dealing with the borrowers. On the construction side, dealing with construction projects, all the way through to returning capital to investors at the end. So if you're investing with AltX, it's not a startup proposition, it's a well-established team with expertise across the board, able to execute on what we do every day. We were asked to look at the competitor comparison. I like to frame this in the context of other asset classes. So if you think about equities, equities obviously generate the highest return of the asset classes and with the most liquidity. The issue, of course, with equities is that they have high volatility and high potential loss of capital. Bonds, on the other hand, are strong where equities, they're basically the inverse of equities. So what equities do well, bonds do badly and vice versa. So with bonds, you'll get consistent income, but you won't get, you'll get lower volatility. You'll get lower volatility with bonds, but there's much less liquidity. So you have the volatility of equities and you have the stability of bonds, but there's that missing piece, the product which can offer you a bit of everything, and that's where the AltX investments step in. So they provide you with an acceptable level of liquidity, with transparency on what you're investing in, the monthly yields, the security of the property, and the guarantees from the borrowers. People ask, how big is this market? You know, who are these borrowers? Who actually takes this money? And we frame this in the context of a quadrant, just to show how big the opportunity actually is. So if you look at the top right quadrants, that's lenders who favor borrowers with strong asset backing and conventional income. So that'd be the big banks. So you've got a property as security and you've got monthly pay slips. AltX in the left quadrant, we also require asset backing on all of our transactions, but we're happy to look at borrowers who have non-conventional income. So it might be family trust income, it might be income through buying and selling assets, anything which is slightly unusual or slightly not what the banks would expect to see. And as the banks are more and more rigid, the opportunity for AltX grows. So the point here is that our opportunity set is certainly as big as the banks. In summary, in terms of what we're able to offer and what our proposition is to the investors, as I said, we offer the opportunity to invest in first mortgage-backed real estate transactions. We offer monthly yield with security and guarantees. Investors can participate either in individual deals, which we put up on our platform, or they can invest in our managed funds, which give you a spread of deals. We're here at Wholesale Investor, where we've had success with investors like yourselves in the past. We're at stand number 19, and we'll be here all of today, and our team will be here tomorrow as well. And we welcome any inquiries. We're also on crisp with all of our data. So thank you very much.
Q&A. Next up, we have Steve Placotaris, CEO of Dr. Mark Hygiene.
Good morning. Ladies and gentlemen, thank you for being here with me this morning. Actually, thank you for being here with all of us this morning. I'm Steve Placotaris, CEO and Managing Director of Dr. Mark's Hygiene. Every once in a while, a really big idea comes along in a really small and simple package. And that's what we do. Dr. Mark's Hygiene is a personal care business in the global oral hygiene space. To date, we've raised just over $2.4 million, with which we have developed an innovative world-first hygiene system for the care of removable dental appliances. Anything that goes in and out of the mouth temporarily, like a denture, a sports mouth guard, a night guard, an orthodontic retainer, clear aligners. And I would bet that everyone in this room has got a story about something like that. Hey, Mom, where's my mouth guard? Have you seen my mouth guard? Or your child's orthodontic retainer that ends up in a bin with chocolate cake all over it. In the 27 months that we've been in market, we now have proof of concept, and our concept is relevant to the hundreds of millions of people around the world that wear a dental appliance. After those 27 months in market, we have onboarded 17 distributors in 12 countries around the world. We have sales. We have year-on-year revenue growth of just under 40%. And again, we're trading in 12 countries. Actually, it's 13 as of Monday. We onboarded Singapore. Here's our mission. Our mission is to reduce the physical, emotional, and financial burden that poor oral hygiene that begets oral disease places on the wearer of dental appliances, the carer of them, their families, and from a big financial perspective, the healthcare delivery systems. Okay, here's the problem that we solve. It is widely acknowledged by healthcare practitioners all around the world that dental appliances are poorly cared for after purchase. Here's the real problem. There is an enormous cost associated with that poor care. There's a physical cost. There's an emotional cost. There's a cost to vanity, and of course, the financial cost. In fact, poor oral health begets oral disease, and oral disease can be fatal. Dr. Marks Hygiene is the solution to that problem. We view fixing that problem as a worldwide business opportunity. See, any concept or protocol that will improve oral hygiene and reduce the elements of oral disease will reduce costs to all of those participants in that continuum. And look, the world wants us. We launched the business in November of 2019 after nearly 5 years in development and just 2.1 million invested in R&D. And as I've said previously, in those 27 months, we've onboarded 17 distributors in 12 countries, around 13 countries. I've got to keep saying 13 around the world. Is there competition? Absolutely. And the competition is formidable. This chart will show you the competition in order of prevalence. Might surprise you to know that the most competitive set for taking care of a dental appliance is a rinse with water. Think about that. Then there's the toothbrush. Pretty hard to compete against the toothbrush. There is only one innovative, patented system that combines the three required elements for aftercare, which is rigorous brushing, soap-based washing, and dry storage as a deterrent. Hands down, the Hygiene system wins. We have a very strong, very lean management team. Right now, I run the business. Dr. Mark Wotherspoon, who's the inventor of the product range, and Philip Wass, our CFO. Very lean, very experienced, and as you've heard from a number of other people, we too have about 100 years of experience in the relevant skill sets required to scale our business up. Why are we at Emergence? We are here to raise 1.5 to 2 million to scale up the business for a launch into the lucrative US personal care market. There is no bigger market for this type of product than the United States of America, where there are 95 million removable dental appliance users in the USA alone. Our priorities include continue to develop and trial our product, identify our unit and market economics, build up inventory as required, and working capital. We're seeking a minimum commitment of 100,000 Aussie dollars, and we currently have a pre-money valuation of $10 million. Traction to date, we have traction to date. We are addressing a significant global health issue. We have forecasted earnings, and I want to reiterate that we have a robust portfolio of intellectual property, which includes 2 patents, including the only patented sports mouthguard carrier in the world. Why would you invest with us? We have a breakthrough concept and product technology. There is nothing else like this and everything else we produce in the world. We have patented technology and a stable of IP. The product range has been launched and tested in Australia and the US. And again, we have traction, we have proof of concept. We're already producing sales with a recurring revenue model. So in addition to the Hero core products, we have Hero consumable products that are generating a recurring revenue model. The experienced management team, we have forecasted profits from year 3. We are committed to a liquidity event at some point in the future, whatever that might be, but we are committed to a liquidity event. And we have a capital structure, and this is important to Australian investors, please. We have a capital structure that allows Australian investors an early stage innovation company or ESIC tax benefits, and there's quite a number of those. That's it. That's it. I'm here all day. Let's really start talking. I'd like to tell you a lot more about our story than I can. It's an 8-year story that I've tried to convince here in about 7 minutes. There's a whole lot more to it. I have product examples, and I'd love the opportunity to speak with you further if you'd like. Thanks so much for your attention, and do enjoy the rest of the day.
Good? All right, can we change the slide, please?
Thank you, Steve. Up next is Mark Garbelotto, CEO and co-founder of Primal Organix.
Thank you. All right, so show of hands if you know anybody that has suffered from anxiety or mental health. Please be honest with yourself. Show of hands, yep. Okay, look around, everybody. Keep your hand up, please. Look around. Look around. Everybody look around at each other. At Primal Organix, we believe that we have a social responsibility to confront mental health, anxiety, and discuss it with our business colleagues, our partners, our friends, our families, and communities. So what I want to do today is just take 45 seconds for you to talk to the person next to you about, do you know anybody that has suffered anxiety? So just take 45 seconds, turn to the person next to you or behind you, and just have a quick discussion. All right, okay. So now let's look at some stats. According to Beyond Blue, anxiety is the most common mental health problem in Australia. 1 in 4 people will suffer anxiety. 2.5 million people take antidepressants. 45% of people have anxiety and depression, and 4.9 million people have an anxiety disorder. Did anybody see the news this morning or last night on ABC? Show of hands if you saw it. Yep. You would have seen them talking about anxiety. It is a massive, massive problem. And we're here to show you a product that has already helped over 20,000 people all over Australia. And our product is designed in multiple delivery applications to help people very, very quickly. In actual fact, our sublingual product, which is now in over 70 stores, in independent pharmacies, health food stores, naturopaths, is a product that is a sublingual product. And this product, you put it under your tongue for 30 seconds. Under your tongue for 30 seconds, into your bloodstream, into your central nervous system, straight up to the receptors to give you that balance and mood swing to manage your anxiety within 30 seconds. This product currently is helping many, many thousands of people. Many thousands of people. And today, if you come down to visit us on booth 21, I'm going to give you for free one of these products for you to try. Because the way this product moves is by word of mouth. This product is a try and get the relief from anxiety in 30 seconds. And if we can manage your anxiety in 30 seconds, this can help you and a lot of people. This product currently retails in our independent pharmacies and naturopath stores and health food stores at $65. We manufacture this in our WA factory for $6.50. So our margin on this product is quite large. Would you not agree with that? Because at the end of the day, you have to take a product to the market that solves a problem, and anxiety, as we all agree, is a massive problem. Our next product we brought to the market is a roll-on topical product. We brought this product to the market to put into Coles, Woolies, Priceline, independent pharmacies, Costco's, under $20. Under $20, it's a roll-on product. Keep it in your pocket, nice and discreet. Our next product's carbonated water, first product in the world. At some point in the future, you'll be able to walk into a BP. If you've got anxiety, you'll be able to pick up a carbonated water, drink it, and straight into your bloodstream, manage anxiety in seconds. We also have a dry powder format. So you understand the Barocca concept, where you put a Barocca tablet in your bottle of water. It's great for traveling. You've got that. And what we see is the next biggest move is what we call a gummy. And a gummy is to get a perfect dose for teenagers and children that have got social anxiety and anxiety across the board. Our products have gone through research and development for over 3 years. Our vision is to supply the global demand of people who are suffering from anxiety and mental health. It is a global pandemic, make no mistake. And our job is to give people the relief that they need without taking pharmaceutical products that have side effects. And if we can do that and help our children, our teenagers, our adults manage anxiety, life becomes a lot more easier to manage. Our traction to date. Make no mistake, we're in our 4th year. We're ready for commercialisation. We are not a startup. 10 years in research and development. We work very closely with Oz Industries, and over the last 3 years consecutively, jointly, we've raised over $150,000 in research and development because our products go through a rigorous research and development, and they sometimes take 1 year to 2 years to get to market. We're first to market with our products. We're Australian-made, all natural. We have our own manufacturing facility in Western Australia where we manufacture all of our products. That's where we are able to deliver a product at recommended retail price for our sublingual product at $65 recommended retail, but we can manufacture that at $6.50. So our return for investors is massive. And let me tell you, anxiety is not going away. 70 stores currently, 500,000 plus in sales revenue. We've already raised $700,000 from our investors, and we are ready for commercialisation. The market opportunity is quite simple. In 2020, it was a $2.5 trillion industry affecting the economy. By 2030, if you read the Australian National Mental Health Commission, the report, and you do the numbers, by 2030 it's going to be a $23 trillion industry. Primal Organix is wanting to capture 0.5% of that market, which equates to $1.15 trillion. We're raising $1.3 million, the last part of our $2 million, for 13% of the business. I'm down at booth 21. Come and pick up an IM, come and get a free sample, and come and have a chat to us. My name's Mark Gabellotto, Primal Organix. Thank you.
Thank you, Mark. Thank you, Mark. And finally, for the next session, we have Sean Fox, founder of Responsible Entity Services.
Hello, everybody. My name is Sean Fox. Some of you would have seen me speak yesterday. I was talking on one of my funds management companies. Today, I'm talking about the backbone of all my companies, really, which is Responsible Entity Services. I want to talk today about what our opportunity is, or our ability to then work for fund managers, people trying to raise funds, people trying to do credit activities. I'll tell you a little bit about my story. I started fundraising about 9 years ago. I started retail fundraising about 5 years ago. And I had a lot of hurdles in that market. Number one, especially as retail, all of our services are full retail, so it's the full complement of licenses. My hurdles were when I was going out and I was seeing lawyers and I said, look, I want to raise retail funds. And everybody would say to me, look, retail's too hard. A lot of the times it's people don't have the ability to license for it. So I saw a lot of lawyers, and they all told me the same thing. I said, look, can you authorize me for retail fundraising? I said, yes. So it's great. So my first question was, how long is it going to take? And they said, I don't know. So, why don't you know? You've done it before. I said, okay, what's it going to cost me? I don't know. So, you've done it before, but you can't tell me how much it's going to cost or how long it's going to take to get there. So I spent a lot of money paying lawyers to go and learn how to do the things that I wanted to do. Now, my very first retail PDS that I paid for to put together was quoted at 8 months and $80,000. 18 months later and $320,000, and I still didn't have a retail PDS into the market. So what I did is some of my very first hires, if we go back a few years ago, I had 2 salespeople, right? We're a marketing company. Fundraising in the retail market, you're a marketing company. I had 2 full-time salespeople and I had 8 lawyers on staff who were then writing PDSs and documents for us. Where we're at today, we've got 22 full-time lawyers on staff. We own a whole raft of licenses. We have an AFSL, a full retail AFSL. We have an ACL. We have a remittance license, so we can convert fiat to fiat, fiat to crypto, vice versa, and we have a digital exchange license as well. We're currently at 22 lawyers, maybe 24 today. We're trying to get that number to 40 by June. We have so much work on at the moment. What we do a little bit different to the other services that I've gone out for, we give fixed price, fixed time. You come in, game it out with me. What are your services? What are you trying to do? Are you trying to do credit lending? Are you trying to raise some money? Are you raising in the right format? So I'll game that out with you to actually see what it is you want to be, what's your value proposition in the market. And then we'll look at our licenses, what we have, and if we don't have it, then we've got a lot of other sort of relationships with friends out there who we can refer you to. It's about getting you commercial as fast as humanly possible. I'll talk about a few of the actual individual licenses. So AFSLs, look, most of you guys are familiar with that. We've got the ability to license you for raising funds under whatever format that you want to. Ours is full retail. I talked a lot about retail. My thoughts are on this, and I was in the trenches like most of you, working out how do I raise my funds, who do I talk to, how do I access the market. A lot of people say that the retail market's too hard. It's fantastic. It means I'm the only person in there doing it. I've got a totally uncapped market to go and raise funds from. And if you can win over retail people, if you can prove through performance that you can produce for them, they are with you forever. Right? So we raised in one of my companies 18 million, or raised towards 18 million for a sandstone mine. A lot of people say, look, isn't that a lot of hard work to raise 18 million? I said, I'm not trying to raise $18 million. I'm trying to raise a $1 billion retail fund. I've only got to get it right for those first retail people. They'll tell all their friends and family, make their aunts and uncles get involved in it. And then, over time, I'm hoping to do that over 8 years. We're a good 3 years into it at the moment, and we're looking pretty strong in what we're doing. So All of our licenses allow for retail, but we can do sophisticated institutional as well. We can game out your raise for whatever it is that you're trying to do through the AFSL. ACL license, a lot of you know, so ACL, we can approve you for credit lending activities. What is it you want to do? If you look at the I don't want to say the word debacle, but everything that's going on in buy now, pay later at the moment, and the massive issues that that's about to come out with ASIC. If you find a grey area with ASIC, don't take it. It's not a grey area, it's a trap, right? It will get you. Just get licensed for the thing that you're trying to do. If you're trying to capture a market and you're in a grey area, it's probably for a reason. Don't take those people. I wouldn't know many people who would want to buy the debt from some of the big buy now, pay later people. I know I sure wouldn't. So look, always go down the right route. We can do things, if you want to start lending for credit cards, if you want to do short-term or do loans for deposits for people buying houses, etc. That's what an ACL allows us to do. So we can do authorise your credit lending. Remittance license, this one's a lot of fun. So this is just the conversion of money. If you bring money from overseas, where do you want to move that to? Particularly with ours, because we can convert crypto to fiat as well. So we're getting a lot of interest for that at the moment because there's just a mecca of work in that space at the moment. So, crypto wallets, different types of investing. If you're trying to, I know that I've hit this hurdle a lot. I've got investors overseas. They say, yes, we can give you $200 million in Bitcoin. I go, well, fuck, okay, now I've got Bitcoin, what am I going to do with that? So we're building some pretty fun things for other people here. So remember, we are an RE for hire. I do use all these services in my companies, right? That's why I built this specifically for me, for my fundraising, and now it's open to the market for everyone else. This one's my favorite. I'm having so much fun with this at the moment. So I'll talk about the things that we're building for me, and then we can do the same services for any of you out there as well. We're in the process right now of putting together Australia's first digital exchange. As most of you would know, Australia is most definitely the most regulated country in the world, right? If you can get it right here, you can go and do it absolutely anywhere. We're putting together at the moment, so all of these licenses, and you may or may not know that we get reciprocal rights in different jurisdictions. So our licenses work in South Korea, Japan, New Zealand, Thailand. So it's a really, really strong license to have. Or if you're putting together credit lending or raising, get all those jurisdictions. It doesn't have to be one space. If you've got a full raft of retail PDS behind you, you're as strong as you possibly could be in that market. So we're building at the moment. It's a lot of fun. I've got most of those 22 lawyers working on this at the moment, around the clock, building this. We have the technology. We partnered with a group out of Hong Kong. Amazing technology. They're one of the first exchanges to also be listed on the NASDAQ. Their problem was they built the technology, but then didn't have all the other licenses. To launch a successful digital exchange, or even to launch one, you have to have an AFSL. If you want to get money from retail people, a retail AFSL, so that anyone who lists on your exchange can then actually go and raise money. You need to have the remittance license, and you want to be able to convert crypto, etc., backwards and forwards, and you need a digital exchange license. So there's a lot that goes into that format. So we're building that at the moment. We are hoping to be launched in New Zealand within the next 4 months or so, and then by this time next year be launched here in Australia. ASIC has a lot of guidelines around what they will accept in the digital world at the moment. It's not that they don't want it, they're just terrified of it, right? Because they're the regulator and they don't want to get it wrong. So if you're building something, build it all the way. And my one piece of advice to you is don't live in the grey. If you find a lawyer that says, look, there's a little bit of a loophole here, just get right out of that, right? Because all you're doing is kicking the can down the road for later. And the last thing that you want, if you're raising funds, is a stop order from ASIC, where you're almost there and now you've got 8 months of having to fix it. So we deal with a lot of issues. If any of you are hitting these types of issues, come and see us. We're a bit of the problem solver in that moment. But try to come to me before there's a problem. It would be much better than when there is one. Guys, that's it for me. There's about 18 seconds left. Thank you so much for listening. Feel free to come down to the stand, have a chat to any of my guys. Have a great day.
Okay. Thank you, Sean. Now we have a quick morning break. Please enjoy some coffee and snack, and then make sure to visit the booths of the speakers as well.
Attention to all attendees and exhibitors on the floor. Could we please have everybody enter the presentation hall for the next round of presentations now? Thank you. Could we please have everybody enter the presentation hall for the next round of presentations now? Thank you.
Thank you. I'll need it on for about 5 minutes. Thank you.
Attention to all attendees and exhibitors in the hall. Please enter the presentation hall for the next round of presentation now. Thank you.
Can I ask you a question? Is it coming out in those speakers or not?
It's all the way on the back as well.
Okay, good.
So I can hear it from there as well.
Oh, excellent, excellent.
And then the presentation is also for...
Yep, perfect.
Could we please have all attendees to the presentation hall and all exhibitors to the presentation hall for the next round of presentations now? Thank you.
Yeah, stay over there. We need ushers. We need ushers badly.
Could we have all exhibitors and all attendees into the presentation hall now for the next round of presentations? Thank you. All attendees, please, to the presentation hall for the next round of sessions. Thank you.
Yeah, literally. Even on that side, just say, listen, we just want everybody in the hall. Give it. Tell them to delay for like 10 minutes. Sorry? Tell them to delay for 10 minutes. People are coming in slowly. 10 minutes, 10 minutes. 5 minutes, 5 minutes.
No, it disturbs the entire thing. We do have lined up Zoom calls for the panelists.
Could we please have all attendees and exhibitors to the presentation hall for the next round of presentations and panel sessions? Thank you.
Dan's good to see you in there. Jack, I need your help. We need a round. Why is there no one in there? Yeah, we need a round. 30 that you want. 30 that you want. Just so you know, I'm just going around. We're all starting the next panel session.
Yeah, we're coming up. Thanks, Thank you.
Hi everyone, it's me again, Megan, taking you through the next set of presentations. First of all, we have Rodney Walt, Head of Private Wealth at EG Private Wealth.
Hi all, and welcome to Emergence 2022. Great to be here with you. I'm Rodney Walt, Head of Private Wealth at EG, and I look forward to sharing with you in terms of how EG helps our wholesale investors invest via a personalized approach in commercial real estate. EG is a leading independent real estate funds manager specializing in real estate. We were founded back in 2000 by the Easton and Gahar families, essentially buying yield-producing sites along new infrastructure corridors and taking them through to rezoning. Today, we manage $5.1 billion in assets under management, have a development pipeline of $3.9 billion, have an amazing track record of delivering 16.7% throughout the 20-year history, and have 112 staff split between Australia, where we're headquartered here in Sydney, and Manila. EG Private Wealth was established to help our networks in providing deal flow and access to commercial real estate opportunities. Access to our institutional processes and systems, deliver above average returns and capital security, provide a personalized aligned approach in every opportunity, and a data-driven, tech-enhanced approach to uncover opportunities to enhance investor returns. To date, in the last 18 months, EG Private Wealth has acquired $200 million in assets and delivered an unrealized IRR of 36.6%. We have a strong pipeline, and we look forward to helping our wholesale investors grow their wealth in real estate. The advantage of EG is part of the complementary services that EG is able to offer. Being a large real estate funds management group, there's a number of ways that we are able to assist our clients, be that through our institutional mandates and ability to see right across this property spectrum from core plus, value add to opportunistic, our rezoning and urban renewal programs, our technology, and of course our BRG, built-in good foundation. When I think about EG, there are a number of things that really are the three pillars of EG, being our technology, our BRG foundation, and culture. Technology. We heavily invest in technology, and we have created our own proprietary property risk management software called Prisms. This is to ensure we are unlocking opportunities for our investors while minimizing downside risk. Prisms is used to measure, price, manage various risks attached to commercial property investments. EG requires all investments to run through our Prisms model, and for me, this has been the single biggest reason why we have been able to grow and perform as well as we have over the last decade. Culture. The people at EG are critical to our success. We have created a unique culture to ensure that we attract, retain entrepreneurial team of individuals that are empowered to outperform. Our BIG, built-in good, people first places, is a unique approach to both generating outstanding returns and lasting positive social impact. Much of our success in real estate comes from thinking BIG, about opportunities to create legacy. EG Private Wealth provides investors with the rigor of 20 years supporting institutional investors with the agility and hunger of an entrepreneur. EG Private Wealth's team offers both the best of both worlds to provide those returns. Through partnership, we invest in every single deal with our investors, access to deal flow, active asset management through our property technology and our institutional processes and systems.
I thought it was really important to share with you this graph here, which is really around our deal flow and what we've been able to achieve. Because obviously what we like to think is that we're able to attract a number of off-market opportunities. So this is just a brief outline of what was it done in the past 12 months. So the number of deals that we reviewed, 29 billion, off-market transactions, 18, and pre-market opportunities, almost $1 billion. And as we funneled those all the way through, we put 21 deals into due diligence and acquired 18 properties. So in terms of private wealth, what we look here, we are sector agnostic, really focused on returns, providing our investors with good growth and capital returns. Properties across Australia, tenants of high quality and strong covenants. Looking at those assets that provide generally a cash yield of 6.5% with a total return of 10 to 15% for our investors, with multiple exits opportunities. So here we've just got a few snapshots of a couple of images of the assets that we've acquired. Feel free to come and meet with us and our team and learn more about the assets that we've acquired over the last 12 months and how we've actually acquired these assets and the value that we've added to our investors. When we think about the last quarter, the December quarter, we delivered a 9% cash return to our investors. So when I think about where and how we've actually created the value for our investors, a lot of that value has been created up front. A lot of that is created during our due diligence process in terms of how we have been able to extend the lease terms with our investors, agree capital works programs, and rentalize those returns, incentives paid to improve the face rentals, adoption of EG's proprietary risk management software, and our active asset management process. So just a little bit about the leadership team. Obviously over here you've got Adam Gahar, Dr. Michael Eason, and Dr. Shane Gahar. They are the E and G in EG. Myself, I've been with EG, I've known EG for 15 years and been investing with EG for that time. I've been with the team for 11 years. And have led the private wealth division here in Australia for the last 3 years. Sean Fleming, my good friend and colleague and partner in the private wealth business, is head of capital transactions at EG. He gets to sit across and see all deals that go into all of our institutional funds, as well as our private wealth deals. And Gemma, who leads our divisional asset management team, where a lot of the grunt work is done in terms of delivering those returns to our investors. We are pleased to be here today. Look forward to getting to know you. And please feel free to connect with us. Check out our website, eg.com.au. Connect with me on LinkedIn or drop me an email. And we'd look forward to sharing with you and finding new opportunities to address your investment criteria in investing in commercial real estate. Thank you.
Thank you so much, Rodney. Next, we have Ian Jones, Chairman, and Hamish MacDonald, Managing Director of Carbon Asset Solutions.
Hello all and welcome. A little bit about Carbon Asset Solutions. Carbon Asset Solutions is a climate technology company. We've been described by one of the world's largest software companies as a leading solution for atmospheric carbon removal. As the world heads towards net zero, it's created a multi-billion-dollar market for quality carbon credits. We hold an exclusive global licensed patented soil scanning technology from the United States Department of Agriculture. With this patent-protected, low-cost scanning technology, we were able to be first to market. Exactly a year ago, Microsoft President Brad Smith said the world needed a new carbon removal ecosystem based on stronger technology-based solutions. We're the first to do this today, and we're working closely with Microsoft on a number of fronts. Our business model generates revenue quickly and at volume. As an example, for every 100,000 hectares we scan, we make $5 million in revenue with a cost of $750,000 to do that. We're able to do this cheaply and quickly compared to any of our competitors. Ian?
Thank you, Hamish, and thank you everyone for coming. For those of you who are familiar with the TV series Billions, the hedge fund manager, Bobby Axelrod, said there are only 2 investment criteria that matter. Do they have something special? And can they be trusted to make it happen? And in the next couple of minutes, I'm going to show you why we are yes to both of those. Now, great investments are made when markets change, and we are at the edge of an amazing change at this point in time as the net zero carbon economy comes to dominate global commerce over the next decade. Emissions reduction, such as green energy, is a fairly mature sector. Atmospheric carbon removal, that is where the action is. We are laser focused on the fastest growing sector of that market, the supply of carbon credits to the emerging voluntary carbon markets, because in the next few years, almost every company everywhere in the world is going to need to buy carbon credits from this market, and controlling quality supply chains into this market is where the big money is going to be made. Trust, transparency, low cost and liquidity, these are the key differentiators in the market, and that's what we provide. We have a very simple business model. Our goal is to supply premium carbon credits to the markets faster, more cost effectively, and at a higher volume than anyone else. And I'll explain in a moment how we do this. So let's have a quick look at where we are today. Our technology is commercial ready. We're about to roll out in the next 2 months in Canada and the United States. We're building major strategic alliances with some of the biggest corporations and banks on the planet. Our technology and our business model is protected by patents and software copyright. We generate very high returns very quickly because we're by and large a software company, so we can scale very rapidly. And our global team has been launching and building technology companies through to IPO for decades, so we can pull this off. So let's have a look at what's making this market so hot. We've spent the last 2 years building a solution that is light years ahead of anything else in the market, and we're launching just as market demand is taking off. And in the past 12 months, the market realises that other solutions don't deliver net zero. And so they're looking at something that they want precision, volume, and low cost, and we deliver that. And global leaders have told us that that is the solution that they need. And this is how we do it. We have built a new global standard for the supply of carbon credits to the market. We're what is known as the industry as an MRV, a measurement, recording and verification methodology. What does that mean? Well, just to put it into context of how we approach that, if you remember when Steve Jobs announced the launch of the iPhone in 2007, he said that Apple had built an iPod, a communication device, and an internet device. But instead of building them separately, he built them all into the one system, and he changed the world. When we looked at the measurement, recording, and verification problem, we realized that people were fiddling around with the measurement and touching around on the recording. Almost nobody was touching on the verification because it was too hard. And we realized to build a game-changing solution, we need to change everything. And so that's what we've done. We've connected precision measurement. We have a global exclusive license to the world's most advanced precision measurement technology with Microsoft's recording ability and our own ISO-certified verification pathway. Each of one of those individually is a good change. Connecting them together changes everything, and that's what we've done. So let's look at the markets in which we operate and where we'll be in 4 years from today. On the supply side, we work with farmers and landholders. We read the carbon credits on their properties. By 2026, we'll have over 6.5 million hectares under our management. We sell the carbon credits to the corporate markets, particularly banks and large corporations. That 6.5 million hectares will generate in excess of $350 million worth of revenue in 4 years from now. We're integrating into some of the major global exchanges and other platforms, including, as Hamish mentioned, on the new Microsoft Global Cloud for Sustainability, which we are a key technology partner on and which will undergo a major launch from June of this year and through to COP27. Okay, quick look at our roadmap. We've been building this for 2 years. We did a first stage round last year, raised $1.2 million very quickly. This current round will allow us to expand our operations through Canada and North America. We'll have significant traction and revenues around about September, October this year. We'll do a Series A, which will expand our operations globally in Australia, Asia, UK and Europe. And by middle of next year, we'll be a globally operated company and we'll go to an IPO on an international exchange towards the end of 2023. So obviously, as investors, you want to know if you put $1 into the company, what are you going to get back and why? These are the kind of financial returns that we forecast. These have been very carefully crafted and independently analysed and verified. So essentially, $1 today buys 2.50 CAS shares, and we project that that will be worth about $65 each a share in 2026. So that means that your $1 today will be worth potentially $130 in 4 years' time. If you have a look at the writing on the bottom of the screen, we've applied to the Australian Tax Office for a early stage innovation company ruling, and depending upon your own eligibility, that means that these capital gains that we showed you could potentially be tax-free. So to the offer, as I mentioned, it's our second round. We're raising $5 million in this current round. We're looking to close off the round by 31st of March. We've currently raised about $1.2 million. We've got about $200,000, which has been recently pledged. We also received a grant from the Alberta government in Canada recently for $400,000. Now that's outside this race, but that's very nice. Thank you kindly. So what we would like to do is like you to come along to our stand and visit us and have a talk about how you can be part of the Carbon Asset Solutions framework. Thank you very much.
Yeah, thank you.
Thank you, Ian and Hamish. We now have Matt McNamara, CIO at Horizon 3 Biotech.
Hello everyone, Matt McNamara. I'd like to present the Horizon 3 Biotech Fund to you, which for you is a launchpad to the next healthcare unicorn. Standard important notice. Our purpose is to improve lives globally, and that means to solve global health problems and by applying unique human healthcare leading edge technologies, and ensure that each portfolio company has the potential to deliver a 1x return per annum of investment. And as you'll see later in this, I have delivered a greater than 20% IRR to investors in the past. There are 3 key messages that I'd like you to take on board. Firstly, diversification into the booming healthcare sector, high growth sector, does produce unicorns. Whilst unicorns are usually associated with fintech and IT, healthcare has many examples, like the 3 that I was involved in and I'll be showing you later. As we all know, where there's high returns, there is normally high volatility, thus highlighting the importance of choosing an experienced manager in such a sector. Secondly, the Horizon 3 Biotech team chooses investments that are later stage, meaning that only 2 to 4 years from that 1x per annum exit event. We're not long-term investors. As many of you know, startup companies have a 95% failure rate. Early VC companies have a 65% failure rate. Later stage VC companies have a 29% failure rate, and that's our area. Our investment strategy is to invest across the board of drugs, devices, diagnostics, and digital healthcare. And as I said, they're in leading edge companies that address global needs, and each has the potential to deliver a 1x return per annum that we invest in over a relatively short period of time. And so when we do deliver this, 70% do deliver, because we all expect a few of our investments will not deliver the 1x per annum. That will deliver a greater than 20% IRR to you, as it has in the past. So the later stage investment strategy reduces risks substantially by increasing the success rate, reducing the number of possible risks, and reducing the time to exit. In reviewing up to 500 investment opportunities per annum globally, we invest in Australian public and private companies and international private, usually private. We employ what's called the Achilles heel approach. If the prospective portfolio company can't deliver on our purpose, or doesn't have the key assets in place, or doesn't have a clear path to exit, then we will decline, resulting in about 4 carefully selected investments per annum into a portfolio of about 10. Our current portfolio highlights our late-stage strategy. Volpara Health, ASX listed, a leading AI-enabled software provider for determining breast density and risk related to breast cancer, recently reported to have 35% market share use of breast cancer detection, a SaaS product of the US market. Also developed a lung cancer detection test. Avecho, also ASX listed, their TPM, tocopherol phosphate mixture, is a mixture of vitamin E, and it's an excipient, which is the buffer inside a drug, has shown to improve many drugs' solubility, stability, and bioavailability. And just in the last year or so, they've shown incredible benefits to CBD, or cannabidiol, the non-hallucinogenic part of cannabis. And they are in clinical trials for osteoarthritis in the hand. Lumathera is a US private company, a medical device company that is at the forefront of development of photobiomodulation treatment protocols for patients with dry AMD, acute macular degeneration, is the leading cause of blindness in adults over 65. And they also are looking to treat macular edema and diabetic retinopathy. And the fourth company, US company listed on the ASX, EBR Systems, has developed an implantable system for a wireless pacemaker for the left ventricle, which has never been done before. And this is to treat heart failure with cardiac resynchronization therapy. Their proprietary WISE technology has eliminated the need for a lead to the left ventricle in treating these patients. All are revenue generating, all either EU or US FDA approved, and the 2 US companies on the right are in the middle of US clinical trials that will support their FDA application. They are also generating significant interest in the market. Thirdly, and finally, an experienced healthcare investment team with a track record of delivering is imperative if you're going to make an investment. My track record over 20 years started in the early pre-seed stage, and I say early, pre-seed, risky. So then I graduated in 2006 to a later stage investment strategy where we had high net worths, family offices, industry super funds, and the federal government through the Biomedical Translation Fund initiative invest in us. And each of these 3 companies, you can see Hardware, Avita Medical, and Saluda Medical, have gone from sub 100 million market caps to over $1 billion. And hence why these funds have delivered 22%, 24%, and 44%. Horizon 3 Biotech has assembled a highly skilled investment committee, each with decades of industry experience and networks globally. And networks is very important. So to reiterate, diversification into the booming healthcare high growth sector does produce unicorns. Secondly, the Horizon 3 biotech team choose investments that are later stage, meaning only 2 to 4 years from that 1x return per annum exit. And thirdly, an experienced healthcare investment team with a track record of delivering is imperative. Here's the details of the fund. So if you are interested in biotech investing via an evergreen wholesale unit trust, 2 and 20 and 8% preferred return structure, with potential liquidity events every time we exit a position, please come and talk to me on the other side of this booth. And also our Executive Chairman, Mike Sullivan, is in the audience over there. Mike, raise your hand. We'll be around the corner, and there's Mike's details. Thank you very much.
Fantastic, thank you, Matt. Next we have Paul Wilson, Founder and Director of Income to Wealth.
Great. Thank you very much. Good morning. My name is Paul Wilson. I'm the founder and director of the company Income to Wealth. I've been working with investors with my company for the past 20 years. I've been a passionate investment advocate for that whole time. One of the things that I've found in working with investors, I've built an extensive portfolio for myself and for my investors, is that there's a common thread. And that common thread is that at one stage or another, we're all faced with challenges that have the potential to sideline the growth of our investment portfolio. So what I identified is that there are actually these challenges that in the marketplace you've probably all recognised. The lack of cash flow, the lack of diversification, leverage and serviceability. The key question is, how do you overcome these challenges so that they don't become roadblocks? I identified that there was a key need in the marketplace for an investment pathway that helped to overcome these challenges while still providing superior returns for our investors. So at Income to Wealth, what we do is we help investors to turn their income into wealth through managed fund investments offering superior returns of 8 to 20% per annum net paid monthly. And these are fixed returns. Many of you may have heard of the term armchair investment. Have any of you not heard of the term armchair investment? Some of you, okay. Well, for those of you who haven't, armchair investment is basically this. It's an investment option which allows you to invest smarter, not harder. You basically don't have to invest your time or your energy. It's a set and forget investment strategy that allows you to receive strong, superior returns solidly month in, month out, without you having to lift a finger, because all the hard work is done for you. Commonly, it's known as passive income, what every investor is targeting. We structure our projects and our opportunities through a managed fund structure. We invest in markets with fundamental supply and demand imbalances, both in businesses and in property. So our assets are underpinned by strong history of businesses or strong property. We have exclusive opportunities and we can diversify our asset mix. Investors can choose all different types of terms. So let's look at this. Short to medium terms of 1, 2 or 4 years with a minimum investment of only $5,000, where your term, the length of your term depends on the return that you receive for your investment. So a 1-year term is 8% per annum paid monthly. 2 years, 12%, 4 years, 14%. That is our business equity fund, and it specialises in businesses that are too small for a private equity company to take over, but they're too successful for a loyal manager to get the funding to buy it off his operator. They have a unique space in the marketplace where they've got at least $750,000 EBITDA a year with a 10-year track history, and they can be run under management. We also have minimum investments of $30,000, which were underpinned more from our property fund. You can invest for a set investment term across a whole portfolio, or you can invest in specific projects which have terms between 15 to 21 months. These are fixed returns, they're not projected returns. We have a track record of paying these month in and month out. The best part is that we've structured this so there are no hidden fees. Literally every single dollar that you invest receives the stated return. And that's a unique difference to a lot of managed funds where the returns are fantastic, but then they're eroded by fees. So part of my goal is when we put this fund together and looking for, from an investor's perspective, is that they receive a net return of 8, 12, 14, 15 or 20% per annum fixed, paid monthly, like clockwork, so you can rely on it. We have impressive results. Since we started the monthly payment option in 2018, we've paid over $35 million in monthly income directly to investors. We pay on the 15th of every month without fail. Our funds have at the moment $110 million under management, and we have a 100% return of capital for all completed projects. The results speak for themselves. This is an example of one of our projects. So at the moment we're doing a $500 million master plan in New Norfolk, just outside of Tasmania, just outside of Hobart in Tasmania. Now this project was a raw block of land and we've turned into a master plan of residential, childcare, retirement living. There'll be a 100-bed hospital, a wholesale market, more commercial premises and more residential subdivisions. You can invest in a specific stage, as it's a stage subdivision, or you can invest across the development as a whole. And we'll be in this area for quite some time, giving lots of investors. This particular project returned, this was the first stage, the Mills in New Norfolk. Gateway was our first residential stage, and investors in July last year received back all of their capital, as well, which was about $20 million, as well as throughout that period they received 20% per annum paid monthly for the whole duration, which is, I think it was around 26 months. We have another project that has recently completed. It was a retirement living project. The investors weren't in there for the construction of this development, they were in there for the acquisition and the DA approval stage. Throughout that whole period of time, the investors again received 20% per annum paid monthly, and just a few weeks ago we returned 100% of the capital, the $10 million, back to the investors. So folks, if you're looking for a innovative way to invest, where it's under a regulated environment, through a proper managed fund, as a retail fund, we can accept retail or wholesale investors, then we have an investment option that literally suits every investor, regardless whether they're just starting out or whether they're a sophisticated investor wanting to get solid returns, using the money to pay down debt or to live off. Today we're also on the other side of this booth, so come and say hello to us. Booths, look us up on Facebook or give us a call the office. Our head office is based in Queensland. We're happy to be here today and we look forward to talking to you, so come along and say good day, and thank you very much for your time.
Thank you so much, Paul. Next we have Jeff Andrews, Chairman of Capricorn Power.
Good morning. Thanks for that introduction. It's interesting that many of the speakers and investors on panels have mentioned the opportunity to do well by doing good. The concept's not new, but I'd like to introduce to you an opportunity to do well by doing good, which is new. This morning, Steve Torso mentioned 3 key success factors that are actually included in this opportunity. I'd like to see if you can spot them. You already know that climate change is a huge problem, a global problem. So I'm not going to tell you about that. You're already experiencing it. You know we have to quit fossil fuels. But what you might not know is that renewables other than hydro have to go from producing 11% of our electricity to producing 73%. That's a 6.8-fold increase in generation. And we have to do that while solving the problems of intermittency, energy storage, and electrifying transport. That's a huge global challenge, but that also brings a huge opportunity. Just in equipment, generating equipment replacement, the opportunity is worth $12 trillion. But renewable energy as a service is even more lucrative at $2.5 trillion every year. So what's our solution to this global problem? We have a patent-protected engine which is able to turn heat into electricity 24 hours a day. And the main advantages of this engine over alternatives are its high efficiency and the ability to maintain that high efficiency even at small scale. So we can put the engine everywhere. Heat engines are everywhere, in cars, motorbikes, lawnmowers, ships, planes. So why invent a new one? Well, the reason is that our engine has a unique combination of features that allows us to take over that electricity market, that renewable electricity market. It's suitable for mass production, it's able to use a wide range of energy sources, and it's able to be deployed in small scales, so we can go to where the customers are and where the energy sources are. Imagine 1 megawatt of electricity in a shipping container on a customer site. We can go to where the customers are and where the energy sources are. We can also use a wide range of fuels. So this model is called distributed energy. It has many benefits, but I'll touch on 3. A higher total efficiency. What did Steve say about business gravitating towards efficiency? We're not losing energy in transmission, and we're not transporting fuel sources. Much higher resilience for the grid, and importantly, a much higher value for the electricity we sell. Because we're sitting behind the meter, we eliminate network costs, which are 2/3 of electricity costs in Australia. We can use a wide range of heat sources, in fact any heat source above 300 degrees. And here you'll see gas flares, exothermic chemical reactions, solar thermal, industrial furnaces, even internal combustion engines, but importantly, waste sources. And we've identified over 50 waste sources so far, which are not only free, but they're in sufficient volume that from just these 10 that we've quantified so far, we can supply 29% of Australia's existing electricity needs. So how does it look? This initial project with the City of Greater Geelong will divert 7,000 tonnes of green waste, which is now going to landfill. We'll convert that to char using pyrolysis. We'll take the waste heat and generate electricity. And there's even the potential to generate hydrogen directly from the pyrolysis syngas. Why now? Well, Steve mentioned timing. In business, in comedy, timing is everything. And the time is right now. We've got universal commitment by countries to reduce greenhouse gas emissions. And if that wasn't urgent enough already last year, this year we've been reminded that by wild weather that during COVID, climate change didn't go away. And the Russian invasion of Ukraine has got Europe expediting its transition away from coal and gas. We're getting increasing recognition. We were recognised as one of the top 5 food waste to energy startups from a survey that was done of 146 companies. We're also being approached by companies who come to us and say, we've been looking for a solution like yours, and yours looks like the ideal. In fact, it could be the perfect fit. Recent progress, we demonstrated our engine core machine in December, and that allowed us to satisfy the requirements of a Commonwealth Government grant through the Advanced Manufacturing Centre. In December, we were awarded a US patent, which is probably the most difficult jurisdiction in the world to get one, and that bodes well for the other applications that we've got in train. We've analysed these behind-the-meter customer applications. And while there's a range of values, many of them are above our existing cost of production of our initial unit. So Steve mentioned Wright's Law. And so Wright's Law means that our cost will reduce as we produce more units. Now, importantly, we're at the tipping point where even our first unit is economic in many customer applications. Now, so that means we're at the tipping point. Now, solar PV took 50 years to get there. So if you missed the solar PV opportunity, come and talk to us. The combinations of producing engines more quickly, larger engines, and getting our cost down mean that we outperform the typical hockey stick that you'd expect, rising to $117 million in year 4. And there's some quite conservative modelling there that we'd be happy to share with you. We've got an experienced management and engineering team and board who are well versed in commercialisation, manufacturing, and the energy sector. We're motivated by the fact that we can make a meaningful contribution to 8 of the 17 UN Sustainable Development Goals. So in summary, what I've described is there's a large, urgent problem in attacking climate change. We have a solution, the unique, patented Barton engine. There are abundant energy sources, and there are thousands of high-value applications which are below our cost of manufacture. So we can have profitable engine sales and projects. You can do well by doing good. The investment opportunity is $2 million on an $18 million pre-money valuation. We're also just on the other side of this wall, so please come and ask your questions, give us suggestions. Look forward to talking with you. Thank you.
Thank you so much, Jeff. Next, we have Rob Santarello, Senior Manager and Corporate Development at Pioneer Credit.
Thank you for the intro, and thank you for stealing my first line. Firstly, I'd just like to say congratulations to the team at Wholesale Investor for putting on such a great event and for giving me the opportunity to talk today. My name is Rob Santarello, Senior Manager of Corporate Development at Pioneer Credit. Today I'll be providing you all with an overview of who Pioneer Credit is, what do we do, why are we different, and what the future holds in store for us. So Pioneer is a Perth-based company. Yes, I know I managed to escape 700 days later. The company started 13 years ago, and it is now ASX listed and has over 400 employees. Now, the Pioneer business model is pretty simple. Pioneer buys portfolios of customers who are experiencing financial difficulty, specifically from quality vendors, such as the Big Four Australian banks. By building genuine relationships with each individual customer, we support them to pay down their debt and become debt-free. We do this by using an empathetical, ethical, human touch. The customer's portfolios are purchased in tranches that we call PDPs, or purchase debt portfolios. And our business model relies on generating returns from these so-called PDPs through our differentiated customer service approach and by reducing our margins. Pioneer typically targets a return multiple of 2.4 times on its investment. And today, I'd like to pleasingly tell you all that we have just upgraded our FY22 guidance. We're expecting liquidations of well over 110 million and an EBITDA in excess of $64 million for FY22, which is pretty awesome. So what makes Pioneer different? Pioneer is in a great position at the moment, with lots of opportunity out there in the market. Pioneer is now one of the top 2 Australian players in New Zealand and Australia, and prides itself on its strong vendor relationships. With high barriers to entry and tightening governance, the market is starting to consolidate, which is putting Pioneer in a perfect position. Pioneer has strong downside protection. We have a strong asset on our balance sheet, our PDP portfolio, which generates steady streams of income. We have always been, and will always continue to be, extremely disciplined in the way we price. Simply put, we will not purchase a portfolio if we think we can't make a return. Through our ongoing initiatives, we are on track to become more efficient and reduce our costs in the coming years. At number 7, Pioneer has a strong risk and compliance track record. And this has helped us extremely well with our strong vendor relationships. Number 8 is an extremely important one to us. We pride ourselves on our customer-centric approach. Buzzword, but simply put, we try to do the best thing for our customers. We want to get to know them on a personal level. We want to understand their unique situation. From there, we can tailor a solution to help them become debt-free. And finally, Pioneer has a great management team who are committed to the cause, our values and our beliefs, and have extensive knowledge. Now on to our performance. So Pioneer has had an exceptional first half FY22 performance, especially given the current economic climate. So during the first half of 22, pleasingly, Pioneer was able to refinance its senior debt facility for $200 million at significantly lower costs. So what that does for our business is reduce our interest margins. We're also able to refinance our medium-term note and increase it to $60 million. This is further setting up Pioneer for the future. Number 2, during the half, we were able to grow liquidations by 9% and managed to drive value from our back book from older customer accounts. Number 3, we're able to grow our performing arrangement book, also known as our PA portfolio, our performing portfolio, to just over $400 million. Pioneer's PA portfolio provides a sustainable, reoccurring income stream for Pioneer on a monthly basis. We also were able to submit our application to become B Corp certified. Now this will hopefully open up doors for us in the future and further lead us to lower funding costs. And Pioneer continued to focus on its digital strategy. This will ultimately improve our customers' experience, improve liquidation, and reduce our costs. Now on to Pioneer's actual portfolio itself, the assets sitting on our balance sheet. Pioneer has a PDP portfolio of $1.9 billion. And this is made up over 225,000 customers across Australia and New Zealand. So essentially, the $1.9 billion is what customers owe Pioneer to date. These portfolios were differentiated by the makeup of these customers. They're predominantly banking and finance customers, with 86% originating from Australian banks. Per the pie chart up on the right there, my right, your left, we currently have $400 million in PAs, with the remaining 1.5 in our WIP portfolio. So generally, on a month-to-month basis, 50% of our liquidations come from the PA portfolio. So that's customers on payment plans, regular payment plans. and 50% of liquidations come from the WIP portfolio. So that's from customers making one-off payments. So diving into this PA, or performing arrangement portfolio, one step further, to let you know why it actually is so vital to Pioneer. So Pioneer's PA portfolio has grown 6% in FY22, like I said, to exceed $400 million. It is also made up of quality customer accounts, with 91% originating from Australian banks. We do not buy any payday lending customers. The PA portfolio is vital to Pioneer as it provides a sustainable, growing and recurring income stream. With it only making up 16% of Pioneer's total PDP portfolio, we still have ample opportunity. And to just wrap up quickly, what does the future look for us? Well, we'll continue to capitalize on growth in the future. We'll continue to grow this PA portfolio. We'll continue to maintain our strong relationships and compliance framework. And we'll finally continue to invest in digital, analytics, and data management to reduce costs and ultimately increase liquidations. Thank you all so much for your time. And if you have any questions, please feel free to reach out.
Thank you so much, Rob. Next, we have Aidan Howarth, Capital Business Manager of Liebke Co.
Good morning, ladies and gentlemen. Thank you for your time. Great to be here. My name is Aidan. I'm from Liebke Co Capital. Today, I'm going to be presenting our latest opportunity called the ACT Townhouse Development Fund. But before I begin, I'd just like to thank Steve Torso and the whole team at Wholesale Investor for putting on such an amazing event, as I'm sure you'd all agree. So to begin with, who is Liebke Co? Liebke Co are a Canberra-based organisation with 4 key areas of our business being property development, funds management, equities and holdings. I represent the capital business along with the co-founders Rowan Liebke and Jesse Zammit. So straight on to the project that I'm presenting. This project is called Bethany. Bethany is a set of 10 beautifully designed, architecturally designed townhouses in the inner north suburb of Canberra called Lyneham. Lyneham is about 2.5 kilometres from the CBD, if you know Canberra at all. The gross realisation is 17.44 million based on independent valuation. They sell for between about $1.6 and $1.8 million each. We've got a mixture of 2, 3 and 4 bedrooms. Basically, the key point here is we're designing something that is specific to the end buyer. Being owner-occupiers. We're not building in the mortgage belt, not developing in areas where we're targeting first home buyers or investors. This is specifically for working professionals or downsizers in this area. Okay, don't know if you can see on your screen there, but just to give you a bit of a picture of where the site is located. Lyneham, as I said, it's about 2.5 kilometres from the CBD. It's quite close to Northbourne Avenue, which is a main northern arterial road that heads into the CBD. About 2 kilometres from Braddon, cafes and restaurants and so forth. You can see the city there and Parliament House. It's about 2.5 kilometres from there. Close to ANU, very close to the light rail. There's a close-up of the shot. This is basically an amalgamation of 3 blocks, old properties which we're going to demolish and put up the 10 townhouses. You can see some precedent there either side for townhouse development already. Okay, why Canberra? So essentially Liebke Co is a Canberra-based organisation. We've been developing property in the Canberra market for many, many years. We know the market very, very well. In fact, Bethany is really part of a broader strategy that we employ called the Inner City Gentrification Strategy, which is basically where we redevelop sites from between 1 and 3 kilometres from the CBD. You might know that Canberra is underpinned by some of the by government employment. As we know, it's one of the main employers in the area, in the city, and that really that means per capita, it's some of the highest wages in the country. Now we've seen that really play out as the Canberra market has done extremely well over the last year or two in terms of capital growth. We've done 25.5% capital growth over the last year, with the median house price now higher than Melbourne. So just to introduce you to the project team, Liebke Co Developments are the development manager on this project. We've worked with Cox Architects, Hive Property, our local marketing sales agent, Knight Frank, independent valuers, and independent quantity surveyors, Mitch Brantman. Now over to the fund team. So Liebke Co Capital has created a strategic partnership with some excellent firms to bring this product to the market. Starting with Hall & Wilcox, they're our legal and tax advisory team, headed up by Harry New, who's from the Financial Services Division out of Melbourne. We have an independent wholesale trustee. That firm is called Polar 993. They're Melbourne-based. That's run by a gentleman called Adam Lindell, who's quite well known in the space. He was a co-founder of Genex Capital. We have independent fund administrators, TMF Group, and the fund will be audited by Ernst & Young. Okay, as you can see here on the screen, this gives a bit of detail about how the fund is structured and how all the different parties basically operate with the fund. So to begin with, the fund is in the middle. It's a wholesale unit trust. The unit trust, or the fund, owns 100% of the shares in the underlying special purpose vehicle, which owns the property. Investors invest by purchasing units in the fund. Now there's two classes of units. There's preferred units and there's ordinary units. Investors will purchase preferred units, and that will make up about 80% of the raise, and Liebke Co will co-invest by purchasing ordinary units, and I'll get to the difference in a moment. You can also see there that Polar is our external trustee. We've got TMF Group as the administrators. Liebke Co Developments are the development manager, not the builder. We're going to engage an external builder on a fixed price build contract. Liebke Co Capital is the investment manager of the fund, and we're a corporate authorised representative under Polar's AFSL. Okay, key dates. The land settles May 29. So we're looking at having all the funds in by early May in preparation for that. The build time frame is going to be about 12 to 14 months, and we're expecting distributions to come back to investors around December 2023. So what we're looking to raise is $4.15 million in preferred units from investors, and as mentioned, Liebke Co will co-invest into the fund by around about $1 million of our own funds in ordinary units. We're offering a 14% per annum preferred return to the investors. Now, over a 20-month term, that's a 23% return. That's net of all fees. Minimum investment of $100,000, and of course it's for wholesale and sophisticated investors only. Okay, so why invest? 14% preferred return is a very strong return, particularly in property development. Now, I just need to, I guess, underline the difference with the preferred structure. You might have heard of preferred equity. It works quite similar. Basically, you as an investor must receive back your capital and returns before Liebke Co receives our capital and returns. So essentially, our money in the deal is in the first loss position, not the investors. Okay, why else? This is a rapidly growing market in the inner north suburb of Canberra. There's a substantial co-invest, as you can see, 20% from Liebke Co, so we really have a lot of skin in the game. We're a very, very experienced Canberra-based development team, born and bred there, doing a lot of projects outside of the one that you can see on your screen. Really know this market very, very well. Our team in aggregate have delivered over $750 million worth of residential developments in the ACT. Also a very experienced fund team with great governance, etc. And really strong deal numbers. So it's about 28 to 29% profit on cost when you use the independent valuation numbers. And all of that is basically essentially providing downside risk protection to the investor. Okay. Well, thank you very much. I'm just about out of time. If you want to come and see me, we're the first out the door on the right. I'd love to have a chat with you. We're on the Crisp Deal Room, or my contact details you can see on the screen there. Give me a call, send me an email, or connect on LinkedIn. Thanks very much for your time.
Brilliant. Thank you, Aidan. Next up is Marcus Lassero, co-founder of CashD.
Hi, good afternoon. I'm Marcus from Cashed. I'm the CEO and co-founder. If you're a worker and you earn any sort of money or income, regardless, absolutely regardless of your employee status, you could be a full-time, part-time, casual, contractor, a flexible worker. There's absolutely no justification why you don't get full access to that cash immediately. Why don't you have the ability to click a button and have access to that cash immediately? So cash is redefining pay by enabling businesses to empower their workers to choose how and when they get paid. Very common knowledge, and I won't go into the problems in too much detail, but we all know that on average each employee lives paycheck to paycheck. But what's important to note, which is quite startling, is that there are 356,000 payday loans that are taken out each year in Australia. High interest rates. And that's not to say that there could be cash advances on credit cards. There could be, personal loans, personal secured loans. 356 on average payday loans taken out in Australia. But the real problem, which is not mentioned there, is these antiquated old school thinking of payday cycles or payroll cycles. Whether they're weekly, whether they're fortnightly, whether they're monthly. What are these? And why do they exist? In fact, they're man-made. So if you earn money today, you should most certainly have access to it. And the problem, in my opinion, are payday cycles. Yes, all this rhetoric about financial stress, payday loans, cash advances on your credit card. The real problem lies in the fact that payday cycles are antiquated and they need to be adjusted in some form. So that brings me to the solution, or part of the solution, what is cashed? And probably more importantly, what is cashed not? So we're not alone, that's for certain. There's no direct debits. There's no security required when you withdraw your hard-earned money. There's most certainly no position that you'll be in where there's a credit default. And most importantly, from a cash perspective, is that the point of difference for us is we're a B2B solution. What does that mean? That means we contract directly with the employer and not the consumer. So we're not a B2C solution, we're strictly B2B. That means we integrate directly with the employer through their solutions, which I'll go through shortly. So the solution is very simple. Very simple. Integrate with your employer's payroll system, workforce management solution system, or HR solution. It's not a difficult concept. Yet in Australia there are hundreds, if not somewhat close to thousands of payroll solutions in Australia. And if we gauge the instant connection through payroll, that may manage the payroll cycles, but it doesn't necessarily account for time, which are your workforce management solutions or your HR solutions. So if cashed were to integrate with an employer's workforce management, payroll, or HR solution, we can most certainly understand the employee's cycle within that business and provide them with instant payment. Part of Cash proprietary technology is most certainly our ability to get paid back. So having those integrations gives us the ability to drive what is known as an automated deduction file process back into payroll. That means we're receiving the capital sum that we've outlaid back in real time. So the solution for Cashed is a real-time payments platform that integrates directly into the solutions of an employer and our ability to then drive that money back through an automated deduction file process. So what does the employee get? Well, they get the slick, very slick, easy to use navigation application, whether it's on the Apple iTunes App Store or the Google Play Store, and they can download this application, and it's easy to use. But again, it's powered through an invitation from the employer, which then gets received by the employee to download the application. What does the employer receive? So the employer receives a very slick engine, which enables them to control security limits, the limits as granular as what an employee can withdraw on a daily basis. So the system includes a lot of, call it, safety and security controls for the employer to allow them the ability to withdraw funds within their means. From a milestone perspective, it's very important to understand that we are B2B, which means that our contracted parties are the employer, as well as the, in our instance, channel partners, which is very exciting for us. Channel partners may have hundreds, if not thousands, of employers. So Cashed contracted party are the employers and channel partners. From a legal standpoint, we govern by AUSTRAC with an AML and CTF policy. From a digital exchange perspective, with regard to real-time payments, we're working with the latest technologies like OSCO, if you've heard of that. And naturally, we have a lot of API integrations with numerous payroll or workforce or HR solutions. But to date, our biggest challenge was securing a channel partner agreement that was sound, legal, and that was deliverable to these channel partners who hold relationships with thousands of employers. To date, we've had a lot of success with regard to certain, call it, industry segments. Those include contract management companies, soft serve companies, and as I just mentioned, channel partners. Contract management companies are interesting. They labor hire type businesses who deploy workers to multiple sites, whether it's warehouse, contract warehouse drivers. Soft serve companies may include nurses, carers, security guards. Channel partners are very interesting. If we were to have a top-down approach with some of the biggest payroll providers in Australia, that would include the likes of Reckon, Pay Group, some of the SAP implementation partners, and that opens the door to hundreds, if not thousands, of employers. So to date, we've had very successful market adoption from contract management companies who, again, supply labor hire, soft serve companies in the way of nurses, carers, security guards, etc., and channel partners who open the door to full-time, part-time, casual workers, contractors, even flexible workers. I would say our competitive advantage most certainly is the ability for us to have a variable fee structure to our employers. That means we give full control to our employers to manage their employees. If an employee were to use the Cashed application and they were to withdraw, as an example, $100, the employer would have certain controls over that. They could, for instance, make an available balance of 50% as opposed to 25% or 75%. The ability for us to white label the solution is also very important, meaning there's some big enterprise clients that may not want to see the Cashed on-demand pay or early wage access application, so we're more than happy to white label that solution for our customers. And in Australia, I'm being told to slow down, fast, time's up. So with regard to our metrics, I'm nearly finished. I'll go through this quickly. We've identified our metrics. For every 100 employees that we invite to our application, we get a minimum of 9 to 10% acquisition rate, which is phenomenal. The average withdrawal is $123 per withdrawal, which is 3.7 times a month. That is insane. Noting that people are avoiding payday lenders, they're avoiding cash advances on their credit card. Those statistics are real, and we've worked very hard to claim that through the adoption process. With regard to our roadmap, employee engagement is very important. Once an employee or worker withdraws funds directly into their bank account, they also have the ability to use their accrued wallet to pay bills. They may use their accrued wallet to drive funds directly into, say, crypto. They may use our debit card, whether virtual or physical, to tap away. And this is money that's been earned but not yet paid. So that debit card is quite a unique feature. So we're going through phase 1, 2, and 3, nearly done. Phase 1, 2, and 3, early wage access, is phase 1, where the adoption is very simple. You click a button and the money appears directly into your bank account. Phase 2 is more about employee engagement, where I've just discussed, you'll get a debit card. You can perhaps use your accrued wallet to convert your income into crypto. You may use your accrued wallet to pay bills. Or you may just use our budgeting or financial wellness tool. Phase 3, why not just pay human capital through early wage access? Why not pay all your company bills? I mean, that makes perfect sense. If you've got adoption through early wage access for human capital, pay your trade creditors, pay your accountants, pay your legal services. That would make perfect sense as well. So we've got a full team. Please visit our website, cash.com.au. And we're looking for $2.5 million in debt/equity at a 15 million valuation. Thank you very much.
Thank you. Next, we have Michael Baker, CEO and Managing Director of Arovella Therapeutics, ASX ALA.
Thanks very much, everybody. Thanks very much to Steve and the group for putting on this lovely event, and thank you, everybody, for your time here today. And I'm looking forward to telling you about our company, Arovella Therapeutics. We're a biotechnology company. We are listed. Our ticker on the Australian Stock Exchange is ALA. And I'll skip over the disclaimer. And I just wanted to talk about some of the metrics of our company before we go into the technology. So we're currently valued at 24 million with an EV of just over 15. So we don't think that adequately reflects the technologies that we have in the company and the team that we've recently managed to build out. As of December 30 last year, we had $8.8 million cash in the bank, including the proceeds from a placement, but not including the $2 million for an SPP that we're currently closing this week. In conjunction with that placement, we had a very well-known and excellent investor, Merchant, join the register. They have had a number of good wins in biotechnology, so again, lovely to have them at the top end. And we do have a number of high net worths and also small institutional investors that understand an investment in the biotechnology space. But of course, we're always looking to welcome additional investors that understand the risks and the potential rewards that come with an investment in biotechnology companies. So what is it that we focus on? And in a word, it is cancer. And I think you'd look around the room and everybody has been affected by this in some way or another. And the reason is because it is still so prevalent, with 19.3 million cases in 2020, around 10 million deaths. And what we know from the technologies that we're developing, they're called biologics. The market is enormous at $143 billion projected by 2026. And more specifically, we focus on a type of treatment that's called a cell therapy. And more recently, there's now 6 approved what are called CAR T, and T cells are a specific subset of immune cells, and they have been approved to treat blood cancers. And so looking over onto the right-hand side there, this is a series of articles that were published in February where some of the patients that took these types of therapies 10 years ago when they were in their experimental phase are still cancer-free. So we are at an exciting time. These types of therapies have heralded in a new era of how we think about cancer treatment because we're starting to use the word cure. So just to take you through as I mentioned, the therapies that are already approved, they're called CAR-T because they use T cells. And our big point of differentiation is we use iNKT cells. They are already a naturally occurring subset of our immune system, but we know that there are a host of advantages that I'd like to walk through in a moment. So the way this type of therapy works, that step one is we actually collect blood. In the cases currently, it's from the patient. So you actually have to take the material from the person that's got cancer. You then take their immune cells. We genetically reprogram them at step 2. So they have something called a CAR on their surface, and that's indicated by the little red dots. They actually serve to seek out and destroy the cancer once they're given to the patient. Those cells are grown up into many more numbers, and then they're given to the particular patient that has the cancer. Currently, the workflow for all of the approved therapies is that we must start from the patient. For our cells, the iNKT cells, they don't cause what's called graft versus host disease, so we can actually give them from a healthy person to a patient. So we know that we can use our product we call off the shelf, start from a healthy donor, create the therapy, freeze it down so it's ready for use as and when needed for eligible cancer patients. We also know that they're one of the most potent immune cells, so they work very, very effectively. For tumours that produce something that's called CD1D on their surface, they also work better than the conventional T-cell therapies, and they activate other components of the immune system. So again, what we're hoping for when we develop this product is a better performing treatment and will be more cost effective and have the ability to be rolled out at scale. So in terms of the cell therapy market itself, it has and it continues to generate an enormous amount of activity. I won't go through all the strategic acquisitions and partnerships on the first table there in blue, but there have been some double-digit billion-dollar transactions in the space, and continuing through 2021, we saw a number of billion-dollar but also high hundreds of millions of dollar strategic partnerships and collaborations. And on the other table in red, we see that there's actually a number of key capital raises that took place last year. Again, it just signifies the investment that we're seeing still in the space, and they're all from 2021. And why we're seeing that is, again, going back to what I said before, these are the types of therapies that have ushered in a new era, and we are seeing really impressive outputs in terms of cure. And in terms of the global cell and gene therapy market itself, it's expected to reach double-digit billions by 2026. So as I said, all the approved therapies to date, they're T cells or another type of cell, and there are hundreds of companies, hundreds of clinical trials, so it's very crowded and very competitive. For us, we work on the iNKT cells. There are 4 companies only, and we're one of them. And in the last 6 to 9 months, all of these companies have had significant commercial transactions. The first on the left is Apia Bio. They had a strategic partnership with Kite, valued at $875 million after raising $52 million in their Series A. I should point out, Apia haven't got their product in humans yet. They're expecting that to happen at the end of 2023. Cure, who are very early stage phase 1, so they have started to dose their humans with their technology. They were acquired for $185 million total deal value. And Mink Therapeutics, also early phase 1. They raised $42 million on the NASDAQ and currently valued at about $100 million. So for Arovella, our company, we had 2 significant milestones for the company. We licensed in a technology, our platform, from Imperial College London in the middle of last year. That's a top 10 university worldwide. And we also acquired another technology that will combine with that platform from what is one of the world's best cancer centers in the US, the MD Anderson Cancer Center. So we see our valuation at $24 million, and relative to our peers, we just see that there's a lot of opportunity for growth. So in terms of our pipeline, we have 2 major programs in the cell therapy space. The first up the top in blue is ALLO-101. We're developing that for the treatment of a form of blood cancer that produces what we call CD19. That, as I said, that's in conjunction with Imperial College London. And ALLO-104 for the treatment of multiple myeloma, and that's the technology we acquired from MD Anderson Cancer Center. So the key next step for both is to drive these as quickly as we can into clinical trials, so we're testing them in humans. We also have another platform called the Orbis platform, where we take drugs and convert them from solid dose into oral spray. And our lead product on that front is called Zolpimist for the treatment of short-term insomnia. And that we're expecting to hit the shelves in calendar year 2022 through our partners Starter and Teva. So really equally important to a biotechnology company, we've already acquired world-class assets, but the key next step is the team. And we've got an outstanding team. Our chairman, Paul Hopper, is very well known in the biotechnology space. Myself, I have a PhD in biochemistry before moving into drug development and then into venture investing before joining Arovella. And the next 4 individuals are all recruited in the last 6 months, all US-based, again, because that's where the top quality is located. Dr. Deborah Barton joined as a non-exec director, and she is the chief medical officer of a company called Arovella Therapeutics, who recently entered into a strategic partnership with Moderna, which I'm sure everybody would be familiar with, for a $45 million upfront payment and undisclosed milestones. And Dr. Liz Stoner, she's formerly an assistant professor at Cornell University, again, one of the US's best universities. She's now the executive partner of MPM Capital, a biotechnology-focused venture capital fund in the US. And Dr. Sandy Buchanan is our VP of manufacturing and quality. She has 20 years experience in manufacturing these therapies, which is absolutely critical to their success. And Dr. Minnie Bharathan, who joined to drive these programs from where they are now currently into clinic. So I'd just like to stop there and say thank you everybody very much again for your attention. It's great to see a lot of people out and about again, and please feel free to come over. I'd be happy to take you through our science and how we think we're going to have a huge impact in the space of cancer. Thank you very much.
Thank you so much, Michael. Next, we have Michael Graham, CEO and co-founder of Mercurien.
Good afternoon, ladies and gentlemen. Mercurien's purpose in life, reason for being, the mission is to protect people and assets in the mobile workplace. With around 75% of people now not needing a desk, they use cars, mobile phones. The whole game's changed, as you know. What's important here is a platform that's a new model for mobility and risk management. 46% of all workplace injuries in Australia involve motor vehicles at a cost of around $9 billion recurring in terms of long tail, rehab and medical costs. We do 2 things. We provide fleet as a service and we provide commercial motor insurance. You can get this deck in the deal room, so I'm not going to go through the whole thing line by line. We funded $4.25 million of motor vehicles so far, and our monthly run rate is about $250,000 now. That's recurring and growing at about $30,000 a month. We're cash flow positive, and that's a good thing for me to be because it's been a long time. One other thing on that slide is Simon Bruce-Weston is our chairman. He's a very experienced financial services executive, ex-Commonwealth Bank, Sovereign Life in New Zealand, CBA in Indonesia, and knows his way around the financial services world very, very well. So what we've done is to find our mission as people and assets and their protection in the mobile workplace. Really, it's about a safety-focused ecosystem for work. If you've ever seen what goes on in a motor vehicle accident, I like to call them crashes, it's not great. If you're a highway policeman, like a Victorian Highway Patrol friend of mine, you can only do 4 years, because after that the PTSD gets you. It's not fun. So, here is the real problem. Motor vehicle fleet management companies are doing exactly the same thing that they did 30 years ago. There's no technology in their cars, they don't change the product, and they treat the customer basically with disdain. So they're doing the same old stuff all the time. We saw a company with $120 million worth of cars and the master contracts had expired. That's an ASX top 20 listed business. And then you've got 40% of this stuff, 46% of these injuries come from motor vehicles. It's a problem worth solving, right? So, fleet as a service. It's a fleet ecosystem. It unlocks safety, compliance and savings. We do things like fuel tax, fringe benefits tax, Saving money on not crashing cars is really big when you've got a $5,000 or even a $10,000 excess. It's serious dollars involved. The traditional fleet management business, I won't name names, you know them, they do these sort of things. They've got a bit of administration software, they've got some fuel cards and accounting, and they kind of, off you go. We take a much more nose-to-tail approach. Is this vehicle fit for purpose? We work with the NDIS. You cannot put a person in a wheelchair into a RAV4. Right? I've seen it. They buy the wrong car for 4 people in a house in Taree, and they go, well, that's a problem. Doesn't make sense. We do all sorts of fun stuff. We've got the comprehensive insurance. We measure acceleration, braking, cornering, duration of trip, and speed against speed zones in per second increments. We identify the drivers who need to be coached, and we coach them. We've seen people with a fleet of 150 vehicles. We pulled the data on the top 10, on the bottom 10 drivers. 6 out of the 10 had lost their licenses. They were driving a branded motor vehicle at work without a license. Do you know what happens to the directors of that company when that guy kills someone? They go to jail. There's now corporate manslaughter in this country, and no one seems to be paying attention to it. Lastly, it's the disposal. Our terms are 4 years or 5 years or 6 years. There's no inertial leases. There's no make good at the end of the trip. Sorry, at the end of the lease. So it's a very clear and transparent opportunity. Lots of benefits to clients. They save a lot of money. We recently gave or retrieved $780,000 from the tax office on behalf of a building products company for fuel tax credit. I'm one of those boring, nerdy guys. I've actually read the law. I understand it better than the indirect tax people that sit in the companies themselves. And it actively optimises. What's the best vehicle for this job? How do you turn it into something that's a good experience for the drivers? We make money in 5 ways. We do consulting services, fuel tax credits, we get commissions on insurances, about $600 per vehicle per year in safety and management and utilisation fees, and ultimately fleet as a service where we buy the vehicle and provide it to the customer. They pay us a fixed fee per month and a cents per kilometre charge. It maps to clients' ESG needs. I won't go through the detail of that, but 20%, we get around about a 21% reduction in emissions. Because when you drive a car in moderate fashion, you save petrol. Right? There's better decision making for the business. Employee safety is massive. The director's responsibilities and liabilities are going up and up all the time. It's a very data-driven business. There's no disputes about utilisation because we can just pull the data. Works well. Is it worth bothering about? This is all good, but how big is the market? So this is just Australia. 1.658 million cars in the identifiable market. That's light commercials and below. So think i30s, Camrys, Hiluxes, tool of trade type vehicles. We go to market through channels, partners, people who are fleet consultants, tax consultants, KPMG and EY and those guys. It saves us having a headcount heavy business. I want low headcount, high tech count. That's how you get scalability and operating leverage. We're raising between 3 and 5 million. The difference is the bottom 2 million is for credit enhancement because the banks won't lend you 100% against cars in some instances. If you're ASX top 20, they'll lend you 100% because of the credit of the client, but we want some money to be able to put in there with the skin in the game with the bank too. That's us. We're all about this one thing, protecting people and assets in the mobile workplace. Thank you.
Thank you so much, Michael. Next, we have Ting Guang, CEO and co-founder of Coinstash.
Hi, good afternoon, everyone. My name is Ting, CEO and co-founder of Coinstash. We're building Australia's first crypto bank. So some of you may wonder, what is a crypto bank? Well, let me get started with this. So we're now in 2022. Nearly all of us have heard of cryptocurrencies. Some of us have traded cryptocurrencies. But how much does cryptocurrencies has really changed our day-to-day lives? I think the truth is, cryptocurrencies are still being used as a speculative asset, and few of us have unlocked the real benefits of crypto. And Coinstash is here to change that. At Coinstash, the question that we often ask ourselves is that it has been nearly a decade since Satoshi's Bitcoin white paper. And yet when people talk about Bitcoin, they still think about the speculative aspect of it. So the problem here that we have identified is not many people are using cryptocurrencies for its intended purpose, and that is bringing financial benefits to its users. The solution that we have, by creating Australia's first crypto bank, we want to be the pioneer in unlocking financial benefits in cryptocurrency to the Australian community. To this end, we have 3 key products that's coming out, which is the earn, the borrow, and the spend. More on this later. The timing is also very important for every product that's coming to the market. And I'm happy to say that for us, the timing is perfect right now. So we have all heard of buzzwords such as the metaverse, also Web 3.0. I think Steve this morning was talking about that as well. We even have an NFT gallery here at the Emergence. So what does this all represent to us? To me, it shows there's a fundamental shift in people's mindset from moving away from the speculative aspect of cryptocurrency into having cryptocurrency and blockchain technology to embed into the way that we operate, into our daily lives. If that all sounds a bit too airy-fairy to you, I would like you to meet Matt. So Matt is a millennial that has been with a number of banks since his teenage years. He has been with the traditional Big Four banks, as well as some of the newer challenger banks that's been popping up in the recent years. The difficulty that Matt has is these days he can't really earn anything meaningful on his savings, which is a real bummer to him. At Coinstash, Matt can earn 6% per annum on his Australian dollars. He can borrow money based on his assets, not on his pay slips or credit scores. And the beauty is he can transact instantly anywhere in the world with little or no transaction fees, thanks to the power of cryptocurrency. Matt does not miss his old bank. So why is Coinstash so uniquely positioned to deliver this vision to the market? Well, we have a track record behind us. Coinstash has been around since 2019, and we already have a fully functional, state-of-the-art, completely developed in-house exchange product. We built our exchange product with one thing in mind, that is having a user-friendly platform with the ability to scale. So to this end, we have created a platform with automatic purchase features. We have more than 340 cryptocurrency assets for people to choose from. And recently, this year, we've also released our new mobile applications. Our future products speak by themselves. With Coinstash Earn, you can earn up to 8% per annum on your cryptocurrency holdings. And this is not just another staking product. You can actually start earning a rate of return on non-stakeable tokens such as Bitcoin, as example. Also Ethereum, and you can also start earning on your USD stablecoins and also your AUD stablecoins. With Coinstash Borrow, what that allows you to do is you can borrow against your crypto holdings as collateral. So why would people want to do that? Some of us may have accumulated a lot of wealth through cryptocurrency, but we don't really want to sell cryptocurrencies because the value is still going up. So what you can do is collateralize your cryptocurrency on one side and then get some early liquidity out of it. That's some early access to wealth. With Coinstash Spend, what we're looking to do is having a Coinstash card out there for people to spend their money anywhere in the world. Now that's innovative. Why do we know our products are attractive? Because we have asked our customers. So during a survey we did back last year, 95% of our customers, they wanted the Earn product. And to this end, I'm happy to announce that as of today, Coinstash Earn is very close to be released to the market. Just some numbers for you. I wouldn't bore you too much with these numbers, but right now we're earning just over 1% from our exchange product. And this is only a one-off transactional commission based on our total volume. In the future, once we release the Coinstash Earn product, what we're looking at is about a 2% net interest margin and that's annual recurring revenue. In Australia, currently we have about 10 billion. If you look at the market as a whole, there's about $10 billion asset under management in cryptocurrencies, and that number is growing year on year at an exponential rate. I'm very proud about our traction to date. As you can see, since FY21, our new signups, total customers, total volume traded, and annual revenue have all grown exponentially. I really want to highlight the total number of customers. We have been growing at 15% month on month for the past 12 months. Now, that's not something that's easy to achieve. Just to shed a bit of light on this as well, if we continue this growth rate for the next 24 months, we'll reach 300,000 customers, about 100 million in annual recurring revenue, and maybe a $1 billion valuation, just if that trajectory continues. We're also very aware of the competitive landscape out there. I guess what we're currently seeing is there's a lot of international players who are playing into the crypto banking space. Some of us may be familiar with obviously Coinbase, Crypto.com, and Celsius. I guess where we're currently positioned in the market is we want to bring in a local, safe, and regulated solution for Australians. To this end, we have already acquired a wholesale AFSL, and we're on our journey to convert that into a retail AFSL. About the Australian market, one thing I want to highlight is the market, there's actually a lot of tailwind behind this market. So I think Steve mentioned earlier, the rising tide lifts all boats. Right now, we're seeing about an 88% growth year on year in the forecast in the next year alone. And as you can see, the current exchange market is about $100 million in terms of commission fees charged. But then on top of that, all of our crypto banking products is at a number of multiples on top of that exchange product. So our team, we have a team of enthusiastic and passionate individuals who are not just interested in cryptocurrency, but they also very believe in our vision, which is to financially empower our clients by building the bridge between the traditional financial services and the world of crypto. I myself, my background is banking and finance. My business partner is leading the product team. His background is in tech. We also have a compliance manager and also AFSL responsible manager. Some numbers, we're using our fund. We're raising $2 million, and we're using that for gearing up for Series A, used across growth, product, and compliance. I'm at the end of my presentation, but I just want to wrap this up by saying that at Coinstash, we started as a humble exchange, but we're on a mission to build something big. By building Australia's first crypto bank, we want to play an instrumental role in being part of this next financial revolution that's enabled by blockchain technology and cryptocurrency. Once again, my name is Ting. If you want to reach out to me, my email is ting@coinstash.com.au. Thank you.
Thank you, Ting. Okay, everyone, we now have a lunch break. So please make sure that you visit the booths that were of interest to you, have some good conversations, and we'll see you after the break for one of our keynote speakers, Alicia Lykos.
Attention to all the attendees in the hall. Could we please start heading into the presentation room for the next round of presentations? Thank you. Attention to all attendees. Could we please start making our way to the presentation hall for the next round of presentations and a keynote from Alicia Lycos. All attendees, could we please start making our way to the presentation hall for the next keynote speaker and round of presentations? Thank you. To all attendees. Attention to all attendees. Could we please start making our way to the presentation hall for the next keynote presentation and round of pitches? Thank you. Could we please start making our way to the presentation hall now? Thank you.
Bring the hell out of that, Brad.
All attendees, can we please make our way to the presentation hall now for the next round of presentations and a keynote speech by Alicia Lycos? Thank you.
Oh, just go in, don't worry. Just go in.
Kush. Okay, so
Mike.
24?
Yeah.
That look okay?
Don't worry about it, don't worry about it.
All attendees, could we make our presentation hall for the next round of presentations? Thank you.
We're just starting the next round now.
I was going to watch it up here.
I don't think the sound's going to come through, but if you want to see it,
I can see the
up to you.
slides.
Up to you.
I'm trying to meet somebody here as well.
Okay.
He's got the men's room.
Okay, cool. No worries. Take your time.
I think people were just wondering if they could eat inside the.
Yeah, they can.
Maybe just put over the mic. You got PA?
Yeah.
So you can bring your food to the pitch hall.
Please feel free to come into the pitch hall. Please feel free to bring your plates and come into the pitch hall for the next round of presentations and the next keynote. Thank you.
Yeah.
And attention to all attendees, you are able to bring your plates into the presentation hall, so please make your way to the hall for the next round of presentations. Thank you.
Hey, Vicky. Tomorrow. Tomorrow. All good. G'day. I'm just ushering people in.
That link is just for in-person tickets. Is there an online?
Isn't it online?
No, it's just
Oh, she told me it was online.
Yeah. Can we?
Yeah, I'll sort it out for you. Can you give me 5 minutes? I just got to get people in.
Afternoon, everyone. Thank you for joining us again. I hope you all enjoyed your lunch. I'm here to take you through the next set of presentations, but first we have one of our key partners, Alicia Lykos. I just wanted to add a personal note about Alicia. So I've been with Wholesale Investor for around 3 years now, so before Alicia came on board. And I've seen the company absolutely transform in terms of a team and a culture. And yeah, my role is 100% better than it was at the start. So that's my personal thank you to Alicia. So please welcome to the stage Alicia Lykos from Red Wolf.
All right, so welcome everybody. Imagine this, I want to take you back. So a Salesforce consultancy. Obviously in a really interesting high growth industry, we've all heard of Salesforce, and this business was set up for success. It's in the right industry at the right time. They were facing double growth year on year. A highly energized executive team. Now that might be something that many of you would have invested in back then, but maybe not. So welcome, my name is Alicia Lykos. I'm the CEO and founder of Red Wolf Group, and I help CEOs and founders lead their organizations with confidence. And I help investors invest in the right people with confidence. And we do that through a really unique approach. It's not about gut feel when you're looking at people. It's about a data-driven, scientific approach to really understand what's going on inside your business. Look at this, I had to do it. Come on, Steve. I had to put your face on a slide. It's that or you come up here, one or the other. So as you heard from Megan, I've been working with Wholesale Investor for about 3 years. And Steve has described the experience of working with me and my team as one of the best investments he has made inside of his business. And why? Because when you start to think about the people side of your business, it is the most expensive line item on your P&L. It is the most painful component of your business. When you have people pain, it is the stuff you go home and you sleep and you think about. And it's also this part that's almost unscientific. It's this mysterious component of your business that you don't have any data around. So when I met Steve, he was looking for more data. He was looking for some insights to how do I steer and navigate this business and create a high-performing team. And I want to ask you the question today. So who has caught your attention? Many of you were here yesterday, here again today, and maybe here tomorrow. And I'd like you to think about what are the type of founders that get up on stage that grab your attention? Is it the gregarious, outgoing, fast talker, fast thinker, high risk-taking individual who's just open to change and really wants to set out onto new frontiers? Sounds like Star Trek. Sorry for that reference. Or is it the very confident, bold, direct, assertive, competitive leader who is a little bit more direct and, speaks what they think? Or maybe you've been really attracted to the type of founder who's really product-led. They're calm, they're patient, they're detail-orientated, and they know every aspect of their product inside and out. Maybe you've been more attracted to those type of founders. Who you're interested in is no chance, but not knowing who you're investing in, that is a mistake. I want to do something really interesting with you, so guess what? It's audience participation time. I know everyone hates audience participation, but all you have to do is get your hands out, and all you have to do is clap. So you don't have to do anything scary. But I want you to think about if you're an investor and you're investing in a company, I want you to give me one clap if you have a look at a particular growth metric when you want to invest. I want to hear 2 claps if you're assessing companies based on the particular industry that they're in. And I want to hear 3 claps if you love to understand the data and the evidence behind any pitch that you hear. All right. And I want you to stomp your feet if you're looking at the people data when you invest. I got 1 over here. Good. And this is the interesting part, right? When we go and invest in a business, we are looking at the numbers. We're looking at their track record. We're looking at the data. And that's what we have to go off. But what's really interesting when we think about it is all businesses are actually fueled by people. That is actually the thing that you're investing in, and whether it's going to be successful or not. Now, for those of you who today or yesterday might have visited our booth, you might have taken the Predictive Index Behavioural Assessment. Now, to give you some context, this is one of the tools that we use within our business, and we're a certified PI partner. What is it? Many of you have taken some sort of psychometric, but where PI is really unique is it has been around for 60 years. It was founded in the US and since then has been through 500 validity studies. It's been taken by millions of people around the world. And really, the competitive advantage here is how much investment they have received. They raised 50 million cap just 5 years ago. And that money gets invested back into the business to create what is now a category of their own. And we refer to that category of talent optimization. This is looking at data and science behind the people component of your business. Now, when you take the behavioural assessment, which you guys feel free to take over at our booth, it will then give you a really unique result that's unique to you. But what we can then do is we can place it in this wheel. Now, this is where it gets really, really interesting, because for many of you, you're already starting to think to yourself, well, where might I sit up there if I took this assessment? Would I be up in innovation and agility? So for people that sit up there, typically they're excited by change. They're big risk takers. They think out loud. They talk out loud. And they really, really like to get everyone else on board. So they're quite influential and gregarious. They might be fast moving. Then we've got people who are in results and discipline. They're very assertive, absolutely, proactive, but definitely a bit more reserved. So really wanting to think things through before they speak. As we move over to process and precision, here's where we might start to see some of the developers, the engineers, the calm, methodical, precision, accurate. They're going to be looking at efficiencies within the business, within their role. Or, as we go up to teamwork and employee experience, I like to call that customer experience. They're thinking about people. That's their motivation. How do we provide the best service possible? Now, many of you are already starting to think of not only people that you know, but maybe roles within your own business. And this is where we can use one framework to look at not only people, but roles, team formation, and we can even do a strategy assessment. We can look at where your team should sit based on your strategy. And this is how we get you a competitive edge. So I want you to think about, if you were really interested in that maverick style person who was a high risk taker, you are probably really attracted to what we call the maverick style. They love risk, they love new ideas, they think out loud, they move quickly, they love to get everyone on board as they lead out into the future. And that might sound like all upside. It's not all upside. The downside for working with a maverick is often they move so quickly they leave other people behind, right? And whilst they love talking, they're great starters, they're not great finishers. So you probably need a team behind them that is into the detail. As we move into, if maybe you're attracted to that style who is competitive, direct, bold, and assertive, you might have been attracted to what we call a venture style. And again, great at heading and leading the charge. Where they fall down, though, is on taking everyone else on the journey. They typically think their idea is the best idea. We've all worked with those people. And so it's quite hard to change their opinion when they've decided something. So again, if we're dealing with a founder like that, we need to look at the team around them and say, well, who's challenging these ideas? Who is it? And how are they challenging the ideas? How do we know that that was the best idea? And if you're really attracted to the calm, conservative, lower risk taker, really into the detail, really into their numbers and the analytics and every side of their product, you might have been attracted to the Guardian profile. So these are just 3 of the 17 profile types that we have. But you can see with every type, whilst we see all these great strengths and it's very strengths driven, we can start to see, well, when we apply it in a business context, this is really helpful. This now gives me more data to go into that conversation. Now I need to know what questions I'm going to ask. If I'm looking at this particular individual, a Guardian, very conservative, low risk taker, who wants to understand all the rules and structure before they proceed, I definitely want to be talking to the founder and the team about, well, how do they take products to market really quickly when they see an opportunity? Because I know this person's going to be quite cautious. So there's an array of insight we can get from someone's profile. And then once we apply it in a business context, this is where we see value. So my lesson for you here is, when you're looking at an organisation, you're looking at investing in a business, you want to understand the founder. Typically, when you go out and do these type of meetings, you want to meet the founder as well. But it's not always just that, and it's not always just the numbers. Once you start to look at the people that sit behind that founder, we can start to unlock more insight. We can start to see whether this executive team is actually well aligned to the strategy. So many of you will have heard of the concept, right person, right role. And this is a bit of a framework that we use with our clients. How do we get the right person into the right role? That's been like a universal challenge many businesses have faced, probably since the inception of business. Where we take it one step further is, how do we get the right team for the right strategy? And this is a game changer for businesses. And I want to use an example for you. So I'm going to take you back to the Salesforce consultancy. I was a member of this executive team, and this was our team formation. This had our founders, our CEO, it had our CFO, and you can see that we're all up here in innovation and agility. We're all fast moving, we love big ideas, we're all excited by the future. We grew the company from 15 to 50 people over a year and a half. We faced fast growth, they acquired new clients, they were absolutely winning awards. Now, for any of you who've grown businesses yourself, you know the challenge of scaling an organisation very quickly. And the biggest thing that we faced as a challenge was actually predictable. And some of you might already be thinking through to yourself, well, what's a real blind spot here? We have no member of the executive team in any of the other quadrants, which means we're all doubling down on our strength, and that's the thing that led us to success, great, but we're actually not set up for success for the next phase of the business. At an executive meeting, we sat around the table and we looked at this, and no surprise, for 2 years we'd been putting off anything that had to do with process, efficiency, looking at billable targets, looking at realisation, looking at contracts with customers. All of the process stuff everyone thought was boring. No surprise, it was in a quadrant none of us wanted to operate in. Now, I'm not going to get rid of the executive team. We don't do that, right? Because they're well suited in their roles. but we had to then bring in new players into that team that were well suited in those quadrants, and then the executives played an executive sponsor role. But this data allowed us to work out where our blind spots were to set us up for the next phase of growth. Now, Steve has given me permission to talk about his business, and most of the staff are here today, so they'll even see some of their own names pop up. And I want you to just hear me out on this story here. So for us at WI, it's been a really important journey of focusing on individual strengths and setting the business up for success. I want to share an example with you because many of you probably like to get into the detail. This is the sales team at Wholesale Investor as of today. And you can see these purple rims. What those are is we've completed what we call a strategy assessment, and we've outlined that the strategic priorities for this group are focused on the right-hand side of the wheel. They're things around acquiring new customers, building new networks, taking ideas to market. And you can see very heavy in innovation and agility, but there's some components of results and discipline, and this is around execution and precision. What's really interesting, both our individuals in sales leadership are in our results and discipline quadrant, right? Yes, they can be proactive and drive change, but they're going to go and ask the questions. They're going to look at the CRM and actually get into the detail. And we know that's what makes great sales leaders. Now, let's flip it. Who wants to guess what this team is? This is a team that is all about people. This is our customer success team. So they're no longer on this proactive hunting focus of acquiring new business and new accounts, new opportunity, that really, really high intensity. This is now about amazing service. And we used to call this division Delight. How do we delight our customers? Well, I probably need to put people in front of our customers that actually enjoy other humans. Believe it or not, some of you here today actually don't really enjoy the company of others. And you don't need a lot of it at work. Some people come to work every day because they want to have a conversation, they want to build relationships, and they want to do that quickly. They want to serve others. They're not self-focused. So people here on the left-hand side of the wheel, they're motivated by helping and serving others. And this makes them excellent at setting up customer success. And you can see, obviously, there's some diversity here, right? And there's some flex and bend with groups, but every single decision that we make as a business comes back to the data. Data helps us make a more informed decision. What's really interesting is many companies set out and give you these great business strategies. Here's what we're going to do. Here's our market. Here's our segment. Here's our roadmap for success. And ultimately, what they're trying to do is they're trying to achieve some sort of result. They want to achieve success. Everyone wants to do that. The vehicle of a great strategy, the only way to execute on a strategy is through people. So yes, you might be assessing these companies based on a great strategy and a great plan, but if you're not looking at the people behind that strategy, you are missing out on an opportunity to really, truly understand the type of investment that you're making. So we talk a lot about the power of people within an organisation. And for many of you, it is the scary part of the business and almost the, let's just push that to the side, that's someone else's problem. The power of this type of insight is that it's more tangible for you to get your hands on and really start to understand what drives and motivates the people in your business. It's not just about one single thing though. So where we see this being leveraged is when you can use this data across the entire life cycle of a business. When you can use it from how do we write the most appealing job ad on the planet so we're targeting a very specific market. And again, Chris from Remote Staff and his team, they leverage PI when they go out and recruit their workforce for you, right? Because they understand the power of data and science in attracting the right people, getting the right people in those right roles for you. And then we start to think about, well, how do I manage this person? Because managing people, for all of you who manage people, it sucks. Managing people sucks. It is the hardest job ever because every single person that you're managing is different. They all need something different from you. You can't just turn up the same every day in every conversation. Whilst we can have our real underlying core values and ethics, the way that we show up in service to the people around us and how we unlock potential in people is by understanding what drives and motivates them. How do I tailor this conversation? Am I going to go out and talk about your goals and ask you questions about how you're going to get there? Or am I going to make sure you're really well prepared for any meeting we have because you need the rules and structure? Having this type of insight allows me to manage people better. It allows Steve and countless other CEOs and leaders and managers all around the country that we work with to manage their people better. We know when you're working with scaling businesses, the key thing that you've got to do is retain your talent. And I hate the word retention because it kind of implies that we've got to hold people captive. We talk a lot about how do we attract but inspire. If I can inspire people to turn up to work and do their best work, your world just gets a whole lot easier. It's not about trying to retain people and hold them captive. It's about how do we inspire people. And the best way to inspire people is to understand them and understand those levers that you can pull when you try and motivate them. So I'd encourage all of you that are here today and or online to take your behavioural assessment. If you visit us on Umbrella or you visit out on our booth, you'll be able to take it yourself. It only takes 5 minutes, so it's unlike many other tools that take 45 minutes or an hour to complete. And it's going to give you a really highly accurate insight into you and your workplace-related behaviours. And then we can talk further about you and your business and how you would leverage this inside your business based on your circumstances. So thank you, everybody. I hope you've enjoyed the session. Please come and visit us at our booth.
So, given that Alicia's finished early, I'll come up for an impromptu conversation with everyone. Okay, so just waiting for the next presenter. So one of the key questions that people typically have for us, and obviously you guys would see that we've got 30 different companies each day sort of in the presentation area. So I suppose one of the key questions that you guys sort of always have in mind is how do we sort of curate the companies? Why is it we're able to attract the kinds of opportunities that we have? Because to me, I think we're super fortunate in the kind of companies that we work with, the stage they're at, and also the people that are behind them. And the reality is a lot of the, like I know you're sitting there from the investor perspective, a lot of the opportunities, and this is what's so beautiful about this space, is all of you wear several different hats. One day you're the investor, one day you're the founder, one day you're raising capital, another day you're investing into an opportunity, another day you're selling one. And this is typically what's so beautiful about this actual ecosystem. So key things we look for when we're curating companies, firstly the board and management. So we love to see that they've got that sort of been there, done that experience behind the companies. And whether it's with working with sort of high profile companies or they've been involved in exits or something like that, like we're looking for that sort of, that background and experience. We're also looking for sectors which are in that sort of growth phase or that are of demand for investors. So like I mentioned yesterday, whether it's you're looking for yield, we want to provide opportunities that have yield aspect to it. Examples like AltX, etc., and whether it be property or fund-related businesses. The second aspect is that sector of interest where we know that there's high demand for it. The rising tide lifts all boats. We simply work with that. So we're always surveying the database. When it comes down to dealing with B2B or B2C businesses, typically with B2B businesses, we're looking for their track record or their product market fit with brand name clients, right? So that makes it easier for us to understand is have they got some sort of product market fit? Even if it's early, that's completely fine. As long as there's some sort of product market fit, because we know the value of acceleration and the growth acceleration stage, once someone's past that MVP point and moving into sort of revenue, we understand that the role capital plays next, and also the role you guys as an investor can play in helping with networks and so forth. And then the next part to that is B2C businesses. We're looking for any type of growth metric which is relevant for, those businesses, whether it be revenue, whether it be subscriber growth, web visits, or whatever it may be. And then for the more technical businesses, like as you see, one of the things that's made WI is the technical businesses. Whether it be in renewable energy, life science, etc. We've got some incredibly cool, like Orbis technology out there, for example. Their lead investors over here as well, and happy to chat with the investors about it. That makes a difference when the lead investor is willing to come out and also have a chat with other potential investors about a company. So. That was the other one, is their existing shareholders. That's always of interest to us, whether it be private people that are relevant for that industry, or the sort of venture investors or corporate investors, etc. So there's some of the key things that we're actually looking for when we're sort of curating opportunities for wholesale investors. So hope that gives a bit of extra context in whilst I'm filling a couple minutes of time. Now over to Chris.
Thanks, Steve. And thank you, Alicia. Next, we have another of our key partners and sponsors, Chris Jankulovsky, founder of Remote Staff.
Can you hear me okay? Can I get a hands on how many people here have Filipino people already employed? Come on, let me see some hands. All right. You know that Australian businesses, 50 to 1 staff member, have already got 36% of these businesses in Australia have already got a Filipino member working in their businesses remotely. At the moment, it's still a competitive advantage for you if you not just hire Filipinos, but if you can actually make a Filipino team work for your business. It's crucial. Now, my name's Chris, obviously. I founded Remote Staff in 2007, very early days. We've hired more than 8,000 Filipinos to work for more than 3,000 employers since we started. So we're very proud of that. We have a team of 80 staff. Now, I don't have a clicker, guys. There it is. We have a team of 80 staff, and majority of our focus is on helping you with compliance, helping you find the right people, and managing the retention for you. Because there's no point putting all this talent in your hands when it's not being taken care of properly on that side of the Philippines. In today's slide, I'll be talking to you about talent, how to look after that talent, the cultural things you need to be aware of that you could all benefit from if you're working with Filipinos already, that I've gained working with Filipinos for 15 years in a remote setting. Here we go. So why the Philippines? I get this asked all the time. So, for starters, they've got 40 million people available right now of working age. They speak great English. The bell curve of that population is 25 years old. This is a hungry, ambitious, career-driven workforce. The work ethics is known around the world for the Filipino people. And so the English is excellent. I mean, they use it in law, they use it in school. It's amazing. So this is the workforce in a nutshell. And of course, it's only 2-3 hours time zone difference between Australia. So let's just talk about the importance of hiring the right person. Alicia obviously mentioned how important and crucial it is to get the right person on your team. We work with Alicia's PI technology because it gives us so much confidence when we endorse you a candidate to say, this is exactly who you were looking for. Whoops, forward. These are some of the good results you can get from obviously hiring a good staff member. And you know what? I think we all know that. We've all got good staff members on our team. But you know what? When we're growing teams and when we're building teams, it's all about this team fit and how rewarding is it that we can hire somebody and that can help us advance our businesses. We can make progress. We can achieve. We can finally step away a little bit and we know we've got somebody taking care of our responsibilities and stuff. This is fantastic. So it's worth the effort, guys, especially in startup environments. It's worth the effort to make sure you get the right staff on board. Because the bad results, bad hires are just bad. You're going to notice the attendance issue straight away. You're going to notice no productivity. You're going to put a lot of time and energy and effort training these people. Seriously. It's not worth the effort. It can be avoided. Not always. I mean, we always experience bad hires here and there, but there's so much science and data that Alicia mentioned, and a workforce such as us that have been around for a long time, specializing in this kind of talent that can assist you to get the right talent. And this leads me to our recruitment process. I want to share this recruitment process because it's so extensive. Very briefly, when you talk to us, you're going to get a job assessment and a behavioral assessment because we want to understand who the hell you guys are or who is your manager that's going to be working for the Filipino people. You're going to be talking to our lead recruiters. We have about 14 lead recruiters that do end-to-end recruitment, and we've got about 20 other recruiters that support them. We're going to do the posting of jobs. Bloody Seek owns all the job sites now in Australia, in the Philippines. So they're very expensive, but we're going to pay for those job ads. We're going to put it everywhere. We have a 150,000 network of candidates that we've been involved in for the last 15 years. We have an employer brand that's very respected over there. And now look at this pre-qualifying process that we go through. Conducting 2 interviews for you. The behavioral and cognitive assessment will give you those reports from Alicia. You're going to know with confidence, who are you hiring? Is this the right decision that you're making? We're going to do skill tests. We're going to do 4 English speaking tests because they speak great English, but can they comprehend English? We want to know that. Now, each one of these tests costs me $8 US. We confirm IDs. We make sure that they're remote work ready. By the way, all of this is done before we endorse you a candidate. And guess what? Now we help you with the interview. We are there with you in the interview. We want to make sure that you are actually making a good decision. And why am I doing all of this? I haven't charged you a cent. Why? Well, I'll tell you why. Because I'm the one making the investment in you. I am spending $2,000 to $3,000 to service my clients. I want to make sure I get it right. Because if it doesn't last more than 6-8 months, I don't get my investment back. So we have a long-term focus. We have to make it work. We have an invested interest to see this work for you, as well as the Filipino people. In this today's landscape, we can't make this work unless it's the right thing for the staff and it's the right thing for you. The staff have traditional employment values in the Philippines. They want to build a career with you. We want to make sure this is right for them too. And by the way, it's only after you decide that you want to hire somebody is the only time we give you a contract to sign. And it's the only time that you get an invoice. Look at all this work I've done, mate. Come on. I've been doing this for 15 years, guys. So, here we go. We're going to give you the contract. The contract is a month-to-month thing. We don't want to lock you into anything that doesn't work. It's month-to-month. You have a 24-hour notice period to cancel. You have a 2 weeks notice after 1 month. I do a lot of things that are very different in this industry, and I'll explain that in a second. But before I do, I just want to briefly cover how do you decide who to hire. I used to own a business called Industry Outplacement. I can't help myself. I did a lot of time studies things. So here's my little time study equivalent on how you might decide who to hire. Put all the tasks on the left, the duration of each task, frequency per day, per week. You come up with the total hours. You try to bundle up the skills to make sure that you don't have a graphic designer bloody doing some business development work, or you don't have a developer talking to your customers. You've got to make sure that the skills are related, you can match up, and you have an idea as to who you want to hire. So, I want to share now something. 15 years of experience. I'm an Australian, born and raised in Melbourne. Married to a Filipina, thank God. It helped me a lot with this. I want to share some of those cultural learnings that you need to know about to optimize a Filipino workforce. First, appreciation for them goes so far. Man, I'm always surprised when I appreciate my fellow Filipinos, when I notice excellence and I recognize them. It goes so far. It never happens here in Australia compared to there. Also, the team there, they love to be as a team. They treat their team like a family. So the more moments you create that they get to be together, play together, have games together, all this stuff, they love that. As a matter of fact, from a working experience point of view, these are some of the memories they cherish the most. I want to move on. So some of the biggest differences is, look, they're not going to tell us what they think. They don't come to us, and this is annoying because I've been working with them for so long. It's taken me a while to learn this, but they don't come to me when they've got problems. They don't come to me to share things. No one. They share it amongst themselves. So one of the lessons I've learned is you have to have a mother or father figure or a manager or a representative like us at Remote Staff that allows the fellow Filipino to go to another Filipino to share whatever they want to share and get comfortable. Don't assume that the staff's comfortable going to you. They've got this authority thing, yeah? The hierarchy mentality has been around there for a while. 300 years of colonialization has affected that mindset of theirs. So the tip here is Filipinos are more loyal to their fellow Filipinos than the company. It's just a reality. I want to share with you about the family pressures and expectations. This is their driving force, by the way. So, imagine there's a family of 5, and none of these ones can afford to have their child go to school except for this one. This kid goes to school. He now becomes an employee. He's the breadwinner now for the family. He looks after the whole family interest. So the staff we hire for you, most of them are breadwinners. So they're very motivated to look after their own families. Jesus, so would you be if you're on the poverty line, you know? It's how it is. So, and also the other thing, not only do they look after their families, but they also look after their extended families. Like, because only 3.5% of people have private health insurance there. So if there's a grandma that's sick, all the family members come together to look after their grandma. The reasons why I'm sharing this cultural stuff is so that you have some sensitivity and awareness about the landscape of working with Filipinos and how to optimize them. As I got here, but the family values actually is what motivated me most with the Philippines. I'm still so motivated 15 years later to support the Filipinos as well as my fellow entrepreneurs to get the right team member in their business that is a valued team member that can actually really deliver results for them. What a difference. Oh my God, it's like winning lottery when you find an awesome Filipino. You're just paying under $2,000. That's amazing. And you mean you're going to have a productive talent? Yeah, we've done it for countless of employers. So, but the family values of the Philippines is what helps you build a team that's cohesive, that are collaborative, that are really committed to your business and your goals. And you know what? If you can build a powerful Filipino team, you'll be the envy of all your competitors. Because this is what everyone around the world values about the Filipino workforce. Communication. So this is a funny thing. I'm going to focus on one point here. Indirect communication, it's classic. So they never openly share something, yeah? They don't want confrontation. I cannot tell you how much a lift of an eyebrow helped me understand that, they approved of this decision. Man, why don't people just tell me? It just doesn't work that way. So just be mindful that their communication style is soft. They're not going to run to you with ideas. You know what Alicia's profile was mentioning, all those stuff? I'm one of these maverick guys. You know the excitable guy? I'm one of them. And so no one wanted to share ideas with me. And if they did, they'll whisper it or almost say it politely. I've learned how to pay attention to the little details, especially when working with Filipino people. Now, I hope I've given you some good overview here about working with Filipino people, because I want to share our offering. So our offering, we first find the Filipino person. Our goal is to say, there's no award rates in the Philippines, yeah? So there's a person, they want something. We know what they want, like we know the market going right now. If we hire the right person correctly, technically, we've covered our service fees right there by hiring him at the right rate correctly. Because the middle, this doesn't happen on the entry level or the lower scale, the middle to senior level are very ambitious people. So if they know they're working with a foreigner, they jack up their prices on average by 40%. I'm talking about their wages. They just jack it up by 40%. If they're ambitious, they'll go 100%. So because we've got a landscape and understanding, we've got a whole recruitment force of 80 staff, we know what's the going rate of certain people, so we make sure you hire correctly. Now, we have a tiered pricing model, but so what do you get for the $500 a month? Well, as you know, those with numbers, I've already invested $2,000, $3,000 for you up front. Man, I'm not getting $1 back for at least 6 to 8 months. But what else do you get in addition to recruitment? Well, we manage the payroll. We make sure we've got tax withholdings, benefit contribution payments. We register them as self-employed professionals. We have an account manager that works with you equally as much as they do with the staff. We need to represent both parties. We are one of the few agencies that have got experiences of where the same staff working remotely with the same employer in Australia for more than a decade. We've got hundreds of these relationships that have passed this milestone that we're very proud of. So we've got a formula that works, guys. So in addition, we've got a remote monitoring technology that we've built ourselves. We manage screenshots, we manage computer usage reports and all this stuff. Why? Because I first started this business for my own needs, and I had anxieties. I'm the employer. I don't know what they're doing. Are they working at home? So I did this 2008, way before monitoring became a thing. It was just what I needed to get some peace, knowing that my team are actually working on work-related matters. So something that none of my competitors do, because we've built our own custom billing system, what we do is for every hour worked, because we bundle up our service fees with their wages into one hourly rate, for every hour worked, right, and proven worked, we officially charge, even though we invoice you ahead. And any hour not worked, because of typhoon, weather, sickness, family issues, whatever, we refund that hour as credit in your following month's invoice. But not just that, we also do something, again, our competitors don't do. We refund our portion of service fees. So we only charge when they work. That's an awesome bonus, right? Now, we do a lot of other things. Come see us if you want to know more of the details. But in a nutshell, we take away all the risk from you. That's the whole point. We want to prove to you that we can find you the dream talent before you pay a cent. How good is that? Come on, guys. I need some, come on, hey, wake up, please. I've been doing this for 15 years. I'm so committed and driven to find good talent, you know? And I'm putting my money on the line. That's why I needed that recognition. Anyway, so we have over 400 candidates profiled. Come to our website, you can have a look at it. You can see prices, resumes, an audio introduction. I can't believe no one's copied me on this. No recruitment site has copied me. You get to see a little audio minute introduction of about a minute or two from a candidate. You get a feel straight away. We know what we look for. We know the kind of talent that you guys love to hire. We've got a handful of them profiled out of our many. If you like what I have to say, if you think that I can maybe find you that perfect talent, with the use of PI, of course, and our people, please scan, visit our booth, come see us. You've got nothing to lose. I take all the risk off your hands. Thank you.
Fantastic. Thank you, Chris, and thank you for your energy. Now we have Simon Kidston, Non-Executive Director from Genex Power, ASX GNX.
Good afternoon, everyone. Simon Kidston, great to be here today. A slight change of pace. I want to tell you all about renewable energy storage in the Australian market. So Genex Power has got $1 billion of capital invested in the Australian market, producing strong cash flows for the business and our shareholders. I'll tell you about how we make money in a moment, but what I want to say is this business not only does it make good money, but it has a very solid environmental contribution. The benefit from our environmental generators, this green portfolio, is equivalent to abating 2 million tonnes of CO2 from the environment. So any investor in our business will make money by virtue of its exposure to this renewable energy, but also know that they're doing the right thing for the planet. In terms of scale and business, we're technology agnostic. So we have a portfolio of solar farms, wind farms, Tesla batteries, and pump storage hydro. In total, that's $1 billion of capital spread between Queensland and New South Wales. It's all about the cash flow. Cash flow will drive shareholder value. This chart is quite detailed, but what I'll explain is that we've given revenue guidance from today all the way to 2055. And what that shows you is that we've got a steadily increasing revenue stream, which is all underpinned by long-term contracts. So that revenue stream averages $90 million per annum from today all the way to 2055. So it's locked in growth by virtue of long-term contracts with tier one customers. So just mentioning who those customers are, It's the Queensland Government for our solar farms in Queensland. It's Energy Australia, one of the biggest energy companies in the country, for our pump hydro project. And it's Tesla, the biggest company in the world, or one of the biggest companies in the world, for our battery project in Queensland. So it's a very, very strong baked-in revenue stream. This year we'll generate revenues in excess of $20 million. By the time our battery project is operating mid-next year, the run rate will exceed 35, and you can see the growth from there. This is possibly the most important slide in our presentation, and what it shows you is the structural changes in the energy markets between now and the 2050s. We all know the energy market is decarbonising. We all have heard that the big major coal-fired power stations are closing down over time. It's not going to happen today, but it's locked in to happen over the next 10 or 20 years. That capacity is being replaced by wind farms and solar farms. Renewable energy, it's clean and green, but of course we all know that the renewable energy doesn't always work if the sun's not shining or the wind's not blowing. And this is the important piece. Our business is focused on energy storage. So essentially, through our pump hydro projects, through our battery projects, we can store energy when it's in surplus and dispatch it into the grid when it's required. So what you see here, over the next 30 years, the black line shows you the terminal decline of coal-fired power stations, and the blue and the green is the replacement by wind and solar. That is happening. It's a structural change, and it provides a massive tailwind to our energy storage business such as Genex Power. This is our first battery project. We financed it last week. It's a $59 million project, and Tesla is providing the batteries, and they're providing the revenue guarantee. It's our first battery project. We've got an offtake arrangement, and construction has just started. It's a fully funded project. It's located near Rockhampton in Queensland, about halfway up the Queensland coast. And we're building this battery park right next to one of the biggest substations in the country. Just some financials on this project. Capital cost just below $60 million. Revenues should be in the order of $15 million per annum. Had it been operating last year, we would have made $20 million. So I'm pretty confident giving you that revenue guidance of between $11 and $15 million right there. We've got a guarantee of performance from Tesla for the next 20 years. Probably will last longer than that, but at least we've got a guarantee from a major corporate for the first 20 years. The EBITDA margins for these sort of projects are phenomenal, 75%. Very, very solid cash generation from all of our projects. So equity IRRs are a very, very healthy 9 to 17%, depending on where the revenues land. Just a few words on our flagship pump hydro project. This is a $770 million project located in North Queensland. It's currently under construction. There's some photographs here showing you the status of the construction. It's a massive, giant water battery. All the construction risk is taken by the builder, John Holland and McConnell Dow. We're in the process of doing underground tunnelling. We'll install some massive hydro turbines. And when this plant is operational in 2024, Energy Australia will lease this from us for the next 30 years. So Genex Power, as owner of this big infrastructure asset, will collect a rental stream for the next 30 years. Fantastic project for us, and I'm really, really proud of our team that we've assembled and got this project into the construction phase. Just a few words on our operating portfolio. We're currently generating revenues in the order of $20 million per annum. That's from 2 large solar farms, one in Queensland, one in New South Wales. For the first half, we generated revenues just over $10 million. We'll replicate that again in the current half to produce that $20 million of revenue. And that's under very, very solid EBITDA margins. Of course, the sun is free, so the fuel cost is therefore free. Therefore, this thing just generates, basically as long as the sun's shining, we generate cash from these 2 assets. We've got a wind farm in North Queensland, which is currently under development. We're developing this 50-50 with one of the biggest energy companies globally, a group called J-Power. They happen to be a shareholder of our business. We expect this project to be in construction by the back end of next year. A big project, really exciting, and the market's crying out for quality wind in Queensland. I did mention at the start our focus on the community, the environment. Of course, our primary focus is for shareholders, but we like to do so in a way that's good for the environment and the community. We've got very high standards in terms of Indigenous engagement, employing a good proportion of women in senior roles, and it's something we're very proud about. Of course, the environmental contribution from generating clean green energy is obvious in terms of CO2 abatement and decarbonising the economy. So look, I guess as I look to wrap up, there's a couple of messages I want to leave you. It's $1 billion of capital. We are not a startup. We've got a very, very solid business, and those projects which are now in operation are backed by long-term contracts. Those long-term contracts deliver substantial revenues, and by the time this portfolio has matured by 2025, I'd expect from that point we'd be in a position to pay a significant portion of our cash flow to dividends to our shareholders. So 2 operating solar farms, 1 battery in construction, the pump hydro, again fully funded in construction, and the wind project, which is looking very attractive and will be operational by 2025. So to summarise, operating cash flow, tier 1 counterparties, a very, very strong revenue stream that's growing over time, and a very exciting development pipeline. Board and management have significant skin in the game. I'm Simon Kidston, I'm one of the co-founders. I'm a significant shareholder. We've just raised money, so we've got in excess of $60 million of cash on the balance sheet, so we don't expect to be coming back to the market. We just want to commercialise the portfolio in front of us and deliver for our shareholders. So thank you very much for your attention.
Thank you so much, Simon. We now have Jennifer Robertson, CEO of BostonTrading.co, and also Jeremy Britton.
Hi everyone, great to see you here today. Welcome along. I know the post-lunch session can be a little bit, everyone's quiet, they're digesting those sorts of things. So I want to get kind of really up close and personal just to kind of get your heart racing a little bit. Just wanted to ask a very personal question, and that is there anyone here who is crypto curious? Crypto curious? Excellent. Hands up. Anyone got investments in crypto at the moment? Fantastic. And still remain crypto curious. That's fantastic. Anyone here like Harry, who I met outside at our booth? So Harry said that whenever he hears Bitcoin or cryptocurrency, his blood pressure starts to raise. Is there anyone like that in here? Anyone? No. Well, look, what I'd like to do is introduce you today to Boston Coin. So it's the world's first cryptocurrency managed fund. And the idea behind Boston Coin, if I can get this to work. It doesn't want to work. There we go. The idea behind Boston Coin is to address a critical problem when it comes to cryptocurrency. The problem is that it's a very new asset class, quite nascent. And so essentially trying to understand what cryptocurrency is, what it does, and how to find the value in cryptocurrency can be very difficult. So not surprisingly, anyone who's been reading a paper over the last 7 or 8 years would know that cryptocurrency does unfortunately have a pretty bad name, and it's got a bad name for a number of reasons. The first is that the market is unregulated, and so it feels a bit like the Wild Wild West out there. And so looking at that unregulated market, people are nervous about putting their money in. And what makes them even more nervous is the fact that scams are something that is happening time and time again, and we hear time and time again that people have lost their money due to a scam. So cryptocurrency is not doing itself any favours when it comes to getting people with kind of real money, serious investors, to put their money in and feel confident that they're going to be able to either retain that capital or maybe even get some kind of profit. So these are the 2 problems that come with cryptocurrency, and you can see here we've actually found a stat that says up to 92.5% of cryptocurrency projects are a scam. And so spotting the scams is getting even more difficult nowadays. So that's part of the problem. Also trying to find out, well, if you want to find that little percentage that isn't a scam, how on earth do you find that? How do you find those ones where you can feel confident that you've got your investment? Nothing's ever watertight, but at least you're not going to be losing it, in an instant overnight. So we came up with a bit of a solution, and that solution is basically a crypto fund, which is a coin of coins. We fondly call it the coin of coins. It's Boston Coin. Started in 2016, so it was at a time, I don't know if anyone's been involved with crypto since 2016, but I can tell you it was at a time where it's incredibly difficult to open a wallet, incredibly difficult to do any kind of research to find out what coins were out there, other than, everyone kind of knew of this thing called Bitcoin, but it was considered a little bit kind of geeky and, those sorts of things. So in doing all of that kind of process, it would be fair to say that I was trying to be, trying to learn about how to do it myself, and you can see that's one of the options when it comes to investing in crypto. However, I'm a very busy person, and I'm going to be really, really truthful, I had little intellectual bandwidth to kind of dedicate to trying to find out how to do this well and navigate all of the complexity that was crypto at the time. So speaking to Jeremy Britton, who is the CFO, he's the secret sauce to the Boston Coin, I might say. So when it comes to choosing the coins, but it was a case of, can you do it for me? Can you help me understand what are good coins to invest in? And Jeremy and Boston Coin has gone one better and actually then said, well, let's mint that into a coin that is asset-backed. And that's quite unusual for those of you who play in the crypto space, an asset-backed crypto coin where the founders don't actually take a whole bunch of, kind of print themselves a whole bunch of coins and then, kind of pump and dump on the market. It's very, very rare. So we're professionally managed and we are open for individual and retail investors. You can see we can get money from all sorts of places. So the solution itself, and this is part of the solution, so a number of people are asking, how do you know what coins to invest in? What's your diversification? This is to give you a bit of a slice as to just how many coins are in the Boston Coin offering. And so we do hold quite a few coins. You can see there the larger holdings in Bitcoin, Ethereum, CRO. And what we do is also not just invest in the cryptocurrencies, invest and kind of research those crypto coins, but also looking at the infrastructure that supports cryptocurrency. So looking at technology like fiber optics and blockchain technologies, those sorts of things, to be able to say, well, it doesn't matter which coin is a winner if we're investing in the underlying pieces of the infrastructure that go to supporting cryptocurrency, we're going to be winning anyway. So that's the idea. The idea is that we diversify your crypto holdings with a view of actually reducing the volatility. Now, that's not the case for everyone. So when it comes to diversification, obviously in the crypto market, again, if you've been reading papers, you'll see that it can go up and down very, very quickly. And so diversification doesn't necessarily mean that you're going to be able to get a good kind of return. But when it comes to our result, over the last, so we've been around since 2016, and we've kind of given you the last 4 years' performance here, and our average returns are 366% for 4 years, and we were first to market. There is absolutely nothing that we withhold from you in the sense of every month, Jeremy, whatever the market is doing, Jeremy will publish a newsletter, a monthly newsletter. It's a little bit irreverent, it's a little bit fun, and so which is kind of really Jeremy's personality. But every month you'll see a newsletter which explains what he observes in terms of what's been happening in the crypto market over the last month, but also what he thinks is going to be happening in the near future. And so the potential itself is extraordinary. So this is not an Australia-wide thing, this is a potential worldwide thing. So Jeremy here, and this one's his particular slide that he loves, is the idea that we're really trying to be almost like the vanguard of cryptocurrency, this idea of allowing people who don't necessarily have enough money to buy a single Bitcoin to come in and actually diversify into something that is safe. You can see here that the opportunity itself for cryptocurrency, there's potentially a $90 trillion opportunity sitting here when it comes to crypto hedge funds. In particular, looking at that statistic of most people don't necessarily want to invest themselves, so they don't want to DIY, they want someone to do it for them. And so the potential itself is quite enormous. Looking here then at the market, it would be fair to say that we are the only one that can really boast a year-on-year for more than 4 years growth. So you look at other now, kind of funds like this in the market, maybe 2 years, possibly 3. So they're very, very rare, but we can give you that return. We've given that return of 366% over the last 4 years, solidly. Now, I'm going to go the person who, and I'm pointing to him right now, you're standing very straight up there on stage. So the person who is the secret sauce is actually Jeremy Britton, who's here on the stage. He's the CFO. He's the one that actually picks the coins. He's the one that does all the research. It's based on him being a financial planner for more than 20 years. He can sort of look at all of the tea leaves and figure out when the market's hot, when it might have a correction due. He doesn't necessarily say, for example, that he predicted the tech wreck or any of those sorts of things, but he could see that there was something there, and there had to be, it was a hair trigger before something was going to make the market, kind of recorrect or correct in a very bad way. So that's the kind of things that he does. And just wanting to point out as well that last bullet point there. So he tries to find, and does find, he's very good at finding all of those coins which are undervalued or perhaps pre-ICO, and so he's picked a number of times the 10,000+ % returns. This is the 6 times. So this is where Boston Coin has had all of its interest from around the world, just to help you know that it is a worldwide offering. And like all good CFOs, he's not shy of being able to put himself up there on the screen as well. So we're pretty proud of the track record there, particularly the Hacker Noon, 200,000 daily views, the Hacker Noon trifecta, where 3 Boston Coin stories came up. But you can see there interviews from Yahoo Finance. It's one of the startups to follow. So a fair bit of media out there, but do come onto the website. So there's a free crypto newsletter there, and that's where you can sign up and have a look at all of our returns, and we're also out there on the stage. Jeremy?
Cool. Thank you. I just wanted to say one word, because I know everybody has come in here like kids in a lolly shop, and there's so many exciting things that you can invest into. The one word to remember is liquidity. So I know you walked in here with your $400 million and you told me you had $4 million in the Swiss bank account. But when you're looking at all these companies, some of them are in startup phase, you put all your money into that one, you might not see it for 3 or 4 years. So the idea is to spread it around like we do with the fund here, diversify. And obviously with our fund, we are asset backed. So we're investing in stocks and shares, we're buying exchanges, we're buying coins. So if you do change your mind, or if the proverbial hits the fan and you need your money back, it's liquid. You can actually phone up, send us an email, you can get your money back. So just a warning, keep some liquidity into some different companies where you can get it back if an emergency occurs, and obviously for the other ones you can invest into for long term. So I've been investing for more than 30 years. I've learned a lot of things. I've made some mistakes. I learned a lot from that. So invest safely, and we'll talk to you soon. Thank you.
Thank you.
Thanks, Jennifer and Jeremy. Next, we have Bill Kalatos, CEO of TomSoft.
Hi, everybody. Good afternoon. My name is Bill Kalatos, and today I want to talk to you about TomSoft. Tom is the SAS ordering platform that allows chefs to connect very easily with all of their suppliers. It is the only software with a streamlined business process all the way from ordering through to delivery. It's got a secret sauce that gives it the potential to go viral. Just imagine for one moment only one supplier using Tom for just 50 of their customers, and only 5% of those customers to use Tom to order off just one extra supplier. If you play that out over 10 iterations, you get more than 1 million connections. We've already got a significant launch platform and established bespoke ERP system that operates in the food service industry with 4 suppliers and over 5,000 customers, and that is our launch pad to launch the Tom platform. And as a result, Tom's already got users. It traded 86,000 transactions over the last 12 months, more than $25 million in order value, with over 1,200 customers on the platform already and more than 20 suppliers. And we've got a fantastic IT capability and a stable team of 11 developers across Vietnam and Australia continually developing Tom in a global and flexible platform with a proven tech stack, and it sits on the Microsoft Azure cloud. The problem that we're solving: too many ordering systems. Chefs don't like ordering off many systems for many suppliers. And there are an immense amount of delivery issues that occur at the point of delivery in finding out where delivery might be or managing credits. And all of that results in a very costly back of house in reconciling transactions and trying to manage credits as well. Re-entering orders, re-entering invoices into the back of house financial systems is very, very common, especially in the hospitality industry. How do we solve that? An unrestricted ordering platform. From day one, every single chef can order off all of their suppliers of Tom, whether the supplier is on the system or not. And we've got Fuba, a fantastic, powerful delivery management system, which gives customers and suppliers visibility of where the delivery may be, and a very powerful workflow process to be able to manage credits automatically to allow people to pay with confidence and streamline the back of house. We're starting with hospitality because that is our instant, easy launch pad. But we're really, really excited about what Tom can do on a global platform and in many more markets. Retail, logistics, it really has a place arguably anywhere where there's a transaction. And one of our powerful things that we love about Tom is we're focusing on the customer and not just the supplier. That creates a much larger market for us, which allows us to create more value to our users for less. And that is one of our key competitive advantages, the multiple revenue streams. Another one, as I said before, suppliers don't have to be on the platform for users to be able to place orders with them. It's quite sexy, really. And we've got Fuba. Fuba gives us a visibility of the delivery for the customer and the supplier at any given point. We've got a very sophisticated invoice approval process which allows us to manage credits simply and easily. And we've got advanced route optimization for the suppliers that are on the platform to allow them to save money and time when they're doing deliveries. And we've got T-Suite. Based on the back of our knowledge with our Tom ERP system, we've got T-Suite. Smart, simple, easy to use plug-ins for suppliers to help manage their businesses. Our business model, subscriptions. Anyone can get onto Tom for free, but then the more transactions that they want to use, the more features they want to use, there's a paid subscription that is competitively very, very low in the industry. And payment processing fees. Any of the customers that actually want to transact and pay via credit card and direct debit and pay as you go, those sorts of principles, we charge a processing fee of 0.5% for that as well. Further, as we grow, further revenue streams in advertising campaigns for suppliers and as an extended marketplace for software, other software providers that want to add their software onto the platform are also of great potential. The slide that really excites me is the exponential growth slide, the ability of this software to go viral using its secret sauce. We've done some modelling that I believe is quite reasonable. And across 16 iterations, this could lead to more than 5,000 connections, 5 million connections, more than 2 million paid users with revenue streams of over $92 million. And it really all depends on the key metrics. How many, through the secret sauce, how viral can it get? How many customers introduce new suppliers and how many new suppliers introduce new customers? And then, of course, how many of them do we upgrade to being a paid subscription? Key people, myself, I've had 30 years experience in food service, which is our original market that we're launching with, and building ERP systems. My business partner, who you can see outside, who's the product manager, Lai Ho, he's been with me for 12 years. Jacqueline Lees, she comes from food service as well. Huge market penetration, huge knowledge, a lot of relationships. And David Nguyen, who actually developed the platform for scalability and growth, has got a wealth of experience in large-scale IT architecture. We're looking to raise $1.5 million. We really want to fast-track this. We want to load up our development team even more than what it is right now to fill in any identified extra features that we've got, and everything else that's going to come from us engaging more with our users and getting very, very intimate with them to be able to really crack this secret sauce of the virality and being able to upgrade subscriptions. And of course, we want to grow organically. We want to make Tom a very popular, marketed name out there as well. Thank you very much for listening. We're at booth 9. Anyone that's got any interest in Tom would love to talk to you. Thanks again.
Thank you so much, Bill. Next, we have Emily Blythe from Pyper Vision.
Every year, there are 620 million passengers that have their flights disrupted by fog. This is 23% of all weather-related disruptions. It costs the airlines worldwide $12 billion in a direct measurable cost to their bottom line. And we're seeing the same problem experienced over ports, critical road intersections, underground mines, search and rescue, war, construction sites, vertical takeoff pads, large-scale events, ferry sailings, and that list goes on. Fog is costing industries an unimaginable amount of money every year. Now, across most of these sectors, fog is also responsible for the largest number of fatality rates. The worst in history was this Tenerife disaster, where 2 aircraft on opposite sides of the runway collided in the middle, taking the lives of 583 individuals. It was this incident that raised global awareness for the need for increased safety standards worldwide in low visibility conditions. Now, as we discovered, fog dispersal isn't new. In fact, the military used to ignite fuel, creating visibility for their planes to come in. However, as you can see, these methods were not very safe. Other attempts infringed runways, and their chemicals corroded our environment, with more recent attempts being extremely time-consuming because aircraft had to take off from airports where there was visibility in order to disperse those that were stuck in fog. What was preventing these solutions from becoming commercial was the fact that they couldn't meet environmental or commercial requirements needed to do so. To be successful, we needed to be able to disperse fog safely, sustainably, on-site, and on demand. And today, this is exactly what we're doing. Through just a 10-minute dispersal at an airport, Pyper Vision can bring fog to the ground, creating enough visibility for hours. Our system works through reducing the moisture level in the air and on the ground, creating an immediate visibility and also hindering the reformation of fog. Our operation is approved in both New Zealand and Australia by the civil aviation authorities. Worldwide, our absorbent is approved by the Environment Protection Agency, and we even meet safety standards for your drinking water. On every test that we operate, we track both our environmental and our runway impact, showing that the residue on the ground turns into a carbon source faster than what it can actually build up, and that we meet the safety standards for braking action for aircraft. At the moment, our system is designed for airports where there is a wind factor below 6 knots, generating a market opportunity of $244 million per annum in revenue across 159 airports. We have an R&D program as well, which is going to build out this capability in the types of fogs in different environments that we can test into. And this will grow our market opportunity to $1.28 billion per annum across 685 airports that face significant fog disruptions. Now, in the market today, there's no one else capable of removing the hazard of fog completely. Our closest competitors cost airports $40 million to set up, and they can take up to 10 years to install. Their systems help to guide aircraft to the ground. However, to meet safety standards, air traffic control has to significantly increase the separation between each plane landing and those around it. As a result, airports are operating with these systems with at 50% capacity at best. We charge the airport between $500,000 per annum and $5 million per annum, depending on the airport's size and the degree of product coverage. This cost is then charged on to the airlines through their landing fees, and they are the true benefactors. To date, we have $410,000 signed in revenue and $7 million in letters of intent across 6 airports. Now, on our team, the team who has gotten us to where we are today includes Nick Jackson, who leads a team of 5 engineers and specialists who have developed the first and only certified absorbent for fog dispersal. Tyler Culling has matched 20% of all investment raised to date with grant income, and he coordinated the establishment of our 2 subsidiaries. Atera Nair is our data scientist, and she's been recognised by Canterbury University as one of the top 3 data scientists in New Zealand. She also developed a model to calculate the financial, human and carbon impact of fog across airports worldwide. Now, just recently, this model was adopted by our customers, and it's shown, their adoption has validated the accuracy of our data. And finally, we have Nikki Whitaker, who has developed our internal training program, training our first 6 individuals, taking them from very low aviation knowledge right through to certified pilots in just 1.5 months. Today, our team is excited to announce we're raising a $5 million round at a $20 million valuation, and this is in New Zealand dollars. We tentatively have $4 million already lined up from existing investors and angels, and we're seeking a lead VC to help set the terms. With this funding, we're going to use the money to onboard our first airports, scale our R&D to both sides of the hemisphere, increasing the number of fog days that we can test in. We'll be securing our regulatory approval in all key continents that are remaining, and securing a lead customer in each of those different regions. Thank you very much for the opportunity to come and present today. It's been an absolute pleasure. Please come and see us afterwards. We've got our drone over in our stand, or reach out to me using the contact details above if you're interested. Thank you.
Thank you so much, Emily. We now have Matt Gill, CEO of White Rock Minerals.
Hello, ladies and gentlemen. Thank you for taking the time to listen to the White Rock story. We're a little bit different. I think I'm probably the only resources company here at the conference, but I welcome you to come and have a chat afterwards, booth 12. We are ASX listed, as opposed to many companies here. We're a junior resources company, and we're into 3 great commodities: gold, commodity you want to be in right now, silver, and also zinc as a construction material. And in 3 great jurisdictions: Victoria, a project here in New South Wales, and a very exciting project in Alaska. We are ASX listed, so we have compliance obligations. I won't bore you. You can read that discretionary statement at your leisure. You will find it on the ASX, and it is on our website as well. So do your own research. I'm not giving you financial advice, but what I like about White Rock, and obviously I'm a little bit biased, three great commodities, as I mentioned, gold, silver and zinc, three great jurisdictions. You know, gold uses wealth protection. Again, not financial advice, but I'd suggest that everyone should have a bit of gold in their portfolio. Gold and silver for jewellery, silver as a renewable mineral in solar panels, and zinc as a construction metal, a critical metal in the US, and our Alaskan project has about 1.8 billion pounds of zinc. Mentioned three projects, great jurisdictions, significant land package between those three projects, and that's important. One of the key assets of a small junior company is the land holdings that it has, and then also the mineral endowment within those land holdings. So we've got a great gold project in Victoria, famous history, 660 square kilometres. Victoria's going through a second gold renaissance. You know, Victoria was built in the 1850s on a gold rush, going through a great period at this point in time. I'll touch a little bit on that in my talk. Alaska, we're in central Alaska, 800 square kilometres. We've got a Tier 1 project that has significant amounts of zinc, silver, gold and lead. And then lastly, not to forget, our cornerstone asset that the company listed on at Mount Carrington, here in New South Wales, again, gold and silver. Commodity diversification, as I mentioned. So in terms of what does this actually mean, 800,000 ounces of gold, 84 million ounces of silver is about 2,500 tonnes of silver, and base metals. Now, you can do the maths, but if you take those ounces of silver and gold and zinc and lead and multiply it by the current spot prices, White Rock's in-ground value, metal-wise, is about $10 billion Australian. My frustration, but the opportunity, is the undervalued nature of our company, our market capitalisation, compared to independent valuations. There's a thing called Valmin, which is an internationally recognised valuation technique. You can see the value that they ascribe. Fundamental Research is Canada's largest independent research house, and then Henslow, which is an international but Victorian, there's a Melbourne office. So you can see a disconnect between independent values for the company and White Rock. My comment would be is even if they're half right, I'd like to think there's an opportunity there. If I had to stop my talk, I'd stop it there. I'd encourage you to come and have a look at our website, come and have a chat to me at the booth. I will now go fairly quickly through those three assets just to give you a bit of a feel. I understand that most of the audience is probably not technically minded, or I'm a mining engineer, but it might just give you a feel for mining, the importance of mining. I mean, there are only two true wealth generators in the world, it's mining and agriculture. You know, if it's not mined, it's grown, as they often say. Our capital structure, you can see that we're ASX listed, no debt, we've got some cash, we have a board of 5. Significant shareholders, our largest is a Denver-based precious metals fund out of the US, so they've done their own research. We've got 2 Zurich-based funds, they've done their own research. We've got a $1 billion private equity group out of New York, they've done their own research. So I think a shareholder or an interested investor should get some comfort, should do your own research, have a look at who else is invested in the company. Don't just believe me, go and have a look for yourself. So Woods Point, we acquired this project in August last year. It's 150 kilometres east of Melbourne, beautiful part of the world. That photo is what we acquired. We acquired a ready-made gold processing plant, a shaft, a winder. It's had production. We've got 25 people there on site. Why Victoria? As I mentioned, is going through a second renaissance thanks to a gold mine called Fosterville, owned by a Canadian company, now one of the richest gold mines in the world. What we purchased is a historical mine. It produced over 800,000 ounces at almost an ounce a tonne, 26 grams a tonne. There aren't many mines like that anywhere in the world. It goes down 800 metres, it's flooded below 10 level. We're working above 10 level. We're getting significant intersections, 1, 2, 3 ounces a tonne, albeit narrow. Part of the trick is the mining the narrow quartz reefs, leaving the waste rock behind. So that's just a snapshot of the upper area. We've got 4 identified areas that we're currently drilling. My comment would be, in this current gold price environment, great time to almost be starting production. That's our plan, to restart production sometime this year. And an analogy of the mine, that's over 800 metres deep. There was an area above it and an area below it that's been mined, but not an area in between, and that's what we're currently drilling. So we're drilling from surface in that upper area, we're drilling from underground in that lower area. As I mentioned, we've identified about 4 areas already. But what's interesting and is as exciting, if not more exciting, is the regional exploration potential. We command 660 square kilometres of ground. That area has produced over 5 million ounces in its time, multiple targets, and that's the second prong of this story, is not only the in-mine potential, but the regional. And an example, something that the old timers mined only 100 metres, hit the water table and stopped. We want to drill that, find out what's there. Red Mountain, geologists are very imaginative. Yeah, it's a red mountain. South of Fairbanks, significant land package, 800 square kilometres. What's very important is the endowment, 11 million tonnes grading, a couple of ounces a tonne silver, over 5% zinc, 2% lead, gives it a significant metal endowment that I've mentioned before. Great land package out to the right of that photo, out to the east, we've got this significant polymetallic potential, we've got last chance potential, it's VMS. We've also got a huge gold anomaly that we started some drilling, we want to do some more drilling on. So a great land package there. We've made a lot of discoveries. If it wasn't winter right now, we'd love to be drilling there right now. We've found areas where it's running 16% copper. You don't find that every day. As I mentioned, we're in central Alaska, great gold potential, all for drilling and exploration. And then thirdly, we don't want to forget our last asset here in New South Wales, and it's Advanced Gold and Silver Project. It's had mining, it's got a study, feasibility study, it's got resources, it's got a reserve, and we're currently being free carried through that with a joint venture partner. Strong financial metrics, it spits out over $30 million free cash a year once it's built, a capital payback of just over a year, and at current gold prices that's under a year, and an internal rate of return over 100%. You won't find many projects like that. So look, I'd encourage you to have a look at the website, come and visit me afterwards. 5 great reasons, I think. I've touched on the jurisdictions. Board and management, also important. Thanks very much.
Brilliant. Thank you, Matt. Now we have Niranjan Peter, Marketing and Product Manager of Let's Join In.
Oh, didn't see that. Hello, everyone. As introduced, I'm the Marketing and Product Manager for Let's Join In. Let's Join In is a social media platform that has been created for organizations as opposed to users. So what that means is basically we've built a platform that focuses on the benefits for organizations, and these organizations are major content providers such as news and media organizations, sporting clubs, political parties, and other major content providers. And what we've done is build a tool that allows for deeper engagement, and that's through group discussions. Now that's patented. We've also got a unique revenue model where we share advertising revenue with them. So as discussed, it's a patented business process, and that's the group discussion model. It's also got rapid growth potential, as the virality of any social media platform can have that. It's a high margin industry because the revenue model is based around advertising or digital advertising. So what's the current landscape in social media? Well, there's a lot of people who spend a lot of time on social media. We've got low engagement from comment threads, and that's just because people don't really want to share or throw their perspective into these long lists of information. That information also doesn't really get back to the organizations that post that content. And what we find is that Facebook and YouTube, they favor user-generated content, and that means that big brands like ABC and Sky News all have to pay to get viewership. Last year, they brokered a deal which allowed them to, get some of that money back, but that was only a few of the organizations at the top. So as discussed, the content providers have to put 20% of their content onto these platforms. That number increases annually. When I first started looking at this product, that was around 10%, so it's actually jumped quite a bit. Investing in their own products probably doesn't work because users don't have the time to spend their time on one product. And social media continues to be quite greedy and, just take all the digital advertising funds that come through. They've also got biased algorithms that make it really, really annoying for you to get viewership. And for the users, as I said, do not really want to put their perspectives into these large comment threads, so they'd rather keep quiet. And because of mum and dad reporters or just people providing information in a free user-generated platform, you get a lot of fake news, right? You get people from down the road giving their perspectives, digesting reports, and that's not really good for society. So, the solution. So, obviously, our platform will give us deeper engagement through the group discussion module. All data is then shared with every organization, so they have the data, and that's theirs because they generated it. All the advertising revenue is also split, and that's done in a quite unique way. We've also combined traditional advertising and digital advertising to let them on-sell those ad spaces. So, the revenue stream for them is quite uncapped on this content. We've also got unbiased algorithms that are just really simple. If you're interested in news, you'll see news. You'll see news from Sky News, you'll see news from ABC News, and you can digest both and make a decision as to what interests you best. Now talking about the users, now they have a space, a dedicated space where they could go in and have these discussions in these small groups. It's one centralized platform where they can find authentic content, and they know they can trust it because it's brands that they know. And we've got strict bullying and harassment protocols that stop swear words, abusive texts, and stuff like that. We've taken the ownership of that, and we've built that into our business model. So this is the product. As you can see, there's a unique timeline per person that operates on an algorithm based on just general interest and engagement. You've also got various groups, so that's the groups, and it operates on like a traffic light system, which indicates if they're full or not. And as you can see, that's a discussion there. So the discussion can play picture-in-picture, or you can go and just read the article, watch the video. You don't really have to engage in the discussion, but the arrows there can allow you to bounce between groups. You can click the group and jump between groups. It's probably a bit hard to see, but that little ribbon in the corner, that shows you all the most liked comments, the most disliked comments, the most top-rated comments, the most engaged comments, and it gives you a big list. So that allows stakeholders, like the clients who create the content, to just scroll through and see what everyone's thinking, what's negative, what's positive. And that's what the political parties really love. This is a team. So Gibson Saladurai is in charge of technology, and primarily that's his role. He has got a background working with technology startups. He runs his own software development company. Geza is the guy who created or architected the concept of it. He births it, and he's the CFO for us. He basically takes on that role, and he also has been operating his own small business for 15 years. Myself, I'm the marketing and product manager. So I've got a background in marketing. I do marketing across multiple clients. Ranging from retail to startups to tech products, but I've also helped build this product. And Alan, he's the CEO. He's got a vast experience in sales and working with some of those media companies, plus he's also manned his own startups. So, the ask. Currently, we're in seed round, looking for funding. We're looking for about 800,000, but again, we only need about 20% of that to get past that critical development requirement. From there, we're pretty confident that we can get it into the market. So our first beta trial, because we're right now in MVP stage, we've got the United Australian Party on board. We're also working with the Australian Lottery Association, who are trialing this product within themselves. And more we're finding organizations that have got a high interest in this product. Yeah, and that's us. If you want to get in touch, feel free to find us over there. Ask me about the revenue model. Ask me about the business model in general. Happy to share as much information with you guys as you need. Thank you so much for your time.
Thank you so much, Niranjan. Up next, we have Jeff Yu, CEO of Monochrome.
Hello. Hello, everybody. So I'm going to talk to you about Monochrome today. So before that, I'll tell you about who I am as a person. So I'm a digital native, is what people call. I live, breathe, and eat digital assets for about 9 years now. My background, I founded Australia's largest and most liquid exchange, crypto exchange in Australia called Binance Australia about 3 years ago. So my passion is always about in this space, and today I'm going to talk to you about what has been my life over the past little bit over a year. So a bit of disclaimers, these are not constitute of any financial advice, so we're not trying to sort of advise you into selling of any of our products, so you need to read our disclosure documents before making investment choices and talk to your financial advisors if you have one. So about us, so who is Monochrome? So Monochrome is a digital asset investment manager. So we manage digital assets, or also known as crypto assets in Australia, in a regulated and familiar unitized product. We currently operate a managed investment scheme. It is offered like any unit trust. We buy the Bitcoin, store it for you in a regular custodian. It's properly insured in custody. We take away all the complexity of trading, the worry of custody from our investors. We recognize an industry problem pretty early on, is that this asset class is largely unregulated, at least until quite recently. With an unregulated asset and unregulated industry, what has been occurring is that a lot of investors have been trying to get exposure in their own way. So unfortunately, a lot of these offerings and a lot of these pathways are not yet regulated. Not that it's not all gloom and shady. It is just that industry is not ready to be regulated. But what has occurred is that we've assembled a team of traditional experts and also digital natives to create an investment experience that is actually fit for purpose for this type of asset class. We work very closely with the advice industry, the fiduciary industry, the advice industry are very close people that we work with, because we recognize that advisors are the white knight of this asset class. We ran a survey last year and the survey came back 77% of advisors in Australia has received inquiries about crypto assets in the past 12 months. And guess what? Only 11% of them feel equipped to respond. That's actually a very alarming number. So we want to equip advisors with the knowledge, the sort of the proper way to guide them into solving problems like PI, getting a rating for them, getting to the investment committee, talk to the APL committee, those kind of things, to help them be able to guide their clients that have been wanting exposure and will do it their own way anyway, to guide them through a safe and regulated structure. So we do have experience across traditional finance and also digital asset markets like me. The digital assetness of the teams kind of stops at me. The rest of the senior leadership of Monochrome is very traditional. They all have experience in even superannuation, in hedge funds, etc., etc. So what is this Bitcoin thing? So Bitcoin, as you all know, as you heard in the news, is that this is digital money, this thing that you can't see and touch, but it's somehow worth a lot of money. I'll go into it and what it is and why it matters in a very short time frame as I can. But this is where Bitcoin's significance in the world is right now. It's not too big, not too small. Again, it's a very nascent asset class. There's a lot of process and a lot of things that need to happen before mainstream institutional adoption can really accelerate. And within the crypto market space, you can see that Bitcoin is the dominant leader in terms of assets. The next one followed is Ethereum. Well, Ethereum is a very interesting concept and an interesting platform for smart contracts, for example. Very different from what Bitcoin is trying to do. Bitcoin is trying to be digital money, digital store value. It is a kind of like the early iteration of a lot of e-gold or tokenized gold projects in the 90s and the 80s that were trying to create this value transfer that can send, you can send value from one place on the planet to the other place of the planet with low fees and instantly. Bitcoin does this without a third party, which is even better. But why does it matter? Right? For now, we're seeing that Bitcoin, we hear a lot about Bitcoin. Some of us may have Bitcoin, we have bought it, we have invested in it, or our family and friends might have told us that they've bought it from here and there. So what are you actually investing in? What actually this asset is in its entirety? So the way I sort of use this is, I've sort of taken a bit of inspiration from Fidelity's recent report on crypto assets, and it talks about this structure of, the foundation, right? Bitcoin is the asset layer, is the foundation, right? It enables the network to actually run, right? Bitcoin, the protocol, and Bitcoin, the currency, is actually two different concepts, but I won't go into too much detail today. So what that actually means is that you have this decentralized system that can act as an arbiter, act as a court system that enables applications on top of it. What applications you ask? You can talk about payments, you can talk about Lightning Network, for example, and also the other sort of tranche of innovation and incubation in the DeFi, NFT, DAOs. They all exist in also a very different asset tranches. But the main takeaway for you guys today is that you don't have to know everything in this space. You just have to know that these things are different. Not all crypto are the same. Not all crypto are crypto. Right? Bitcoin, like I said, it's digital monetary asset. Ethereum is a leading smart contracts platform. They're both very distinct. So, and why Bitcoin? Right? Bitcoin, as I've gone through it, in the early days, we got all these versions of Eagle that have been trying to solve this problem. Bitcoin realized that the problem of that was there is the existence of an asset pegged to an external asset in the physical world creates a central point of failure. Right? You got companies that has to maintain the peg, companies has to issue units, almost like a unit registry kind of model when people buy and trade and redeem this token gold. So Bitcoin introduces this concept of let's remove that peg entirely and let the protocol take care of itself. Well, it introduces a very interesting problem is that because it's not backed by any token, it's very volatile. The market can't decide what it is worth today and in the past and in the future. So you create a lot of this volatility in this nascent period of the life cycle of Bitcoin, which is really interesting. So the pathways of Bitcoin is very distinct and very early still, but I'll go through the main few ways. So the first way that we have most heard about are exchanges or brokerages. So the pros is that they're quite easy, they're simple. The cons is that it comes with a lot of gamification because that's how exchanges operate. It's their business model. And also, they are still not yet to be regulated. I used to run an exchange. We've been trying to get regulation into the space for a very long time, but still, it is a nascent asset class, not ready for that yet. They're still working on it very hard. Self-custody is another option, is that you become your own bank, right? You take on the whole responsibility of the asset. And also proxy or MIS. Proxy is pretty much buying things that things that actually get exposure to Bitcoin, like a picks and shovels method. And where we operate as Monochrome is in the MIS and also exploring the ETF segment. Well, the pro is that it is an exposure that is pure, right? We don't trade the asset. It's a passive single asset exposure to underlying asset wrapped in a traditional structure. We give you, and let's not go through the portfolio, we don't have really much time here today, but it is a familiar unit structure. We got an investment grade rating from SQM recently. Custody is insured. We have transparent liquidity. So there's nowhere for us to hide any pricing in that offering. We're moving to weekly liquidity very soon, so make it more accessible. And also what is important is that we provide a lot of this reporting that your accountants and your tax lawyers and even yourself will be very appreciative of. I'm going to end the session very quickly by showing the team behind, this is just a few of the team behind Monochrome. I would implore you all to speak to me, come to us, send us any questions you have. We will definitely love to have a chat with you all. Thank you very much. That concludes my presentation, and I hope you guys enjoy the rest of your day.
Thank you so much, Jeff. Next, we have Pete Wargent, co-founder of Buyers.
Okay, welcome to our presentation. We are Buyers, the better way to buy property. So we are Australia's first and only national marketplace connecting home buyers to property buyers agents and to lenders. So just as mortgage aggregators have grown the market share of consumers using a mortgage broker from around 5% in the early 90s to 67% today, we're doing exactly the same thing, but in the property buying space. And the appetite for using a property buyer's agent has never been higher than it is today. We're getting very rapid traction. So our run rate has passed $2.5 million per annum. We're growing at around 20% per month. We've got over 9,000 subscribers, and we've got $1.5 million of deals in the pipeline, and we're growing very rapidly. Property buyers agents save consumers time, cost, and stress, but traditionally in Australia, buyers agents have targeted only the affluent home buyers and the portfolio investors. We're opening up the market with our lower cost alternatives. So the existing market, as I mentioned, fees ranging from $15,000 to $40,000 plus GST for a buyer's agent. A lot of consumers, particularly first home buyers, but actually most people just won't pay those fees. Our entry-level product comes in at around 1/3 of the typical market offering. So to date, only 3% of transactions go through a property buyer's agent, but we're opening up this massive addressable market. It's a very inefficient industry. Only around 55% of mortgage pre-approvals are ever converted into actual purchases and actual home loans, with the remainder lapsing as people give up in despair, or they can't find a property, or sometimes the mortgage pre-approval lapses. So there's tremendous benefits that we provide also to lenders, and we're in discussion with a number of major operators in the industry. So saving time, cost and stress, there's around 550,000 residential transactions in Australia. We also do commercial property. So we're opening up a huge addressable market here. The benefits to lenders and to mortgage brokers are obvious. We typically convert around 95% of engagement into actual purchases. Across the industry, it's only about 50 to 60%. So we massively increase the conversion rate of our referral partners, lenders, mortgage brokers, mortgage aggregators, and so on. We're targeting a market share of 5.8% of transactions within 5 years. That alone would equate to a revenue of over $450 million per annum. But there are many services that hang off the property buying process, ancillary services. For example, building surveys, there's property management, conveyancing, and so on. By far the biggest opportunity is in the fintech space to actually write the loans ourselves, which is a potential that we can do down the track. And of course, there's also international expansion opportunity above and beyond that. How we'll get to this 5.8 market share, 5.8%, in two different ways. We're running a sophisticated B2C digital marketing campaign comprising of Google AdWords, Facebook retargeting, and so on. That's being run by the marketing agency in Sydney, 303 Mullen Lowe. On the B2B side of the business, we're in conversations with a range of industry players in terms of building strategic affiliations. To date, we've built strategic referral agreements with a whole range of industry players, such as mortgage brokers, financial planners, and so on. Of course, our main target is to build an affiliation with one of the big four banks. Currently, we're targeting a clean list of over 10,000 mortgage brokers, a whole range of affiliates already signed up. We're also targeting over 6,000 financial planners who we have connections with. In terms of the team, I'm one of Australia's leading property market analysts and commentators. We get a lot of mainstream media coverage like 7 News, 9 News, also the serious financial media like the Fin and the Australian. I've actually run a buyer's agency for over 10 years with offices in Sydney, Brisbane and London. Our CEO and my co-founder Doran Peleg is a serial PropTech entrepreneur, formerly a Westpac executive. Our CMO Alison Solery, formerly a marketing executive with Citi. And Pritam, our CIO, has held a whole range of head of development roles, including Telstra and Coles. We've got a number of investors, shareholders from the tech firm Atlassian. A couple of them are on our board advisory, and they're really helping us to build out the sophisticated IT and tech, which is really our point of difference. We run streamlined, centralized processes with artificial intelligence and machine learning for screening clients, and this is what really reduces the cost, hence why we can significantly undercut. So we've currently got 25 buyers agencies buying right across the country, Sydney, Melbourne, Southeast Queensland. Our panel also covers South Australia, Perth, ACT, so we're buying right across the country, fully operational. Our run rate is over $2.5 million per annum today. By year 5, the revenue purely from property buying services, we're projecting over $450 million per annum by that stage. We opened a $2 million funding round. We were quite quickly oversubscribed, so we've actually got more than that now committed. We've changed the terms of the round to $3 million. We're also in early conversations about opening a much larger round later in the year of $6 to $8 million. We see a potential valuation of over $1 billion within 5 years, and that's purely based on our property buying services core business. But as I mentioned, there's a whole range of ancillary services which hang off the property buying process. So it's a vast addressable market and a huge investment opportunity. So if you're interested, please come and see us at the stand. Doron, our CEO and co-founder, is also here, and so is our CMO, Alison Solary. So there's a few of us milling around today. So do come and say hello. You can check out our website. It's buyersbuyers.com.au. We've got a suite of property tools that we make available to the market on there. And you can also contact us on the details there on the screen. So that's it for today. Thank you so much for listening. Look forward to seeing you at the rest of the event. Cheers.
Thank you so much, Pete. Now we have our first panel session of the day, Fundmakers and Dealmakers. So joining us today, we have Matthew Hyder, CEO of Legacy Property and Sterling Property Funds, Nick Rafferty, CEO of AltX, Lelda Smits, co-founder and executive director of the Capital Network, JB Liu, portfolio manager of the Tribeca Alpha Plus Fund, and Ryan Crew, partner and head of Australia at Altiv.
Hello, everyone, and welcome really to the exponential era of innovation. Today, I'm absolutely delighted to have fund managers and deal makers on the panel. These are experts in their industry, and I personally can't wait to hear the insights that they're going to give us, not only on their industries, but on financial markets and the opportunities that really exist at the moment. I'm going to start, though, by handing over to our fellow panelists and asking them if they can introduce themselves as either a fund manager or deal maker, and their roles, the focus of their current roles, because that will really give us some context on the discussion that we're going to have. So perhaps if we can start, Matthew, with yourself, if you can introduce yourself and your focus.
Sure. Thank you, Lil. Yes, Matthew Hyder. I created Legacy Property back in 2009. Over the last 13 years, we have built up a portfolio of projects. We're now delivering just under 4,000 apartments and lots across Greater Sydney. Over the last 13 years, we've delivered more than 16 projects, all residential development, so large residential communities in the West, as well as apartment projects in urban Sydney. In addition to Legacy is a company called Sterling Property Funds, which I founded a few years ago. We now have 4 funds. They have invested in industrial, non-discretionary shopping centers and commercial buildings across the eastern seaboard. Happy to report that each of the funds is outperforming our original forecast with an IRR of 22% versus our original forecast of 13%. In terms of my focus, I naturally support the group of individuals that really make it all happen at the office, but I guess my individual role is assisting with capital raising and, in a sense, from the deal-making standpoint, ensuring that the structures that we enter into are ones that really look after our future interests and protect us in the event of a downturn. And from a funds management standpoint, I really manage all of our investor relations.
Wonderful. And from a panel perspective, I think we can call you the property guy. And I know there are a lot of people that have been following. It's impossible not to follow the property market and what it's done, especially since the pandemic. So we're definitely going to be calling on some of your insights with respect to property. And Nick, how about yourself? Can you introduce yourself, your background and focus?
Of course. Thanks for having me on the panel. Nick Raffaele, co-founder of AltX. AltX is a managed marketplace focusing on first mortgage real estate investments. We've been going for a decade, founded in 2012. The business has underwritten and funded more than $2.5 billion worth of transactions. Currently, we manage a book of approximately $1 billion. And in simple terms, the focus of the business is identifying and funding with our own balance sheet first mortgage-backed transactions, which sit outside of the bank's quite strict funding criteria. And then once we've funded those deals, we take them and we syndicate them to a base of wholesale investors, like many people in the room. And the offering or the proposition to investors is they get access to an investment which pays a monthly income yield of 5.5% to 8%, and it's backed by bricks and mortar security of the actual underlying asset, as well as personal guarantees of the borrowers. So the marketplace really connects borrowers who sit outside of the bank criteria with investors who want access to this asset class of private first mortgage investments, but for AltX would not know how to identify, underwrite, vet, curate, fund, manage, etc. these transactions. As I say, we run a book of $1 billion, and that's represented by approximately 350 deals, so a very diversified spread of deals. My role, I'm co-founder, co-CEO, so obviously I was there at the beginning, and I guess I performed most of the roles in the business. Today, my role is primarily focused on business growth, identifying opportunities, obviously managing the team and making sure that the underwriting is tight. The key thing I would say that our business does is that we provide access to deals through our technology platform in a way that hasn't really been done efficiently in Australia before. So if you're sitting in Darwin or Perth or Wagga or Ballarat or anywhere in Australia, you get the same access to the same information and the same opportunities at exactly the same time as anybody sitting in Sydney or Melbourne.
Wonderful. So a deal maker with a technology platform. That sounds like a powerful combination. We'll be calling on your insights with that background. And Junbei, could you introduce yourself and your focus?
Of course, and thank you for having me. I'm, really privileged to be amongst part of really, great panelists. For those you don't know me, my name is Junbei Liu. People call me JB. I manage a, Australian listed equity fund. My fund is just over $1 billion. I'm probably the largest longshore fund here in Australia. I'm probably the longest running longshore fund here in Australia. We invest across pretty much all listed shares. Has some large cap focus, but we do invest all the way to, down to micro cap and the like, and that's where we find a lot of interesting stories and innovations in that space. Essentially it's a fund very leveraged to share market, and the purpose of my investment is essentially thrive to outperform the share market ASX 200 all day, every day, whether it's a down market, up market, growth market, value market, we look to outperform. And, the great thing about being long short, which means we can, take advantage of, market falling, is that, we can do that. And that is our key focus. And, that's our thing.
Fantastic. The stock market. That is something I personally love to learn more about. So I'm going to be asking you more questions about that. But finally, Ryan, if you can start by introducing yourself as well, your focus and background.
Great. Thank you. Everyone, my name is Ryan Crew. I'm partner and head of Australia at Altiv. So Altiv is a tech-driven alternative platform. We look to provide access to high-quality offshore and institutional investment funds. So we focus on a range of different asset classes within alts, so private equity, hedge funds, venture capital, property, and infrastructure. Our whole premise is that we want to democratize access to alternatives. Traditionally, if you wanted to invest in high-quality alternative funds, you needed $5-10 million, and you needed to be associated with a private banker or a broker. We're looking to use technology to provide better access, reduce the minimums, and make investing in alternatives easy for everyone. As a platform, we've been around for about 3 years, based in Hong Kong. We've been in Australia for just a little over 1 year now, and we have about 90 staff, predominantly based throughout Hong Kong and Singapore, and we have about $850 million on our platform, and that's across institutional managed funds, as well as direct deal flow.
Fantastic. Thank you for that introduction. Now, as you can see, we've got panelists that really are experts in their own field, but very diverse industries. So as we're talking about finance and we're talking about emerging trends, we're going to be asking them from their unique perspectives, their outlook, their views and their forecasts. I think firstly we'll start perhaps with an assessment of where we are now. We've just come out of, well, emerging from a pandemic. However, entering into a European conflict, markets have been all over the place, certainly with a lot of movement. I think it makes sense perhaps to ask Junbei from a financial stock market perspective, what's your outlook for the year ahead, and what have you seen of late, perhaps from the beginning of this year, and where do you see the markets heading in the year ahead?
Thank you for the question, and I think it's probably good to start with a long-short fund manager, where we, as share market, we tend to be very quick to respond to uncertainties, or I guess sometimes the greed and the fear get in the way. So share market is often reflective of what's happening in terms of mood of investors. Our view for 2022 has always been that equity market looks not too bad. It is going to be a year of transition, simply because interest rate was way too low. We had the pandemic, and we had, 2 years ago, we didn't know what sort of vaccination do we have, and we didn't know how the corporate might respond, and all these uncertainty. That's why we have all-time low interest rate and all these support from the central banks. So we knew 2022 was going to be a year that some of those easy interest rate is going to, increase around the world, and we have seen New Zealand's done so. We've seen UK happening, and US obviously is going to take place sometimes this year. But remember, over the next 12 months, even though interest rate is going higher, it is still going to be way below what it was before the pandemic. So remember, economic activity was pretty good before the pandemic. Where our interest rate is actually now below that pandemic by the end of this year, that means it is still very good for economic expansion. Now, putting aside that interest rate, economic activity is going to be above trend. Yes, it's going to be lower than what it was last year, because last year we're comparing to a almost zero economic output to the year before. So this year we're still looking at high single-digit economic growth rate for globally, for the US, for Australia, still looking pretty good. So with a above trend economic growth rate and with good corporate earnings, which we just had the reporting season, thinking things looking pretty good, and the interest rate still pretty relaxed levels. That's all pretty positive for the equity market. But of course, you had, the war that throw into the mix. Life is never as it is. Things always happen. Our view of the war is that at this point, assuming there's no expansion into other regions, equity market normally is pretty good in terms of dealing with geopolitical uncertainties. I'll give you these stats. Since 2010, every second year we have had major geopolitical issues. Now, S&P 500 in the US has barely made any dent with those geopolitical uncertainty, except, of course, when Russia went into Crimea, it went down 6%, and now with the current conflict, it has gone down more than 6%. So when you actually look at the share market performance, generally we cushion those sort of events pretty well. And if you look at the output of Russia and, Ukraine and things, it's not at this point having a significant impact. But of course, commodity is running. So that is something we're watching. But at this point, it seems that, it is easing on the way down, and, share market should be able to move forward to focus on the fundamental, which is actually pretty good for the Australian share market, because, our commodity is running very hot. Our country is going to make a lot of free cash flow, and that is going back to our corporates, which will pay back lots of dividend back to the shareholders. shareholders. So share market is looking pretty strong, and which is positive for the general economy because it's good for the confidence.
Yeah, I mean, that sounds very positive and very upbeat, in particular with the overwhelmingly negative headlines we've had everywhere. One word that you really said, of course, was inflation and inflationary pressures, and I'm sure we've all seen this emerge in the headlines. And the impact on property is something I'm very curious to learn more about. We have had record property prices and just climbing in recent years. What are you thinking about, in particular, inflation and the impact on property this year? But what are your clients and investors saying? Are they concerned or are they a bit more upbeat?
And I think that's a great question. And I'm approaching this from the perspective of you as investors. And I think in recent time, what I'm hearing from our investors is that they are seeing property in probably an even more attractive light than they were previously, partially because it is such a good inflation hedge. For example, in our commercial, retail, and industrial assets, as leases turn, you are able to pass on higher rents to your tenants, and that does allow for an inflation hedge. And so I do think there's a real perception from investors that hard assets that produce a yield where you can pass on rental growth is seen as an attractive proposition, especially when you have more uncertainty across the world right now. So I certainly do think that there's strong demand for it. I think the other element of it, though, is that we really have seen almost unprecedented demand for property for some time, and that has continued to drive cap rates down because simply the weight of capital has just forced many investors to want to put capital to use because the alternative is just so unattractive with commercial paper in the interest rate. So I think for us, it is in us, representing our investors and you as investors. I do think on the one hand, you should almost expect a higher rate of return because as interest rates rise, you should expect a higher arbitrage there. I think the reality of it is that you're not alone in that interest in buying inflation-adjusted assets that produce a strong yield. So in some respect, I do think that some of my more seasoned investors do say to me that they're, to be honest, happier with a lower return that is more stable, where it will protect the asset. So in other words, even more of a flight to quality in uncertain times. Yes.
Yeah, for sure. And Nick, when it comes to your technology platform and the work that you're doing with mortgages, what are you feeling about inflation? Are you concerned, or are you perhaps seeing the positive in it?
So, in terms of the opportunities we offer our investors, we always think about it from a capital protection perspective. So, just to frame the way an AltX opportunity looks, if an asset is worth, say, $1 million, we would advance a mortgage of, say, 65%, so $650,000. So there's a built-in buffer of 35%, $350,000 in that example. If property prices come down because rates rise and money gets sucked out and confidence erodes a bit, the value of the asset could come down, say, from $1 million to $900,000, and then implicitly the LVR goes up. But there's always going to be that buffer of headroom which protects the investors before any capital is impaired. So we feel very comfortable with our model, even if property prices were to soften because of rising rates, for example. The other thing is that our deals that we present to investors are generally short-term, 12 to 18-month deals. So we're not taking long-term market exposure. We're taking kind of rolling short-term exposure, which makes us comfortable too. But I would say, kind of stepping back from it all, I think to have a moderation in property price appreciation or growth, or even to have no growth or negative growth for a period of time is not a bad thing. I think nothing grows to heaven, including property. And I think you actually get social dislocation if prices continue to go up. I think you have a bifurcation between the haves and the have-nots. The rich get richer because they gear their property to buy more property. The poor are priced out the market because they simply can't get the deposit together to buy property. And I think you potentially generate longer-term social issues if property continues to go up and up. So from my perspective, the notion in Australia of property flattening or potentially even going down slightly over the next few years wouldn't be a bad thing. And I remember seeing it, for example, between 2003 in 2009, for example. Property didn't really go anywhere. People say property doubles every 10 years, but it typically doubles in 3 of those 10 years, and then for 7 it's up a bit, down a bit. So I'd be quite comfortable with seeing kind of a slowing down in the property market. I think it'd be good across the board. I think people have this idea that things go up forever, but they actually don't.
Absolutely. Markets go up and down. That's all of the markets. And Ryan, in terms of the year ahead, how are you looking at the impact of inflation in terms of how you do business and how it will impact what you're up to in the year ahead?
Yeah, thank you for the question. I guess for us, we are a platform which is aiming to provide the access to a range of different investment options. We don't take a view on inflation. We think that the self-directed investor needs to be empowered by having a range of different choices. For example, increasingly we're seeing a lot of clients move away from traditional Australian property investments and looking to move money potentially into other investments. That's where we see, an important part of what, the value of alternatives are. For us, we are still confident in the market. We think that inflation is going to be here to stay for quite some time at least. We don't think you can take all your money and put it into cash. That's not going to help you at all. So we think that the value of diversification is key. So for us, it's all about empowering people with the tools they need to make the best decisions.
Fantastic. Now, as I'm looking at you, I'm also seeing here showcasing the era of exponential innovation. So I think it would be amiss of us if we didn't ask these experts where they see innovation heading in the future. We've seen so much transformation occur so quickly in the last 2 years, in particular with respect to digitalisation. Junbei, what trends have really come into your sight as things that you find particularly exciting or accelerating, or things that are likely to take momentum in the coming months and years ahead? Mega trends.
Yeah, absolutely. Look, for the share market, the mega trends can last, from 3 months to 3 years. I must say the digitalization that you touched on is a big trend. We've seen it. The pandemic has driven that digitization. Everyone can work from home anywhere and everywhere. We see that to be sustained. We see, future workplace to be changing. Office no longer is just a place for people to sit in front of their computers and work, because you can do it at home. Offices space has become a place of collaboration. So are we seeing a lot of change like that? Now, I really think, so in terms of digitization, I think the future is that, we'll never go back to the way we were. So many, as funds management, we see companies all day, every day. I remember during corporate reporting seasons, we used to have back-to-back meetings, seeing those companies, and those company management used to travel all around Australia and around the world to see investors, and that is highly inefficient. And during the pandemic and up until now, everything's digital. We can have a Zoom conference with the companies and straight away, and company loves it. And of course, if you do want to travel, and there's still options for you to do so. And we've seen site tours done by drones that you can, if you want to see an office and the like, and you can send the drone around to do the visual part of it, and they're just being incredible. Now, these things are not likely to go. We're also seeing the proliferation of the digital payment space. Today's world, you go into a shop, there's probably 10 different ways you can pay for your things, and cash is probably the one that you're least likely to use because of pandemic and for the hygienic reasons. So the world is really changing now. For the share market, it's incredibly efficient in trying to price in some of those opportunities. At this point, the share market is going through a juncture where interest rate going higher and the commodity price is running. How do we price in some of these? But over the next decade or so, we will work it through. It's exciting to see now big part of ASX, ASX, Australian Stock Exchange, used to be heavily dominated by mining companies and banks, and it's very boring, compared to the rest of the world, like the NASDAQ and everything else. The innovation was very limited, but we have seen a sharp uplift in the last probably 3 to 5 years in terms of innovation. So the ASX is now actually, quite a large part of it is there's the healthcare, there's health Biotech, and there's other tech businesses, which is incredibly encouraging. And over the next 5 years, we should see those businesses mature and become the mega gorilla of the sector, if you like. So, we're very excited to see that taking place.
Can you give us some companies on your watch list?
Absolutely. This is actually a great time for you to be buying some of those high quality companies. Aside from the healthcare companies that sort of underperformed for quite a bit, like the likes of your old favorite CSLs and Cochlear, Xero is back to all-time low. And, while the earnings growing significantly higher than the rest of the ASX, these are the businesses now represent some significant deep value opportunity because the market is overlooking them, because markets worry about the short-term risk. Incredible amount of opportunities in the market.
Fantastic. On that theme of digitalization, when it comes to building a technology platform, it's really no surprise why it has taken off for you. But where are you looking to take this platform, and what opportunities are you looking to capture? Also, another one in there for you, where are you seeing the biggest demand for this technology platform?
Sure. So I think Ryan mentioned the notion of democratization, and I think that's something which the AltX platform does particularly well. So for example, when we present a deal for investment, whether you're sitting in Darwin or Broome or Wagga, Ballarat, Sydney or Melbourne, as long as you're onboarded and accredited as an AltX investor, you get access to the same information, and you have the same opportunity to invest no matter where you are in Australia, or indeed for that matter anywhere in the world. So technology's been an amazing enabler in that sense. It's efficient for everybody. It helps us to disseminate the info. It helps investors to make the investment, to manage their portfolios, et cetera, et cetera. I would caution, however, that one shouldn't get too lost in the technology. At the end of the day, we're making loans to people secured against real assets with the real value. We need to make sure that we know who we're lending to, that documents are correctly executed, that borrowers understand their obligations, that we've properly assessed our collateral. And the old sort of boots on the ground, understanding what a property is worth before you provide money, taking it as security. No technology platform can do that for you. The technology can help you to pull up the comps and quickly assess what it should be worth, or look at average rates per square meter or cap rates or whatever it may be. But at the end of the day, there's no substitute for that human judgment which says this is a good deal or this is not a good deal. And we've seen innovations across the board. So in settling transactions, for example, there's something called PEXA, which enables property purchases and sales to cross and settle instantaneously. So a couple of years ago, or maybe 3 years ago now, if you wanted to settle a property, you had to book a physical settlement. People turned up with bank checks at a room in the city at an appointed hour. If it was in a different state, you had to send an agent. Today that's all done electronically, and that's amazing. So there are these efficiencies, but I would caution that it needs to be matched and augmented with old-fashioned common sense investing principles. Otherwise, it's all going to go up in flames.
Absolutely. You've raised some very interesting points with property. I must say, from my perspective, property does seem as a more old-fashioned industry, one that's been around for a long time, perhaps that hasn't had the innovation of other industries. But Matthew, you may surprise me and tell me something different. What have you seen rather in the last 2 years? Any changes to the way in which property transactions are occurring and your business is growing? And looking ahead, how do you think digitalization will impact property investment?
Yes, I'm probably not going to surprise you on this one. In a lot of respects, property investing and property transactions and property finance hasn't really changed that much, I would say, in my career from that perspective. As he was just alluding to, at the end of the day, it is a relationship business. You do have tenants, you do have landlords, you do have vendors, and this really is still done the old-fashioned way in a lot of ways. We just settled 2 new assets last week. The amount of paper and signatures was enormous. Certainly PEXA has assisted. It's a fantastic initiative that the government finally got behind. But I frankly think a lot of our investors, probably not too dissimilar to yourselves, do like to harness technology when it improves your efficiency, when it makes it easier for you. But at the end of the day, you still do want to have a conversation. You still do want to have a relationship with the manager, and I think that goes a long way. So I frankly think in some ways, digitalization has been more pronounced in terms of our internal operations, more so than I think from, say, an investor and manager standpoint. We certainly use a lot more technology internally. We use something as basic as, Microsoft OneNote a whole lot more because some people are at home. We're obviously using Zoom and Teams a lot more. But I think from the perspective of investors and manager, that hasn't changed that much.
Well, and I feel like all of us being here is really testament to that, because we've seen these conferences that were run last year online, but what makes it most exciting is to be here and for those relationships to occur face to face. Ryan, I would love to ask you, when it comes to your investments, how digitalization has perhaps impacted them of late, and how you see it impacting the year ahead. What trends and what innovation will you be looking to capture to maximize your returns?
Yeah, so I mean, being a obviously tech-powered platform, similarly to the other groups here, we want to make sure that we create the easiest possible way for people to get access to their money. Increasingly, we're seeing the need to be completely digital. It's easy now. You can transact every aspect of your life via your iPhone. That's really changed, and I think the pandemic really brought that forward. So we're seeing a number of other clear mega trends in the market. Obviously, the rise of the metaverse and cryptocurrency. It's changing a lot of different things. In terms of how we're leveraging towards that part of the market, a lot of the single name deals which we provide access to are heavily in this part of the market. So via our platform, investors can get access to names such as SpaceX, which is obviously leveraged to the growth of the space economy, Discord and Epic Games, which are the entry point to the metaverse, Impossible Foods, which is a leader in alternative diets. So for us, it's just getting access in the easiest possible way, and we think technology is the best way for clients to, I guess, get access. And just the other point I want to make is that I think the great thing about technology and digitization of investments is that it's allowing investors to look outside of Australia. I think that Australians have a overwhelming bias to local assets, and I think that that needs to change, because there are some fantastic opportunities outside of the country.
Fantastic. Now, I can't believe we're almost up. We've got about 60 seconds remaining, so I'm going to ask every panelist my favourite question. And perhaps, Ryan, starting with yourself, what are you most excited about when it comes to investment in the year ahead?
Look, I'm a millennial, so I'd say it has to be things to do with the metaverse and cryptocurrency. I think it's really going to change a lot of very old school industries, and it's really, really going to create some huge money-making opportunities. So I think people need to read and continue to learn about that space.
Brilliant. And Junbei, what's exciting you with financial markets and investing this year?
Oh my goodness, it's going to take longer than that. What's really exciting at the moment is, I don't need to take too much risk. So literally, I can buy some of the highest quality companies listed on the ASX at very, very cheap prices. Now, last time I saw this was when pandemic took place, when the share market went down 30%, and I saw opportunity in those, but they recovered within weeks, pretty much, in terms of share price. Now we're seeing it again. So it's incredibly exciting. 6 months ago, we're actually thinking, you really have to push the envelope to buy some of the high quality company. Now they're pretty much 30-40% cheaper than what it was. So, it's really exciting to see that.
That is very exciting, getting something on sale. And Nick, how about yourself?
I'm excited to see how in our business we can use technology to delight our investors, to do things for them that's never been done before.
Brilliant. Innovating every day. And finally, Matthew, property. What's exciting there? Many things, but I want to know what excites you.
Thanks. We do invest across all 4 asset classes, and I have to say that I think the amount of investor interest in residential investment is likely to increase significantly, as frankly across Greater Sydney, the lack of supply of housing is really going to reach quite a crushing point over the next few years, and I think that's going to create strong returns and higher prices, and that's going to really facilitate, I think, a lot of investor interest in the residential sector.
Fantastic. Thank you so much to our amazing panelists for all of the excitement, all of the investment analysis and the outlooks for the year ahead. I hope everyone's gotten a lot from this. And yes, please give them a round of applause. Thank you very much. Thank you.
Thank you so much for coming in, everyone. What a fantastic lineup. So we now have another afternoon break. Please enjoy some more conversations, and we will see you for some more presentations after the break. Hi everyone, welcome to our last section of the day. I hope everyone enjoyed a coffee or a tea. Next we have, to start our session, Daniel McGrath, CEO of XCEDA Capital.
Hi, good afternoon everyone. My name's Daniel McGrath and I'm the CEO of XCEDA Capital. XCEDA Capital is a fund manager and non-bank lender. We have operations in Australia and New Zealand, and I'm here to talk to you today about a new fund that we're about to launch. So we're an income-based fund, so we're a yield fund. So we're boring old yield. I've been outside just having a look at a lot of different presentations, and there's a lot of exciting equity plays, but we're just boring old yield. So as we say to investors, hopefully we can play a part of your portfolio to give you some yield income, whether it be monthly or quarterly, or depending on what your needs are. So As I said, our operations are across Australia and New Zealand. So in New Zealand, we have a non-bank deposit-taking licence, which is the equivalent of the Australian ADI. So we're a retail deposit-taking licence, much like a small bank. So on that basis, we've been operating for 30 years, taking retail deposits from New Zealanders and deploying those funds into lending. Our lending in New Zealand is across all forms of lending. So we do consumer loans, we do SME finance and mortgages. In terms of the business itself, because we are regulated by the Reserve Bank, we have a rating agency that we're required to be rated. But in terms of our history, over the course of the 30 years, we've had great success in providing our investors with a stable, consistent return via term deposits. So we're much like a bank in the sense of the product we offer. And as I mentioned, we've had almost 40,000 loans spanning almost $500 million of lending. So we've got a very good track record in terms of our credit operation. In terms of XCEDA Capital Australia, we're based in Brisbane. So in 2018, we launched XCEDA Capital Australia as an investment manager with an AFSL, a wholesale AFSL. We currently have two funds that we operate. One is a property management fund that develops NDIS housing programs. The other is a select mortgage fund where we marry up investors with specific mortgages. What I'd like to talk about today is a pooled mortgage fund that we're launching this month. In terms of the fund, I'll just go through the basics of the fund. As I mentioned, it's a new fund that we're establishing as a pooled mortgage fund. On that basis, investors are collectively pooled, and all of the assets of the fund, which are mortgages, are originated and managed by XCEDA Capital under our AFSL. It's a unit trust that we've developed. It's got two classes. Class A, which is the generally available unit class to wholesale investors. We've also got a Class B, which is has to be at all times at least 5% of the fund, and XCEDA Capital, as the manager, will invest initially into that 5%. So that gives us the skin in the game that should give investors comfort that we are looking after your money as we would ours. It's a $20,000 minimum investment, and you can select investment terms for 12, 24 or 36 months. They are fixed term investments, so it's not a call account as such, so they are fixed terms, and we price the return on that basis. So the Class A, which is available to the wholesale investors, is seeking to achieve between 5.5% and 7% per annum return. The rate at which we set the interest rate for the investor depends on the term. So we're launching the fund with 12 months at 5.5%, 24 months at 6.5%, and 36 months at 7%. As I mentioned, the security for the funds will all be deployed into mortgages, which I'll explain a little bit about on the next slide. It's obviously only permitted, as I said, to wholesale investors, not retail investors under our AFSL. We have a target fund size to get to 50 million within 3 years, which is very comparable to the success we've had in New Zealand over the last 3 years in terms of the growth of our mortgage book. I've got a slide here that might be a little bit hard to see, but just to talk through in terms of the fund allocation, in terms of the security, but also in terms of the yield that we're able to achieve from borrowers in order to be able to pay investors. We have a fund allocation where the majority of our lending will go into first mortgages, and the blue part of the pie is first residential mortgages. So these are typically residential dwellings that are owned by investors who can't get bank funding or who are, quite frankly, outside of their parameters with the bank. Or it could just be investors that really would like to act in a swift way, and sometimes with investors and their banks, banks don't move as swiftly as what potentially a fund like XCEDA can move. So a lot of these investors will buy these properties to hold. So as I said, the blue part is generally residential, is the biggest part of our portfolio. We do first mortgages on bare land, but I would say that bare land is residential bare land, so no industrial land. We do have an allocation, a small allocation in our fund to do second mortgages and also caveats. They're typically lower volume loans. So with our first mortgages, we can go to 2.5 million, and with our second mortgages and caveats, we can only go up to 350,000. We have a lot of success in managing second mortgages and caveats in our New Zealand business, and we have done in our select mortgage fund here in Australia, because we understand the risks associated with being second ranking to a bank, and we're comfortable with the risk that we would take on that. In terms of the funding, moving across to the yield allocation, As a bridging mortgage product, so typically our mortgages are between 6 months and 3 years for investors who are using that funding for a purpose, whether that purpose be to enhance the section, whether it be to just hold and flip. Because of the short-term nature of the mortgages, we are able to attract a higher yield than you would otherwise in an owner-occupied property. So as you can see there, our first mortgage rates that we're charging to borrowers are between 7 and 8%. We do take an establishment fee on that. Our second mortgages and caveats obviously attract a high rate to the borrower, which can get up to 14 to 15%. In terms of the yield that creates or the revenue that creates for the portfolio, if you go back to the pie chart, we're trying to allocate the risk associated with those loans, but trying to attract as high yield we can within that fairly conservative risk profile. In terms of the funding stack, it's very straightforward, as you can see there. As I mentioned, the Class B, which is the junior, will be taken up by XCEDA as the manager, and other investors have the balance of the fund. In terms of the rationale for the fund for investors, we are seeing a general bank credit tightening in the market, as you would all see. We're seeing a lot of customers that are coming to us that we think would be bankable that otherwise are not getting bank facilities, particularly around those investors who may have 3 or 4 properties, and the bank might be uncomfortable with those people having more lending from that particular institution, so they would come to us. There are also general bank credit tightening factors involved. We're seeing a lot more compliance come into the banking sector. That creates a significant opportunity for non-bank funders like ourselves. Obviously, there are certain compliance policies that we have to adhere to in terms of anti-money laundering, etc., and we do so under AUSTRAC, under our licence, but certainly the overbearing, I would say, credit policies that are attributable to a bank are not applied to us, therefore it does create an opportunity. There are also other bank factors around central bank policy, such as the macro potential tools that banks are imposed. It could be LVR restrictions, it could be debt to income ratio allocations. Those types of macro prudential tools are creating a lot of hindrance for certain types of borrowers in the market. And obviously, as a non-bank in Australia, we don't have those type of macro-prudential tools. Therefore, it gives us certain flexibility that is not available to the banks. In terms of the NIM or the net interest margin, I briefly went into that in the slide prior. We're able to create a revenue base for the fund based on that security that gives us an ability to pay back those investors those returns. There is obviously, we've got to make sure that we're always profitable. So in us being able to create an inherent net interest margin on NIM on our investments, we're able to give investors the confidence, but quite frankly also the track record, to be able to keep meeting the target return rates for investors. In terms of historical performance, notwithstanding this is a new fund that we've created, we have over 30 years as a group in terms of our track record in managing these types of loans. And it's not just about getting the loans out there in the market. For those in the credit space, they understand it's one thing to get the money out, it's another to get the money back. So, we have a very proud track record over our 30-year history in New Zealand. We also have a good track record in Australia in terms of the personnel that we have on our credit committee in Australia, which I'll get onto in a moment. In terms of the actual track record on historical performance on these types of loans, mortgages inherently have a very low impairment rate. So our business in New Zealand, with over 50 million in mortgages that we've raised over the last couple of years, we've had a 0 impairment rate. So in this type of lending, done well, done properly, managed well, there is a low impairment rate. In any event, as I've illustrated earlier, the manager is prepared to put out 5% of the total fund, which we believe is sufficient to give investors comfort of our track record and our capability. Finally, just in terms of the key staff, my partners in XCEDA Capital in Brisbane are 2 founders, Jim Cray and Ross Stiles. They co-founded Cromwell Property Group, which is a listed property trust here in Australia. It's got over 2 billion of market cap, which these 2 gentlemen founded. So they provide a great deal of oversight to our business as credit committee members. They're also my co-shareholders. In terms of myself, I have a background as a lawyer. I worked overseas in financial institutions in London and Singapore, and also worked in Challenger Financial Group here in Sydney in their funds management division. So look, that concludes my presentation. As I said at the outset, we're very interested to talk to investors that want to have some part of yield in their portfolio, and we're very interested in talking to you about the new fund that we're launching in Brisbane. And by all means, please ask any questions if you feel free to do so. But certainly I'm over at booth number 18, so please come along and have a chat.
Thank you, Daniel. Up next is David Baker, CEO and co-founder of Issuer Pixel.
Hi, this is David Baker. I'm CEO of Issuer Pixel. Issuer Pixel is a B2B video, audio sharing, and networking platform connecting companies to the world. The problem for companies is there's no video audio platform that's indexed and company and industry specific. Companies don't have a centralized media library to structure and organize their video and audio content. They have difficulty being found, and there's no economic way to achieve or measure visibility, which is critical to all companies these days. For users, the problem is they don't have a video audio platform to efficiently find content, video and audio with relevant and congruent results. Conducting diligence on site with planes, trains, and automobiles is expensive. It's challenging to communicate with companies directly and difficult to identify exact comparables at a granular level. Here's an example of a use case looking at YouTube and Google Video. In this case, we're looking for jet fan companies. The results tend to be disparate and irrelevant. In this case, looking for jet fan companies, there's one company from Pratt & Whitney that has a video that's relevant. The rest are not. It's just noise. And this is a problem throughout platforms like YouTube, Vimeo, etc. It's an issuer-specific problem. It's an industry size problem. And again, results tend to be disparate and irrelevant and incredibly time-consuming to find that which you're really looking for. The solution is Issuer Pixel's B2B video audio sharing platform that actually indexes video and audio, delivering accurate and congruent results. If we look at indexing on our platform by the numbers, we have over 125,000 industry categories, 70 different search criteria, approximately 1,250 fields within the search criteria, and this equals approximately 8 billion combinations for video and audio, and it's only growing on our platform daily. This is an example of our production homepage. You can take a look at categories you probably haven't seen before elsewhere. So we have categories of shared community research, trending in aerospace, reporting, and not public trading, field programmable gate arrays. Again, we have billions of combinations here, and you can search for that which you're looking for. And in this case, on our production homepage, you can see unique categories of video and audio. Our platform has 4 major functions. They're video audio library, video audio database, company-to-company communications, and visibility services, ways to provide visibility to companies and to distribute visibility for video and audio and distribution of video and audio. This is an example of our video audio database. You can see at the top there are tabs with different characteristics and different types of categories to search through: industry, company characteristics, video, audio, media types, fundamentals, market, technical, social. You can search for any combination or permutation of filters and have results that are delivered with the appropriate video and audio media content that meets your filter criteria. We believe this is the most sophisticated video audio database in the world. Here's an example of a video audio profile. As you can see, there's a video audio library of the company and then company details on the left-hand margin, looking at their profile. Our market size is approximately $130 billion globally and approximately $4+ billion in the United States, $2.5 billion for the company market, $1.4 billion user market, and $900 million corporate video sharing ad market. Our business model: freemium for companies, freemium for users, promotional services, which is visibility and distribution of video audio content, and then licensing and advertising. We have patent pending technology with one patent issued that deals with self-building, hierarchically indexed multimedia database. We have 3 patents pending and 5 more patents planned, and we're using an omnibus strategy, so it's a family of patents, and each patent is related to the previous one. Our competitive map, take a look at the y-axis, abundant video and audio content. At the top, at the bottom, scarce video and audio content. On the x-axis, all content to the left, company-specific content to the right. Companies like Google, YouTube, Dailymotion, they have an abundance of video audio content, but it's not company-specific and industry-specific. At least it's not easy to find. In contrast, in the lower right-hand corner of this map, you can see companies like PitchBook and Crunchbase. They have a lot of company and industry-specific content, but no video and audio. Issuer Pixel plans to be the leader in abundance of video audio content that's both company and industry-specific. This is a platform comparison slide. As you can see, companies like LinkedIn, they do B2B networking, individual to individual, whereas Issuer Pixel is company to company. We have a media database, which other companies have. However, Issuer Pixel has a multi-factor, industry-centric video audio database, which allows to search for combinations and permutations of filters and criteria to get the video audio results you're looking for. And we can index any media or data, video, audio, articles, news, etc. Our roadmap, we started the company back in early 2020. We got to beta within approximately 17 months. We're in beta now. We have 75 company customers on platform. We expect to open the front end of our platform in July of this year and generating revenue in December of this year. Here's our growth and revenue forecast. This is really a year 2022 of beta. As you can see, when we launch charging and revenue generation at the end of December 22, early 2023, we believe our revenue and growth will ramp fast, both in companies, users on platform, and revenue itself. Our leadership team, myself, I have experience on Wall Street for 30 plus years and have had successful exits. Our CIO and CTO, Vadim Tarasov and Byron Kwok, they have years and years of experience owning and running their own software development firm. All of the leadership has a lot of experience. Use of proceeds, we're raising $3.25 to $5 million for our Series A financing. As you can see, the use of proceeds is fairly spread out evenly between platform design and development, proprietary content, and sales and marketing. Obviously, sales and marketing is the greatest expenditure of our capital, as that's what we think we need most to achieve scale. Ladies and gentlemen, thank you very much for listening to our presentation. You can find more information on Umbrella or at wholesaleinvestor.com. Alternatively, you can email me at dnb@issuerpixel.com. David Nancy Boy, dnb@issuerpixel.com. Thank you very much.
Thank you, David. We now have Toby Chappell, Head of Trading at Zerocap.
Is this on? Yeah. My name is Toby Chappell. I'm Head of Trading at Zerocap. So we're going to talk about crypto. So it's exciting times for the industry, but also a lot of differentiation. Probably what you've heard today is a lot of retail exchanges talking about how they go about giving you access to the coins. At Zerocap, we're more of a private wealth, private banking model to deliver different attributes of the crypto space to our investors. We mainly deal with high net worth, family office, and institutions, and we bring across a wide range of services to those institutions. For example, we have full institutional custody of your assets. We hold them on our platform. We shard the keys around the world. We're fully insured with Lloyd's of London. We have yield and asset management products that you can invest in via unit trust structures. We are fully backed by the Victor Smorgon Group, one of the largest family offices in Melbourne. We are now bringing to the street structured products and the way that normal traditional capital markets have attacked some of the problems that we face in crypto. And what are the main problems in crypto is, after you've decided you want to invest, is the volatility of the space, right? The bottom graph here shows the maximum drawdown from equity high from Bitcoin. Now, numerous times the space has fallen over 80% if you time your investment wrong in this space. It has around 8 to 9 times the volatility of just normal equity markets. And what does that mean for you, right? If you lose 80%, it's going to make you try and make 400% to try and make that back. So what we have is we're bringing some traditional investment banking products to try and cure this volatility for you. There's a big institutional dilemma about how can you put this to your portfolio. For example, if you've got too much volatility, you have too much downside risk. If you don't have enough volatility, you don't have the non-correlated benefits to the market. So one ways we attack this is by curing the volatility. We have tools at our disposal to accurately control the volatility of Bitcoin. One of the ways we do it is through a product called Smart Beta, which accurately maps the volatility of Bitcoin to 14%, which is equity market volatility. Now, what this means is that you will now have in your portfolio the same exposure to Bitcoin, but with the same drawdown profile of the equity market, which is approximately 20%. So this is a very risk-averse way to get access to the premium without worrying about this major drawdown loss in your portfolio. But more importantly, and even more excitingly, is how to attack it via structured products and take advantage of the volatility. We've spoken about, there is a lot of volatility in this market, but what you probably don't realize is that the derivatives market since June 2021 is now greater than the spot market. And this is a normal progression of any financial market. So the futures and options market have now more volume going through it than the spot. And that means we can now attack the space with the same level of sophistication that normal investment banking and hedge funds position their trading. So what this is really telling us is that we can put together multiple products that have a better risk-return relationship than just going directly to buying the spot market itself. Also, just talking about the options market itself, there are a lot of very unusual characteristics with it. Number one is that the implied volatility, that is the amount that people pay for that type of insurance, is far greater than the realised, i.e. what actually happens. And that means that because it's retail driven, we're getting a lot of people paying way over mathematical models in the option market. So let's talk about how we can try and use these markets to give you a better risk-return trade-off. One product we have is the yield entry notes, right? Where we basically go, and instead of you going to the spot market today and buying Bitcoin, we'll go into the market and sell a put option for you, maybe 15 or 20% below the market. What this means is that you get a win-win situation from doing that. Because the volatility is the major price in options, if the market rallies away from below 15% from you, you will generate 22% per annum yield paid into your account in US dollars. Now, if the market falls and you are long 15% below the market, you should be happy about that because it's 15% below where you want to get in today, plus you keep this yield. So what we have now is a smoothing function and utilising the yield attributes of the option market to smooth your entry and exit into the space. Yield entry notes on Ethereum as well, you get even more yield because there is more volatility. The option market is just an insurance market where it's pricing the likelihood of these things happening. So the amount of yield we can generate without manager skill, without timing, without normal hedge fund type investing, all we're doing is selling optionality here to make sure that you enter and exit these markets at a better price. Also on the top side is very popular as well. So we can sell a call if you're long the position. We'll go sell a call 15, 20% above the market, and we can generate you 24% per annum. Now, this is in a world with zero interest rates right now, right? So we're offering these exceptional yields just from taking advantage of market participant behaviour. And so in this type of product, if the market rallied above 20%, you would sell 20% above where it is now, plus you would keep this yield. If the market fell away from where we sold the call, then you would just keep that 24% in in US dollar terms. So what this does is just allows you to enter and exit the market in a more thoughtful way and handle the volatility and take advantage of it in your portfolio. We, of course, do this on Ethereum as well, and of course, you get more yield for doing that. So also what we do is, because we kick out such high yields from this market because of the volatility, we can package this up to keep on rolling these notes for you again and again and turn this into an income and growth strategy. This, what I'm showing you here is if we just compound 25% a year, again and again and again, you start getting amazing returns after 3 to 5 years, right? Just from the yield aspect and also being long the coin. We can also have a lot of clients in the family office networks that need cash flow. And so we can turn these type of products into a glorified cash management strategy where we just kick out income every single month in the region of 25 to 30% a year, right? So, and once again, this isn't magic. It's just because the option market participants are paying way more than what they should, and the inherent volatility in the crypto assets. So we're just saying there are different ways to attack the space than just going directly and buying these coins and handling the volatility up front. We also do a lot of sophisticated stuff now, taken purely from the traditional investment banking markets and throw it onto the crypto. One of the ones we're launching soon is the principal protected notes, whereby you will participate in the first 50% of the market rallying, and if the market falls away, you get your money back. So you will in effect have a risk-free type return structure to play the top end of the market without losing any money. We sell puts, we buy calls, we do all sorts of really cool structures now that you may not have known the sophistication that can happen to it. So, as I said, at Zerocap, we're not a retail exchange. We're just high net worth, family office and institutional flow. We have very, very sophisticated custody solutions for you. And we have sophisticated ways to manage your risk profile. So it's worth considering before entering the market what maybe some of these risk return parameters may affect your portfolio. And thanks very much for your time.
Thank you, Toby. Up next is Damien Champs, all the way from New Zealand. He is CEO of Orbis Diagnostics.
Hello. So my name is Damien Camp. I'm the CEO of Orbis Diagnostics, and we're bringing lab quality diagnostic testing to the point of patient care. So we're seeing a significant shift in the global healthcare industry currently, and that's been driven by a number of different factors. Vastly improved communication technology is one of them, but also a significant acceleration caused by COVID. And as a result, we're seeing a huge growth in the global telehealth industry that is picked to reach $636 billion by 2028. And that's at a CAGR of 32% between now and then. And as a result, we're seeing a whole bunch of new companies being spawned out of this, including Doctoroo and CoView in Australia. And the Morrison government recently has contributed $106 million to support that telehealth industry and make it more permanent. A significant factor for this virtualization is the drive towards customer convenience. And it's that convenience factor which is also driving other changes in the sector, including the development of concierge health and providing wellness services outside of the traditional channels like the GP clinic and offering them in the pharmacy clinic. Key factor here, though, is that 70% of the decisions being made in that primary healthcare sector still rely on physical diagnostic testing. So as a result of that, we're seeing a significant growth in point of care diagnostics, picked to reach close to $100 billion by 2030. However, a lot of those point of care diagnostics, the innovation in that space is around handheld devices, rapid strip tests, more qualitative than quantitative type results, which you can do less with, so simple type of tests, and they do not address the more complex biomarkers. Measurement and diagnosis around those more complex biomarkers like hormones and antibodies has historically been quite cumbersome, and that's because they involve a full venous draw of blood by a qualified phlebotomist carrying a big needle, which most of us don't like. It also necessitates lab-based testing on very expensive equipment with highly trained technicians. And that sets up quite a complex logistical chain between the time of sampling and the point of sampling and consultation and presentation of the results to the patient. So that's expensive and time consuming, and generally out of reach of a lot of use cases and not that practical for industries like telehealth. So we've looked at that and we've developed the Orbis Arca, which is a miniaturized serology lab. It's a combination of photonics and microfluidics, and it's split into two parts of technology. The first is the Arca unit itself. So that is a lab quality desktop sized instrument. It generates accurate and quantitative results. It's automated, which means it can be operated by non-medically trained personnel. And it's minimally invasive, so gone is the big needle and in comes the finger prick of blood. And it's multiplex, which means on the disc we can run 8 different samples for the same type of test, or we can run 8 different tests on the same disc for one patient. And it's rapid, so we can generate results within 15 to 20 minutes. Second part of the technology is the microfluidic disc, which I'm holding here and you can see in the foreground there. So the microfluidic disc is the consumable of the system. It's the heart of our revenue model. So once the Orbis Arca is installed in the sales channel, we'll continue to sell the disc on a high volume, high margin basis. The other important factor of the disc is that it's multi-configurational. So by simply changing the reagents loaded or pre-loaded into the disc, we can test for a whole range of different things and cover all the large testing criteria and all the various types of tests on the market. The beauty of that is that we can focus on those more complex biomolecules, which our competitors find hard to deal with, but we can do the more simple tests as well, which they do, so we can encroach on their market. In terms of our competitive advantage, if we split that between, is this going okay? Bouncing in and out. Accuracy of results and scalability. If we lay out the competition, we've got in the top left-hand corner the lab-based, traditional lab-based assays, and the bottom right, the traditional or the emerging speed or high-speed, high-throughput, less accurate rapid strip tests. And through the comparative work that we've done, particularly against the lab-based assays, we're as quantitative and as reliable and accurate as those lab-based assays, but as scalable because of our multiplex factor as the smaller handheld rapid strip tests. Our partnering strategy is to partner with the big companies driving these fundamental changes in the industry. Our first partnership was with IDEMIA. IDEMIA is a large multinational based in France. We're working with the Australian office. IDEMIA is focused on biometrics, and with IDEMIA we're developing health data that IDEMIA is combining with identity data so that you can own your own health data and distributing that through various channels. We've also got a partnership with Green Cross Pharmacy Group, Green Cross Health in New Zealand. Green Cross operates 357 pharmacies and 45 medical centres throughout New Zealand, and it's with Green Cross we'll be launching our first product next month, which is very exciting. So first revenues. And from an engineering perspective, we've partnered with D&K Engineering in San Diego, who have got a long track record of working with some of the biggest well-known companies in medical device industry. So our first product on the market, which we're launching with Green Cross next month, is a quantitative COVID immunity test. So using our technology, we can measure quantitatively the level of antibodies in your system as a result of vaccination or exposure to COVID, and therefore what your relative level of protection is. 2022 is going to be a big year for us, as I said, hitting our first revenues with our Green Cross release and developing additional tests beyond that. The next test is going to be a celiac test for celiac diagnosis, again rolled through that pharmacy channel. We will be filing our FDA EUA emergency use authorization application in this month and our TGA full application later on this year. Our team is underpinned by our 3 scientific founders who are still very active in the business. Professor Cather Simpson, who's a director, and Matthias and Professor David Williams, who are on our management team. Just of note, David Williams he headed the team at O'Leary that developed the world's first digital home pregnancy test called Clear Blue, so he knows the space very well. And we have launched a $15 million raise, New Zealand 15 million, about 14 million Australian. We're about halfway through that, having raised $8 million, and it's on a pre-money valuation of $31.2 million. And we're using the funds to ramp the business up and for our market entry and our regulatory program. I'm here today, we're on booth 28, and I'll be walking the floor tomorrow as well. So please approach me if you have any questions. Thank you very much.
Thank you, Damien. Up next is Tim Demetrio, CEO of PencilPay.
Hear that? Okay.
Tim, the CEO and co-founder of PencilPay. PencilPay is growth software for product suppliers. Let me tell you quickly about the problem that we're solving. So, you walk into a cafe. Does this work? There we go. You walk into a cafe, you buy a coffee, and you pay for it before you leave. But if you think about the guys that supplied the coffee, the milk, and the takeaway cups to that cafe, they won't get paid for 7, 14, anywhere up to 30 days. It's called trade credit. And every year in Australia alone, you've got tens and thousands of small and medium-sized wholesalers that are selling 1.3 trillion worth of goods to other businesses on credit with zero expertise in running a credit business. If you think about a personal loan application, there's a few requirements. So you'd usually have to provide 100 points of ID, you'd have to get a signed contract, the bank would want to perform a risk assessment, you'd have to provide a personal guarantee, and you'd have to provide a bank account to debit those repayments from. You'll notice that all of that is done at the point of application. Now let's look at the application phase for trade credit. It's a paper-based form. It's usually a PDF that's printed out, filled in and scanned back. The information is impossible to validate. They're long, they're repetitive, they miss signatures, they miss information, and there's no payment method required. Now, how do I know all this? Because I was on the customer side of this. So in 2018, I took over a cafe that had about 20 different suppliers, and when I took over that cafe, I had to fill in and sign 20 of these paper-based credit applications, which took literally the entire first month of having the place. Now, I was pulling my hair out, as you can see, and then Greg, my friend, came in, who's now Greg, my co-founder, and he came from a very strong software background, having done and built platforms for the likes of Bunnings and Aesop and Holden. And we got to talking, and the more and more that we were chatting, we realised a few things, that even though 90% of all SMEs were already using cloud accounting and cloud inventory systems, and e-commerce was absolutely exploding at the time, credit applications hadn't changed in 20 years. And no one was meshing credit applications with payments. Now, to have a look at the type of impact that a platform like this can have, you can look at a business called Practice Ignition, which operates in the accounting sector. Now, they launched about 10 years ago. Since then, they've amassed 5,000 subscriptions or 5,000 customers. They process $1 billion a year in payments, and they've got net monthly revenue of about $2 million a month, and a valuation recently of $330 million. Now, what they did was they fundamentally changed the way that an accountant would engage and bill their clients. Pencil does the exact same thing, but for product suppliers and their wholesale customers, where a customer completes an online contract, they give security or a personal guarantee, and they provide a safe payment method for auto billing. And so far, PencilPay, we've onboarded about 2,500 signed buyers, and we've had 17% month-on-month growth for 2021. And that is really fundamentally what drives our business model, where a supplier pays a monthly subscription fee, and then as a supplier uses the platform, they onboard more and more of their customers, and as those customers onboard, they process more and more payments, which means that the revenue that we earn from each supplier actually compounds over time. The next thing I want to cover is our moat. Now, we know that as soon as a supplier onboards 5 or more of their customers, they remain on the Pencil platform 100% of the time. We haven't lost one customer that's onboarded more than 5 of their customers. The time and cash flow implications of switching are just too great for that supplier once they're on. Now, we've managed to carve out a really nice niche for ourselves in FMCG, alcohol, health, and clothing and apparel. And as you can see, the growth there month on month, that covers that 17%. In terms of how we expand and how we grow this platform, we're just going to do all the things that we've been doing over the last 12 months, but we need some funding to put it on steroids. The one thing we're going to add to that is a podcast, which you can find at www.pencilpay.com/news. Please check it out. Now, where's all this going to take us, all this growth? We need to get to 2,200, in 4 years' time, we want to get to 2,200 suppliers, each processing 50 transactions per month. That gets us to 1.32 million net revenue monthly, or a little under 16 million annually. And what does that mean? To get the answer, we look at 3 recent exits in the space. You've got Unleashed, Deer Systems, and TradeGecko. Each of them was doing around about $1 million a month in revenue, and each of them has sold over the last 18 months for anywhere from 110 million US up to 170 million US. We're raising $1 million. We've raised a quarter of that so far. The allocation of those funds will be in partnerships and sales, content production, customer success, and product development. If anyone's interested, please email me, tim@pencilpay.com, or we'll be over at our booth on the far side today. Thanks so much for your time, everyone. Appreciate it.
Thank you, Tim. Now we have our next panel session of the day. Everyone is going to talk about the state of FinServices and FinTech. Here to talk to us today is King Lung, Head of FinTech at Invest HK, Vincent Liu, Partner at BMYG Financial Group, May Lam, Partner and FS Technology Consulting at Ernst & Young, Tamas Sabo, Group CEO at Pepperstone, and Catherine Lyle, Partner at Seed Space Ventures.
Good afternoon, everyone. Can you hear me well? Yeah, I think I get, yeah. So welcome to the FinTech panel discussion. So my name is May. I'm a partner at EY, where I lead the payment practice for APAC and FinTech practice for Oceania. So EY FinTech Census last year told us that Australia's FinTech ecosystem was a standout hero through the whole pandemic. And not only that, as a sector, that we are no longer a startup or scale up. In fact, it is a grown up. And the data show us that as a sector, that we raise a lot of more capital like never like before, and also raising a lot of jobs. And 72% of the FinTech have set their eye on international expansion. So in the next 40 minutes, we're going to talk about how the FinTech as a sector and the growth, that's not only disrupting the banking and the financial services, but how it's going to change our businesses, economies, societies, and the consumer behavior. At the same time, how we can catch the tailwind of the growth of the FinTech to diversify the portfolio or the investment, forming more partnership, and also the collaboration and continue to grow and the innovation of it. So today, joining us, we have a stellar lineup of panelists as introduced, and also King joining us through Zoom as well. So without further ado, I'll probably start the first question. So are FinTech companies the new golden egg for the corporate VCs? Start for you, Thomas.
So I think the next golden, well, there are good eggs and bad eggs, I guess, in any investment opportunity. I mean, it's amazing what's happened in FinTech over the past 2 years, really. The level of investment that's going into FinTech, but also the changes that it's had on society. I mean, you wouldn't be able to apply for a home loan online at all 5 years ago, and there's been enormous change. There's the deep, rich data that people are analysing. It's all driven significant change in fintech. And there are two types. You obviously got the traditional disruptors, the payments, and online trading, and then you've got the sort of real disruptors, which is all the new stuff, and NFTs, and you've got crypto, you've got Web3, you've got all that sector. So there's opportunities across the board. Yeah.
Yeah, absolutely. Thank you. I think that, like the way you call out the data, probably we can unpack further later on. Catherine, what do you think about it?
Yeah, so if I put on my hat, so I'm a partner in a VC here, and I'm also a co-founder of VC in the UK, and we invest only in very early stage fintech in financial services. So I would say, to your point earlier on, we're kind of in our feisty teenage years here as far as an ecosystem. We've gone out of toddler mode, and if you compare us to our peers, we're doing really well. We're accelerating quite quickly, but from the perspective of corporate VC interaction, I think we're a couple of years behind, say, our peers in the UK, the US, Singapore, etc. As far as the sophistication and the evolution there. I think the GFC largely bypassed our banking ecosystem here, and we weren't impacted in Australia the same way as we were overseas. So there was a much stronger drive from governments and from industry to really push innovation. And you saw a real push for partnership happening collaboratively within these ecosystems overseas. And I think here there's been a much more I must own or build, but that's really pivoted in the last 2 years. You can see with the big four banks, with their innovation arms, with their funds where they're investing, you're seeing some of the big VCs allocating money to seed. I would still argue from our perspective, because we are really at seed stage, that first investment after you're bootstrapped, there isn't a lot of big VC money there, but it's certainly starting to filter down. So I'd say, is fintech the golden egg? I think it's definitely a lens now. Buying and partnering particularly is absolutely on everyone's agenda versus having to build in-house, and that's massively encouraging.
Vincent?
Yeah, I think I think for some of those large corporates, they've got a existing system and the products that already working really well for decades or maybe even longer. So obviously, for some of those large corporates, they won't change things dramatically, but at the same time, all of them are aware that how fast the world is moving, how fast new technology and innovation is changing the industry where they're in. So obviously that will continue to raise the interest from the corporate VC's perspective to continue to invest in early stage business to see what are the new ideas on the market, who are some of those early stage business that might potentially to disrupt the business they are in, or maybe just stealing some market shares from these large corporates. I feel it's more like a safe bet for them to get their foot into the innovation game, to keep a close eye on what's happening, in the industry, and so they can react as fast as possible once they feel they are ready.
Yeah, thank you. King, over to you.
Yes, I guess we have to be putting things in context, because when we look at the privileged position that we're in as a government department, UMass Hong Kong, the fintech team, we run an accelerator program called Global Fast Track. And through this program, we onboarded by now roughly 70 financial institutions as our ready buyers that are ready to open the wallet to adopt B2B fintech solutions. At the same time, we also onboarded roughly 30 to 40 what we call investor champions. So by talking to these champions, both corporates as well as the investor side, I think I have to dissect a question in two camps. Now, the first camp, whether this is like a golden egg in general, the answer is yes. And obviously, I think the more sexy domain would be around like crypto, the NFT, the DeFi. Those are the areas that garner the most attention, not just from the mainstream like VCs and so on, but also a lot of interest from family offices, which we also onboarded a few. Now, so that's the sort of general investment landscape. Now, whereas I think to your question about the corporate ventures, which we also work very closely with some household names from the Standard Chartered, SE Ventures, the Citi Ventures, even the big, the investment banks like the Morgan Stanley, the JP Morgan, the Goldman Sachs. So we talk to a lot of these guys. Now, and even for that segments, there are really like two camps. Now, the first camp, I would just call them as investing as hedges, because obviously with all the things going on to disrupt traditional banking, they would like to ensure they got a seat at the table. So when there's a very promising fintech doing amazing things that have the chance for disrupting their own business, they like to be the first to know. So the motivation for this group of corporate ventures to invest in them is really not about making money financially. It's like financial investors' perspective. But it's more about gaining insights at the board level, understanding the roadmap. And as a result, those insights could be beneficial for the banks to chart out the roadmap of transformation going forward. So this is the first type, which I would say 80-20 rule, this represents, let's say 80% of the corporate ventures of the banks, the insurance companies that we talk to. Now, the other 20%, the minority, so to speak, would be someone like, let's say, Goldman Sachs, right? So Goldman has a digital venture arm, but I think in the interest of time, I won't go into a lot of details. So perhaps we can talk about this.
We can unpack further. Yeah, thank you. So what we heard so far is that there's a lot happening in the fintech, a lot of innovation, a lot of maybe hype. So we really want to understand from the investment perspective. So fintech at different stages, we have different wish lists of the investors. Conversely, investors also looking at different criteria for different stages of the fintech. So Catherine, probably go to you first. How do you see, what were the insights that you've seen that from the fintech perspective? What are they looking for, the ideal investors?
Yeah, so we're super early stage. So we invest even at ideation stage. So they may not even have any MRR. And that's quite unusual to have a fund down that end. It's a lot more work, right? So we will then follow on right through to late seed and even Series A. But our first investment always must be at that ideation, early first raise stage. And we do that because we think the group we've got around the table, we all came from financial services, had big careers in capital markets. We've got a really strong network of connectivity across the ecosystem from a financial services perspective. And so we look for three things at that early stage. Obviously, what's the problem being solved? And is it a problem that actually wants solving? So there's lots of great problems out there, but sometimes when you get into it, the ecosystem won't let you solve it just yet for various types of inertia. The second thing is the technology being used. And it's not the number one thing, the tech, right? It's great to have some great tech, but even if you've got an ideation and it hasn't been built yet, if we can see the value there, that's another tick. And the number one thing we're really investing in are the founders. Who are the people doing this? Are they subject matter experts? How are they going to coalesce as a team? And our view from the founder perspective, that we're expecting them to ask for us, not just the cash, right? Everyone wants the cash, and there's much as you can get at that early stage. But from our perspective, we would hope they'd be looking for strong advice. We have a big, strong advisory model. We will sit on boards if they want us to. We don't demand it, but we certainly want to be able to leverage our networks, our experience, our connections to help the business grow. So from an early stage founder perspective, when you're going to these VC meetings, you should definitely have an ask on the table that's more than just about the cash. What do you need around the table, experience-wise? What have you got missing? Even if it's advisors and board members, and actually actively go out and seek that and ask for that to get around the table. So I'd say do that first up, because that'll set you on the right path to scale.
No, thank you. That's a really good tips. Vincent, what do you think? From fintech perspective.
Yeah, in terms of what we are looking for in the fintech, we typically invest in post-revenue stage startup business. So I guess for all stage of the business, essentially we are looking at a set of key things. Most importantly is still we are investing people. So we will take a look at the execution. So prior to this capital raise, what the team has done in the past, and then we will compare to some of the comparable business. Are the team executing the strategy faster or slower than some of the peer business? And also the experience, the prior experience of the team is really important. We need to. It would be great, the founder has a deep industry experience, knowledge, instead, not just on the technology part, but really they can articulate and understand the industry problem very well. And also they can demonstrate that they have a solution to solve the problem. At the end of the day, the last thing we will look at is still like business model, whether that business model that makes sense from a unit economics perspective or from a long-term path to profitability perspective. If the business can be sustainable in the future. These are a few key things we will typically focused on before our investment.
Yeah, thank you. So Thomas, from the investor perspective, what do you see the must-have criterion or the benchmark when they look at different?
I mean, the other two speakers have spoken about early stage, which I completely agree with everything they've said. But it's very important that as a business transitions from early phase to whatever the next phase you want to call, it's a different perspective that the investor needs to look at, because investing in the founder, investing in the idea is prerequisite. But then as soon as a business starts to get to scale, you need to think about cash generation. There's been a real obsession with growth stocks over the past 2 years, and I think everyone realizes that's sort of coming to an end a bit now. People actually want to see some cash flow. So it's important at that point that there is a real visibility of how that's going to happen. Also, it's very important to understand the unit costs of acquiring a customer, the value of that customer, lifetime value of that customer, and also what is your cash burn, what's fixed and what's variable costs, to really start projecting that into the future. And you can still be growing the business at that phase at a very high rate, but investors, I think, will start to demand cash a lot more than they have over the past 2 years, I think.
What about, so when you mentioned cash, I suppose that's more revenue side. When would they expect to see profit?
I mean, I talk from my own experience. I'm invested in a small business lending business, and I haven't seen the cash yet. I'm sort of very patient about it, but I can see it coming, and I believe in the business. I believe in the founder. So the fundamentals are there. I'm not desperate for cash, but I'm seeing the growth, and to be honest, it most likely will be an IPO where I realise the capital. But there needs to be a view of cash, otherwise an investor, whoever it happens to be, I don't think that's, I just think that the tide's changing a bit now. I think that sort of patience is not so much there as it was over the past few years.
Yeah, thank you. King, what do you think from the investor perspective?
Well, perhaps I'll add two more angles on top of some of the great insights from the other panel speakers. Now, first, when we have been looking at helping different fintechs, I would say over the past 2 years, we probably talked to over 1,000 fintech companies. So we got a pretty nice sample size of different nature. Now, and if I were to highlight two more items, because in a way, we also look at it from an investor perspective before we refer these fintechs to our investor champions. So the first thing is about the understanding of the level of competition. Or in other words, how do they, as a fintech, differentiate themselves against the competitors? And in most cases, a lot of founders, they are very smart people, used to be senior executives with major banks, insurance companies, but they somehow focus a lot on the product or solving a problem without knowing a lot or spending enough time to look at the competition and how do they stand out. So if I were the investor and also speaking on behalf of the investor champions, they really want to talk to someone to understand how this firm can win the game, how to stand out. This is one. And secondly, because Hong Kong is a city, so most of the time we will see actually more B2B fintechs than B2C coming our way. And as a result, a lot of times we also recognize that some teams, they're a great team, but somehow the one piece that's lacking is the sales team. So I think that's another piece whether or not we can judge that firm, besides great technology, great team, whether or not they can win contracts. So those are the things that are more practical, but it's also a good way to gauge whether or not this fintech can gain traction quickly.
Yeah, thank you. Okay, let's move on from the investment perspective. Let's look at the innovation itself. So how has the innovation in fintech actually increased the access to the traditional assets for the retail investor? So Thomas, probably start with you first.
Yeah, look, there's been a proliferation in more financial products available for retail investors and obviously wholesale as well. There's a lot of development online on education. Also, the UX is really important if you want to get into investment, just the process of understanding how you start from, exploring an investment to actually doing the investment. It's far, far easier now online to learn that yourself. You don't have to go and get an advisor so much to help you. Our products, I'm not here to push Pepperstone, but our products give you a very, very versatile access to a very broad range of products, which was traditionally only available for institutional investors, and there are many other companies doing the same thing. So the proliferation of more product is there, and the education, which is really, really important to understand it, is there, because if you don't know what you're doing, it's best to sort of sit back and get educated.
Yeah, I think that the education is quite key in this stage to give people the confidence of getting into the trading. What do you think, Catherine?
So my career started out, I ran derivatives trading and hedging businesses for banks for 12 years and then went overseas and set up entire new exchanges from scratch for NASDAQ and LSE and ran Chicago Board of Trade and CME for EMEA and Asia. So I've seen that whole value chain happen from execution right through to clearing and settlement and custody and the digitisation of that all the way through. And from a listed perspective for retail, there's a massive amount of opportunity. And then also through brokers like Thomas's, for the OTC products, for retail, there's an enormous amount of product to access. There's a lot of, technology in it to allow you to analyse those markets and help you make good decisions. But I think when you get to the space we're in now from a VC perspective, which is unlisted early stage companies, and honestly, that's where a massive amount of upside is, right? If you get it right. And a lot of the unicorns you're seeing that are listing now globally, they're kind of a 8 to 10 year overnight success and have usually come from somewhere very humble and worked really hard at a real problem. So I think that the thing that I see, well, we've got a lot of opportunity and a lot of scope to invest as retail investors. I think the way data is being democratised, the access to deep information that normally you'd only get sitting on a OTC bond trading desk or on an FX desk or something like that, that stuff's now more readily available, and it's going to mean that retail investors are going to increasingly get better and better informed. You've seen what's happening in crypto world. People do want access to things. So I see that democratization of data and how it's used and how it's assimilated and how it's delivered out to people, increasing the opportunities for retail investors. But it's always buyer beware.
Yeah, that's a really great point. And also, I think we can all see that through the COVID, it changed the way we pay, it changed the way that we interact, and changed the way that we consume the financial services. So I think that kind of change is going to be permanent. So Vincent, would like to understand from you that how all this phenomenon has been changing. The mobile banking, for example, the way that the cashless society is interrupting the banking industry. So what is your view of what would be the next, and how we collectively can take the lessons learned and the opportunities from it?
I think by moving away from a cash-based payment system into a digital payment system, the biggest change will be the process creates a huge amount of data. So the data itself is a wealth itself. So in today's world, for business to continue to be competitive, you gotta has the capability to collect these data and analyze data and get value at more like this data-driven decision process. So if the business cannot keep up the pace to extract more value from this data, probably they will be in a disadvantageous position in terms of understanding their customer, in terms of understanding the changing market trend. So in my opinion, the biggest change will be the data creation and a successful business has to leverage the power of data to make their business model more competitive.
Yeah, thank you. King, you mentioned about the corporate venture before, so we'd like to understand more what is the implication to the incumbent institutional bank and commercial bank perspective?
So sorry, you mean how do they see the competition, or?
Yeah, so they have been disrupted through the fintech, and most of the fintech probably is touching the retail or consumers or maybe SME perspective because it's easier to adopt. So when it comes to the institutional bank and the commercial bank, the big ton of the big guys of the town, what do you see the impact of that, and what will be the opportunity?
Yeah, well, I actually have done a study into the fintech evolution for the past 40 years before this field was called fintech. I would say the first wave back in the 90s in the US were more confrontational, where the fintechs were trying to really disrupt the mainstream players, the traditional banks, so to speak. But then in recent years, the past decade or so, we definitely see that the whole mindset has changed. They try to be much more collaborative. And I just want to use one example. Now, for example, when we talk to a fintech in the business of revenue-based financing, okay? So it is the business where they would go out to lend money to, say, some small e-shops selling, let's say, training courses and whatnot. Now, and then they'll be providing the money for these small e-shops to do, marketing on IG and so on. Now, so the one thing that they need desperately is the ongoing working capital. So who do they go to? Actually, they go to so-called traditional bank. So there are certain banks, without naming names, there's some mainstream banks, household names. They have a dedicated fintech lending team. So they will actually lend money to fintechs to further lend the money out. So in a way, I guess the point I'm trying to make is that definitely, I think some really progressive-minded, open-minded financial institutions, they're looking for ways to, instead of competing, but they're trying to work with the fintechs to make money together.
Yeah, thank you. So have we seen the end of the high fees trading, and what do we expect to see next, Thomas?
I think we have, to be totally honest, and there's two reasons for that. One, well, it's really one reason, but you can call it two, but let's just say that the value chain within the trading space has shrunk, where people have captured multiple parts of it. Traditional broking is you have a broker, the broker then interacts with the stock market, and the stock market interacts with the market makers. And parts of that have been disrupted. Robinhood being a great example. They get payment for order flow, so they get a kickback from the market makers, and they send flow to a specific market maker. It's the reason why free trading exists. So what they're doing is they're sort of monetizing another part of the value chain, and the reason why they can offer free brokerage. The biggest risk to all of this is regulation, because this is being looked at very carefully by regulators. Because if you think about it, if you're sending an order to a specific market maker and then offering the best price, the client's getting ripped off. So large institutional traders will not be trading Robinhood. They'll be trading with someone else because they understand that there is no sort of free game here. But the real value is disrupting the value chain and just essentially doing it for a cheaper price because you've got less people to feed in that process. Yeah. So, I mean, that's the basic adage to free trading.
Yeah, thank you. What's your view, Catherine?
To put my old trading hat on and my old building exchange businesses hat on. So Thomas is right. It's been wrung out on the execution piece, I think. But I will say, having run numerous types of asset classes and trading businesses, T+2, really. I mean, lots and lots of stuff is T+0. There's a lot of fat still in that. There's a lot of regulatory capital tied up in those two-day holds. Even in futures, we've been 2+0 for 40, 50 years. And I think the old traditional ways of clearing, settlement, custody, how you hold things, that's definitely starting to get disrupted. Australia's is more expensive, I think, than trading in the UK and the US for the reasons of the way the market's infrastructure is set up. And I think competition's quite hard we're a very sophisticated market, but we're small. And so we have the players that we have. And I think our brokers, et cetera, do a great job in wringing the best they can out of it. But I think there's a lot of areas where there can be a big reduction in costs all along the value chain. We want to be able to keep that professionalisation of the value chain so that it's not exposing people to scams and things like that, I guess, right? They need to know what they're doing and that they're well educated around that. But there's tech absolutely happening here in Australia, and it's also overseas, that will come in and streamline a lot of those processes from the exchanges through the brokers. And so I think we can see a lower cost. And let's face it, we're changing the way we interact with our money, right? Everything's going digital. The banks know that. They want to be the platforms of the future for your wealth, for your mortgage, for your loans, for everything. So, the next 5 years, I think we'll see some big changes.
It's going to be a very exciting time. Vincent, what do you think? Do you think that we see the end of it, the high fee?
Yeah, because that's certainly what's happening in the US, right? So, because for a lot of the trading, because I think that the revenue model of this trading business has been changed. That's at least what's happening in the US. Some of these online trading business stopped charging commissions. They started to sell their trade order flow to other high frequency traders. So they can provide free service to their users, but at the same time they still get rewarded by providing the service. In Australia, we have started to see a lot of online trading business coming to operations. Obviously, brings a lot of innovation and the competition to the stock trading markets, and the fee is getting lower. Whether it will be zero, I'm not sure, but definitely it will be lower.
Yeah, we'll be at the aspirational goal. King, what do you think?
Well, I guess my view is the same applying to other segments as well. When you are in the early stage where you have a lot of competitors, then they have to compete on price to gain market share. But once the consolidation starts to happen and some players got somehow phased out by the market, then I think the remaining players would then have the bargaining power to raise price. So I think it's really about what stage the market is in. For the more mature markets, I would think that when the shake-up is finished, I think they would raise the price in addition to try and look for other revenue streams.
No, thank you. So for the last minutes that we have with you, probably one last question. Catherine, what do you think, what is the one advice you would give to the fintech?
To fintech starting up?
To fintech, yeah. Not as a startup, yeah, but to fintech.
If you want to make your business a success, talk to everybody, show up to everything. In Europe, in the US, etc., you can pitch every night of the week for money, to educate, etc. It's not so easy here. We're much more spread out geographically, and people tend to invest in trusted groups. So I think we're trying to do a lot to educate. We're doing a lot to try and professionalise the pitching environment. We're doing a lot of work with government, with policy. I sit in the board of FinTech Australia as well, to try and really improve the early stage funding ecosystem, right? Because there's some really smart players in the ecosystem, but it's very hard to join all the dots together.
Yeah. Thank you. Vincent?
I think, maybe one advice would be don't die. Right, so that would be the very basic of starting a venture, and also from day one, because I think in today's world, the venture capital investor, they value how much the revenue is growing. So the valuation of the startup business is linked. They value business on a PS multiples. But at the end of the day, for a business to be relevant or to be competitive from a long-term perspective, you always need to have a playbook to make the business profitable, instead of continue aggressively grow the top line, but always has a very ugly bottom line. So I think Yeah, so don't die.
Thank you. So very quickly, so what would be one advice you would give to the investor who is interested in fintech?
I'll try and be really quick because I know time's up. So for me, regulation is probably the area that most investors don't understand well enough. There's plenty of examples of Afterpay being a great example. The share price of Afterpay moved around by comments from government. Bitcoin was up 10% last night because the US government said, oh, we're not going to regulate it too much, and that will change tomorrow. So it's really, really important that if you invest in financial services, it's a highly, highly regulated industry globally, and the regulator, governments care about customers. They care about the not ripping them off, and that's really, really important. The government has an agenda, and it's important that you understand that, because you could invest in something, and then before you know it, it's completely regulated out of existence. There.
Thank you. King. Very quickly,
Sure.
for the investor. Yeah.
Sure, I'll keep it short. Again, we have a lot of respect for the investors, the smartest people in the food chain. But the one thing that we believe that the investors can do is to reach out and work with multipliers like us. So we are in the business of helping to scout for fintech projects. So last year, we basically scouted fintech projects from something like 60 economies around the world. And then we channel some of these deals to the investors to basically save them some time. So I believe that this would be something that can be an additional level of value adds. So the VCs, investors, providers in the audience, feel free to reach out to us, and we'll be happy to work with you and channel some deal flows.
Awesome. Thank you so much. Please join me to thank our panelists for their generous advice. Thank you.
Amazing. Thank you so much, everyone, for coming in. We really do appreciate your time. Next, we have our final panel session of the day called Personalised Healthcare. So with us today, we have Rob Scott, Managing Director of Australia Asia Technology Incubator, Leslie Chong, Chief Executive Officer and Managing Director of Immugene, Liz Boyce, partner at Piper Alderman, and Janine Joen, Doctor Principal at One Ventures.
Well, good afternoon, everyone, and congratulations on climbing the hill through today, and you've reached the pinnacle in our panel session. My wonderful panellists have already been introduced, and I'm so glad to be with them today. As we gather, I'm conscious that we're gathering here in the Fullerton Hotel on the traditional lands of the Gadigal people of the Eora Nation. And if you're joining us virtually, you may be joining us from the traditional lands of other peoples. And so I want to pay my respects to the custodians of all of these places, the custodians of the land, sea and community, and also to any Aboriginal or Torres Strait Islander persons who might be joining us today. So we're here to talk about personalised healthcare, and whether that's an area that you're deeply invested in already or just curious about, I think it's fair to say it's something that resonates with us all. At an emotional level, we all like to be treated as an individual. As a scientific level, we recognise that in order for us to effectively treat and diagnose and prevent illness, we need to have a deep understanding of the genetic makeup of the patient to make sure that the right product gets to the right person. And from a health economic point of view, we know that we have scarce resources to deploy, and so the better we get at deploying those resources to the right people, the better quality of life we can deliver, the better the health economic outcomes. So those are the ways in which we might resonate with personalised medicine as we come here today. My panellists each have a variety of perspectives on that space, and our hope is that whether you're here as a company that's involved in personalised medicine or thinking of, you have an idea for a product in that space, or if you're looking at an investment or potential investments in that area and wanting to learn more, we hope that we'll come to you with some practical insights. So I'm going to start with Leslie Chong, the CEO and MD of Immugene. And Leslie, you've been in the oncology space. You're incredibly passionate about the oncology space and bringing drugs through the clinic and out into the market. I mean, in that experience of a couple of decades, you obviously started very young. What have you seen in terms of some of the developments in personalised medicine? What are the opportunities that you see? What might be the hurdles to realise the opportunities?
Thank you for that. So I love what you said there at the end about quality of life, because that's what we want. We don't want to be living, withering in pain. That's not really living. So I think medicine, and especially in oncology, has come a long way in that, as of 2011 is when we saw immunotherapies to be one of the pillars of cancer therapy, and that was significant, and that was a way into personalization, because if you know nothing about cancer, the way we used to treat cancer is just blow it up with chemo, radiation, and then we had this smart, really, great idea that let's look at biomarker, let's look at genetics, let's do small molecules, tyrosine kinase to inhibit certain cellular therapies, and that is also quite personalized because you need to know the genetics. And then when immunotherapy came into play, I mean, it changed the paradigm of how we looked at each patient treatment. I mean, Michael Baker's here, he's got a CAR T in the company, and CAR Ts nowadays are giving a rate of cure that we have never seen in cancer therapies before. You're seeing something from 20% jump to 40% to 60% to 90%. I mean, it's incredible, but it's all due to the personalized nature of how we treat individual humans. That was very long, but thank you for letting me say that.
Well, it almost sells itself, but I might dive in a little bit deeper in terms of to get to that amazing success rate, it must be a fairly expensive and lengthy process to get there. I mean, what are the hurdles that you need to overcome?
Well, we're standing on the shoulders of giants. I mean, CAR Ts are something like $300,000 to $500,000 for a one-shot deal that you can get maybe a 40%, something like 90% cure. And so our health system, that is really, really difficult to bear. And so now people brighter and smarter than I am are looking at allogeneic rather than just individualizing that and the manufacturing aspect. They're looking at off the shelf, which will decrease that price significantly and still have, benefits to the particular patient.
Thank you. I'm now going to pivot across to Rob, and Rob, as well as the Australia-Asia Technology Incubator, you also have a role in some incubators in the UK. When we were talking before this panel, you were telling us about a particular group that you're working with, P4, the Precision Medicine Incubator in the UK. And so I thought it might be nice to sort of move across to that sort of early stage companies. What are some of the companies that you're seeing through that incubator? What are some of the challenges that they've got to realise their potential to attract investment and hone their strategy?
Thanks, Liz.
It is on.
How's that? It's better. Thanks, Liz. Look, and that's right. We're not just, I guess, an accelerator focused on healthcare, but we're actually focused on cross-border healthcare, which is quite challenging in itself. I mean, some of the companies that we've helped over the years, groups like Sky Genomics, have a genomic platform coming out of Brisbane, or Sticky Cell, which are working in the blood work sort of area, using luminescence there, doing some really fantastic stuff, spun out of TRI, or more locally here in Sydney, Monomic or Glytherics, with immuno-oncology, detection and also a treatment therapeutic company. So that's, I guess they're the kind of companies where we're helping basically into both Australia and into, markets from Australia into Asia and obviously UK and Europe. And obviously working in UK, of course, we're working with P4, which are probably, I guess, arguably the leading personalised medicine accelerator themselves, an incubator in the UK market. I think they have about 150 companies. Not, too conversant with the individuals, companies so much that they're working with specifically, but I know, for example, that they're looking at a few key areas. So Oncology, obviously, is about 30%, I think, of the market they're looking at from across from immuno-oncology all the way through to detection, treatment, and management of that. I think female health is another one which has been a really emerging market, and trying to look at ways in which to translate a number of the technologies, the treatments which are available for men, basically for women as well as obviously treating specific sort of conditions. And then I think another one, obviously, in terms of AI, so platform sort of multi-omics sort of technologies obviously are a key one for them, the ones that we've been sort of talking with them about and working with them. So suffice to say that obviously in the last few years there's been a fantastic sort of increase in interest in personalised medicine as the whole power dynamic, it's moved, in countries like Australia, UK, US, and even in Asia, from the medicos to the patients, is what Leslie was talking about. So moving that through and seeing the investment opportunity there, where the investors we work with and the partners, the multinationals we work with, are seeing great opportunities across the whole spectrum, really.
Thank you. Fascinating little comment about the emphasis switching more to the patient, that the personalised medicine allows the patient to have more control on what's happening to them rather than just the clinician. An interesting dynamic. I'm going to move across now to Jeannie. And Jeannie, you've had a life in the healthcare space, and now you're on the investor side of things at One Ventures, and we've talked about some of the companies and the different areas that they're involved in, the time and the expense to bring products to market. So when a company is coming to you as an investor, with a personalised medicine offering, that might sound really well, U-Butin and whiz-bang, but what cuts through to you in terms of what are you looking for as an investor? What do they need to communicate to you in order to have a compelling case for you?
Sure, thank you, Liz. Well, I guess there's a few things. Personalised medicine can be the individual, autologous treatment, but then there is also the ability to take that learning across the broader population. So a better way to manage chronic diseases, if you like, a more personalised way to manage chronic diseases. We at One Ventures have a few different funds under management, and one of our funds does focus on healthcare. And because of the way we like to work with the companies that we partner with, and we deliberately say partner with, we see a lot. We see a lot of different technologies. We see diagnostics, we see therapeutics, and devices. So I think we have a very good idea about the breadth, and obviously oncology is leading the way in autologous personalised medicine, and all of the other therapeutic areas are watching very closely and learning what they can. I think it's really important for anyone who is developing a personalised medicine to understand the competitive environment, to know what is out there. Because as I mentioned, we do see a lot of these things, and we do a lot of research, and sometimes people come to us and they think they've got a very novel idea, and it's not so novel. So I would encourage anyone, before they come to One Ventures or any other pitch presentation, just make sure that you have got that unmet need clearly articulated, and you know how you will achieve the solution to the problem that differentiates you from everyone else. And also, I'd like you to think, as I mentioned right at the start, more broadly than just individual autologous. I'm going
to put a time out because we've got a technical autologous. What does that, in case anyone doesn't know what that means?
Okay, so I think these CAR T therapies used in oncology are the perfect example. So I would go and I would donate my own cells. Someone in a lab would look at those cells and turn them on against my tumour. So I'm making it so simplistic, but anyway. And then they would grow those cells, and then in a period down the track, they would return them to me. So it's my cells, my treatment, but they're boosted, they're supercharged, and they will attack my particular tumour. So that's autologous. And as Leslie mentioned, you know, because of all the learnings, and there are learnings in healthcare that are not just applicable to the individual. As I said, they're more broad-based. So when they were developing these therapies, when they took the cells out and they grew them with the cancer and they found out that they could kill the cancer better and they put them back in the patient, it was amazing. It's a company called Dendreon invented a product called ProVenge, and it was for prostate cancer, and it was just amazing. But there were so many problems along the way. That company nearly didn't make it. Just things like supply chain issues. So there's all these ancillary benefits around drug development, diagnostic development, biomarkers and everything. And we are also interested in looking at those too. If you can facilitate a learning in one area, like in oncology, and take that to a neurological condition or take that to some other area, inflammatory processes, you can really make a huge impact. And there your business case will look a lot better too, because you're not just impacting that one little area, you're potentially impacting a much broader therapeutic area and treatment paradigm. Yeah.
So you have to understand what's unique about your product, but also then to be able to, having satisfied yourself that it's unique, think about, well, how might it fit into a broader picture? What else could it do, or who else could we work with to help another indication or another issue?
Exactly.
Mm-hmm.
Yeah.
Mm-hmm. And we've talked, just picking up on your comment about, the environment keeps changing. You might think your product is new, but perhaps things have moved on. I know, Leslie, we were chatting about that beforehand, how, you can think you've got a great product and then, 6 months later, something's changed in the environment. How do you keep across that, and how do you help your investors sort of navigate that with you as you need to respond to those changes?
You try to develop really unique products, as Janine was alluding to. You don't want to just have a product just because it worked at that one time space. And you have to keep in mind, your ultimate goal is to reap benefit for the patients. You're not developing to make more money off your company, to make the shareholders wealthy. You're developing a product that's actually going to give something back to humanity. And that's, I think for most of us that are in biotech, hopefully that's the reason why we get up every morning. The landscape shifts all the time. It is on a day-to-day basis. Something new gets approved, and that blocks you from going in that direction. And what you need to do is figure out how exactly your product is working in the patient. That personalized medicine here is key. If you know that it works in a certain population and some other product got approval in that particular indication, well, that is really good knowledge, because then you can pivot to a combination. You can look at other avenues of why that patient benefited from that particular drug. So for me, if there's something new in the landscape, it benefits my knowledge, it benefits where I'm going. That's how I approach it.
Growth mindset attitude there, Leslie. I'm going to move across to Rob, and you alluded to the fact that you help companies going into Asia, and I know you've spent a lot of time working in China. I mean, that's a huge market, a huge population. I mean, how does personalised medicine sort of speak into such an enormous population?
Good question, Liz. And just picking up on Leslie's last point, I mean, it's not just that the industry that we work in is changing from a medical perspective, but also that the fact that because of the countries, not just China, but throughout Asia, and even when we're now working in the UK, are changing rapidly in terms of the regulatory processes, their development, a whole range, of legislation sort of which is being developed, as we speak, kind of thing. So in terms of personalised medicine, it's really about how those countries, China for example, is specialising in AI and big data, and it's actually even down to a provincial city level where they're getting specialist sort of significant billions of dollars worth of investment at a government level to develop ecosystems around a specific aspect, whether it be genomics or platforms or or testing, to give them competencies to compete not just locally and within that country, but internationally as well. So I think we'll see a raft of these technologies coming through, and obviously we've seen that even with COVID, we've seen a range of Chinese-based tests and tests coming out of Korea and other areas. And I think we'll continue to see that out of Asia. And of course, with Europe, with UK, with post-Brexit, they're going through, in a way, a similar process of change, of development within that. And actually, it's important really to understand those dynamics on the ground to be able to take advantage of that and actually take those opportunities and also be mindful of the challenges as well and avoid the pitfalls coming through.
Thank you. Now, we've had a couple of mentions of AI, and I kind of want to have a little chat about AI because that sounds very cool and techy. So, Jenny, when we're talking about AI and personalised medicine, AI sounds very big, personalised medicine sounds very niche. How do the two work together?
Yeah, I'm really passionate about AI because there is so much data and we're collecting data all the time. And if we don't mine that data and get the use out of that data, what is the point of collecting all that data? So we're all individuals, we all have our individual genome, but if you overlay that there are similarities in our genetics, and then we have lifestyle, we have behaviour, we have psychology, we have environment, if you can find those traits that bring people together, you get a lot more out of your personalised medicine. This is the personalised not on the individual level, but personalised in a group of like people. And you can still have such huge benefits because when we quote patients who only with chemotherapy may only achieve 5 or 10% remission, and CAR-Ts up to 90%, some of those people are 100%, right? Some of those people are cured. So we need to find what is it about that person that made them respond in that way, and how many other people can we find and add to that pool, and then not treat those other people who will not benefit at all. So you can see it's going to have an enormous societal impact and as you mentioned at the start, great health economic impact. And that's why I think we've got the tools. We don't have the genome completely under our control just yet, but we're getting there soon. So we have to keep adding the data, keep mining, keep looking for what the similarities are and treat those similarities to get really superior healthcare outcomes.
Thank you. So a little bit on AI, that's great. I'm going to talk a little bit about team now. Again, we were chatting, Leslie, beforehand about how your team has grown over time and how, we've talked about the different teams that we work with. What sort of advice would you give to a company in terms of building out their team, an early stage company building out a good team, or an investor looking at, well, who's on the team and do I, the investor, have the opportunity to help some gaps?
For me, I look for early clinical development experience because that's exactly where we're at. And it's nice to have commercial experience, but that's not what I'm looking for because commercialization is another field of expertise, and we don't really need that at the moment. We'll hire as needed, but for a biotech company starting off, being in the clinic, that phase 1, phase 2, how to navigate the regulatory from the FDA, how to navigate through that myriad of landmines of landscape development. It is scary how hard it is to develop really great drugs in this atmosphere because of the competition, which is great for patient, but it makes you work a bit harder and you need to get some really good skills in your company.
So it's a challenging landscape, a lot of opportunity for both investors and companies in the space. What I might do now is I'm going to get my panel to, I'll give you a moment to think, but to give perhaps a final piece of advice in terms of, from a company perspective, on how to go forward and realise the benefits in personalised medicine, and then from an investor point of view, what as an investor would you be looking for, or maybe looking to contribute as you look at a company? So can I start with you, Leslie?
So my company was, when I joined in 2015 of September, it was 0.0079 cents, right? That's less than a penny. I'm an American, so you guys don't have pennies, 1 cent. And so it went upwards of 65 cents. And I thought, holy moly. But my goal has always been to develop meaningful products. And my saying has always been to anyone that joins my company or to an investor, follow the science. Because if you don't have science, you don't have value. You're not adding value. At the end of the day, what do you want to do? You want to build something that is meaningful to humankind. And that's where my focus is. That's how I invest my money. I look for innovative scientists that are going to manifest itself into something that's going to help humankind. And I would say the same to an investor.
Lovely. Follow the science and benefit the patient. Rob, what about you? Some advice to companies and some advice to investors?
Sure, Liz. Well, look, from the company side, it's and something we tell all the companies who come through our programs really is to go beyond, the shores of here in Australia. Look at the world. Look at where the opportunities are. It doesn't matter whether they're in Asia, whether they're in UK, whether they're in US, obviously. But look at those opportunities and how you're solving local needs. So if you can solve those needs through your technology or an application or a variant of what you're doing now, you'll find that there's a huge market out there for what you've got. We've got some of the best and brightest scientists and entrepreneurs and founders here in Australia, but they don't often go out, unfortunately enough, and obviously it's been hard of COVID, but even then, there's been lots of investments going on the last couple of years as well in this space. So I would say that just to try to venture forth and just get out there and be more active in other areas. And then I guess to investors, it's and similar in a way, I suppose, look at the opportunities beyond what you're normally seeing. Take the time and the patience to sort of understand the market. If you're not from the life science, the biotech space, it's quite a hard sector to get your head around, obviously. But that doesn't mean it precludes you as an investor from investing in this. Work with other investors that are maybe do have that scientific sort of rigor or more experience, and you'll find opportunities to add value and to make your investments work harder.
Lovely, thank you. And finally, Jeannie, some advice to a company and advice to an investor.
So for the company coming to us...
Remember to hold your mic up like a rock star.
Sorry, if you're coming to us for an investment, I'll just reiterate that for us it's very important, and I'm sure for many other venture companies as well, that there's a high unmet need, and you can clearly articulate that high unmet need, and that your solution is transformational. There may be many other companies that like stepwise improvements, but we're looking for a transformational change, so that's what we like. We'd like to know that you know what the competitive landscape is in the environment, and we'd like to know that you have got both yourself, if you're the founder, you have a team around you that also believes very strongly in the underlying science, and that you have also the ability to understand where you need support. Because we would not expect, particularly, early development companies to have all of the answers. We just wouldn't. So you have to be able to say where you're strong and where you need the support, and a company like One Ventures, that's where we thrive. We'd love to come in and give you that support. I think that the other thing is you need to understand that your development timeline is never going to happen, so you have to build in contingency, because we will certainly build in contingencies. So I'd say if you're a venture company looking at investing in a personalised medicine company, you would do all of your due diligence. You would make sure that all of those boxes are ticked off, and at the end of the day, there's just one thing. You might have a really truly impactful development, and it just may not fit with the company that you're speaking to because of the horizon, the development timeline. It might be a great idea, and they should give you that feedback too. They should say, you're on the right track, but it just doesn't fit for us. And that doesn't mean that, it's a slap in the face. Just keep going. If they give you the feedback, there's your number 10 and there's 9 ahead of you, maybe you should take that feedback on board too. But you're not always knocked back because the idea is not good. So I just wanted to leave you with that as well.
It's a very optimistic and reassuring way to finish. So we've traversed quite a lot of ground in this presentation. I hope you'll take away some insights around the importance of the unmet need, the focus on the patient, understanding the science, understanding where your science fits within the broader landscape and how that landscape might be changing, being willing to go that long journey, have the right team around you and understand where you fit into the supply chain and the wider ecosystem. So there's a lot to take in. We're all on LinkedIn, so feel free to reach out to the panellists if you want to continue the conversation. And I just want to say thank you to my wonderful panel for sharing so generously, and thank you to our audience. So please join me in thanking our panel.
Thank you so much, and great to see you here, Leslie. It's like 2 years ago, I remember watching you present at Emergence 2020, and then watching your share price go like that ever since. And Liz, and also from Liz's side, what I love about the life science community, I know obviously participating in events and so forth is part of it, and from our perspective, we'll take this and we obviously we've recorded everything today, and we want to share this as much as possible going forward, because this space, to me, is one of the most exciting areas over the next 5 to 10 years. And every single one of them worked hard over the last sort of 10 to 15 years to build the life science ecosystem in Australia. It's nice that you're starting to see some of the value that these companies had inside actually achieve the valuations that international groups saw in them and the potential. So thank you so much for participating in Emergence. All right, so that concludes today. Now, tomorrow, and obviously for also on the live stream as well, tomorrow is Fun Day. So when I say fun, I mean Web 3.0, I mean crypto, I mean NFTs and so forth. This has been one of the hottest topics for a lot of people over the last sort of couple years. It's one of the funniest spaces in that everyone starts out and is, I don't believe in it, I can't see the value in it, I can't see this, and then next minute they're buying stuff that you would never expect. And I literally had a conversation with my own shareholder 2 months ago where they said something like that, and then literally the first thing he wanted to do was look at the NFT gallery. And now he's it's one of the most funniest. So tomorrow's going to be an exciting day. It's jam-packed with all the sort of investment leaders in this area that have basically been the ones that have built the ecosystem in Australia, including the most recent announcement from the Immutable X guys who just did a deal at sort of valuing them at over $2 billion, and they only launched a couple years ago. So exciting day tomorrow. Well, hope you enjoy the rest of the tomorrow. Obviously today is the end. And then obviously we've got the fun stuff as far as the networking and drinks at the end of tomorrow night. So I will see you all for day 3. Get rest, recharge the introvert batteries if you're an introvert. For the extroverts, just keep networking. Thank you.